quarter. When your disbursements are weak and your asset quality deteriorates, the NII growth weakens, and NII growth rate of 1.4% YOY is the lowest that you are seeing in last 11 quarters. There is a sharp decline in net interest margin by 35 basis points sequentially. Hence, the net interest margin is at 7-quarter low. Now, AM growth is also weak at 14.3% YOY and just 2.8% sequentially. AM growth declined both YOY and quarter-on-quarter in real estate financing, infra financing and wholesale financing. Back to you.
Okay, all right, got it. Thanks for that, Abhishek. Let's move forward. We have Sudarshan joining in on IGL. So, good morning.
Morning, Surbhi. So, company has reported a healthy set of earnings for Q4. It's an operational beat. EBITDA has increased by 37%. It has come in almost rupees 500 crore. And estimates of EBITDA, it was around rupees 410 crore. So, it's a beat on this front. Margin has also increased to 12.6% in comparison to nearly 10% in the Q3. Volumes were largely in line. It has come at 9.2 MMSCMD, and that is the flat on a sequential basis. The biggest positive, EBITDA per SCM. The estimate for EBITDA per SCM was around rupees 4.80, say rupees 5, but company has reported EBITDA per SCM of rupees 6, and that should be taken positively, and that's the reason I'm going with green for IGL.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's go back to Rima. She's here to tell us about Tata Tech as well as Zensar Tech. Rima, take it away.
Well, let me start with Tata Tech. The top line was a tad bit subdued. The company's constant currency revenue growth declined by 3.3%, but the EBITDA margin performance was better. Margins improved to 18.2%. The auto part of the business struggled, while the aerospace business, which is a smaller portion on a low base, has actually done very well with an 8% growth. So that explains the top line. The company also said the BMW JV is actually ramping up ahead of schedule. JP Morgan has an underweight call on Tata Tech, and they're saying we're expecting a low single-digit revenue growth in FY26 with flat margins. Keeping that in mind, the current valuations of 37 times PE is expensive and not justified. Zensar has reported a pretty decent decent numbers given the context. Revenue growth was at 0.9%, margins up 10 basis points. The total contract value of deal wins up 4% quarter-on-quarter. So at least there is some growth, compared to many other companies where we've seen revenues drop off. The problem is manufacturing and healthcare that declined for the company, and the company in the conference call said that they anticipate FY26 to be better than FY25.
Okay, all right. Got that, Rima. Thanks very much. Back to Abhishek then. More numbers on the financial front. IDFC First Bank and Poonawalla FinCorp. Abhishek?
Well, IDFC First Bank, they have overshot their credit cost guidance for FY25. So their FY25 credit cost is at 2.46% versus the guidance of 2.25%. In terms of our poll, both the ANA and PAT, they are lower than our poll. Microfinance SMA 1 and 2, that book increased to 5.1 versus 4.56% in the previous quarter. So watch out for MFI stress in the coming quarters as well. Net interest margin is at 10-quarter low. NII growth on a YY basis is less than 10%, the lowest that you are seeing in last 22 quarters, and just 0.1%, which is the lowest in last 19 quarters. ROA continues to remain weak. Quarterly annualized slippage ratio has declined a bit by 20 basis points, 3.73 versus 3.93%, and thanks to a write-off of 1,486 crores, gross NP ratio is one of the lowest that you are seeing in last 17 quarters. Now, Poonawalla FinCorp, unbelievable, the AUM growth is unbelievable, robustly high with respect to all the lenders that you are seeing. Operationally, a weak P&L over there. So AUM growth is at 42.5% YOY and 15% quarter-on-quarter. No other lender has seen this kind of massive growth. The NII growth is weak at 11.5% YOY and just 6.4% quarter-on-quarter. Weak with respect to if you compare to the AUM growth. Operating profits have declined by 41.8% YOY. PAT is down 81% YOY, and it's up about 233% quarter-on-quarter thanks to the low base. Key ratios, if you watch out, the calculation shows that the net interest margin has declined both YOY and quarter-on-quarter, and ROA continues to remain below 1%. Asset quality largely stable with respect to gross NP and net NP ratio. Back to you.
All right. Thanks a lot for that, Abhishek. In fact, we have the management joining us at 10:15 a.m. to discuss their Q4 earnings. So stay tuned to that conversation of IDFC First Bank. Mr. Vaidyanathan will be joining in here on CNBC-TV18. Well, today the big numbers that I'm going to be looking at is going to be Ultratech Cement from the cement pack, but we have one of their, the companies that they own, which is India Cements, that came out with its set of numbers over the weekend. And it seems in the first quarter of them taking charge itself, they've tried to make some kind of difference. On the top line, there was only a 3% degrowth. We were getting used to seeing higher degrowth numbers coming in from India Cements, and the EBITDA number is still a net loss, but the EBITDA loss has come down to just 3 crores. So that turnaround strategy is something that we'll be focusing on. Expect the stock to open up in the green because it's corrected 25% from that open offer price, and now it trades at around $80 per ton on an EV per ton basis. The net debt has come down to around 1,000 crores or thereabouts on a year-on-year basis. That's sharply lower. And they'll also benefit from the price hikes that have been taken in South India. So we can expect an improved performance coming in Q1 FY26. So put all this together, going with green on India Cements. That said, let's do a quick recap of all the top stocks we just covered. The ones with positive news flow include Reliance, Mahindra & Mahindra, IGL, Zensar Tech, Poonawalla Fincorp and India Cements. While the stocks with negative news flow include SML Isuzu, L&T Finance, Tata Tech and IDFC First Bank. That's about the equity markets. Let's turn our attention to the commodity pack. We have Manisha who joins us as always to tell us what's going on there. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the gold prices because we've seen further decline coming in. For this one, remember, Friday was a 2% of a decline. And now from the all-time highs of $3,500 an ounce, the gold prices have come off by nearly 6%. Well, there has been rebound in the US dollar index. There are also potential partial exemptions and tariffs, perhaps between US and China. And the markets do believe that the global trade tensions in some sense may be easing as US continues to negotiate with various countries. And that's led to that long-awaited profit-taking in case of the gold prices. The one thing that really seems to be getting support right now is the crude oil prices. They have been inching up in Asia, trading flat to slightly marginally on the higher side right now. Well, the markets are reacting to China Politburo meeting, which is vowed to stabilize jobs, increase insurance funds, etc. And then the markets also are reacting to the Iran port of Bandar Abbas explosion. The street will watch out for the OPEC and allies meeting. Remember, they are increasing production from the 5th of May. And there is a meeting on 5th of May as well, which will decide on what happens from the month of June in sense of output from OPEC and allies. So it's going to be an interesting next couple of weeks, especially for the crude oil prices.
All right, Manisha, thank you very much for that. So oil in focus as well. Now, Maruti reported a weak set of numbers for the fourth quarter. EBITDA fell about 9%, net profits fell 4.3%. Those comments from Mr. R.C. Bhargav, chairman in Maruti, really made headlines, essentially talking about, FY26 domestic growth unlikely to be better than FY25. And of course, there were also comments about effective purchasing power, in terms of consumers in India and how that needs to sort of grow for sustainable growth. I mean, slightly macro-ish comments which made the headlines, but this is, of course, what he told us earlier. Listen.
The projections made by SIAM on the auto industry for 25-26 do not show a better picture than 24-25. Last year, we grew at about 3%. The forecast made by SIAM is 1 to 2%. So the domestic demand is not growing beyond what it has been in the past, maybe falling a little bit. Where we see a silver lining is that our exports are going to grow. We grew exports at 17% last year. We expect that exports this year may grow at about 20% this year. So that is going to make up a lot of what may or may not happen.
Okay, that's Mr. Bhargava talking about the road ahead for Maruti. We have to take a very quick break. Come back on the other side. We'll be in conversation with Prakash Diwan and get you some fundamental analysis on the stocks in focus today. Welcome back. Reliance Industries. Let's get to the analysis on the big giant. Came out with numbers, of course, after market hours on Friday. We have a whole panel of experts joining in. The numbers are fairly steady. Fourth quarter performance quite all right across all the key segments. The revenues was up about 9%, driven by strong growth in digital services, and retail recovered rather well. To discuss this, we have Gaurav Malhotra, Executive Director, Axis Capital, joining in. He tracks the telecom space. We have Karan Taurani joining in to size up retail operations and how Q4 was for Reliance. And, of course, we have Prabal Sen, who tracks the energy space at ICICI Securities, joining in. And, of course, Karan is from LRI. And we have Prakash Diwan right here as well to discuss Reliance and other stocks. Gentlemen, good morning and good Monday to all of you. Let me first start with telecom, Gaurav, because that's where I think the quibble is that, yes, ARPU has gone up. I think it's gone up to 206, but maybe the street had a little more in mind. But overall, how would you look at it, and what's the sustainable expectation now that the first round of tariff hikes is behind us? What are you penciling in from Reliance's telecom business this year?
Yeah, hi, good morning, everyone. So, see, in terms of ARPU is actually slightly ahead of our estimates. Do note that this is a quarter in which there are 2 less days. So, even if on a like-to-like basis, the ARPU would have sort of dipped, say, 2%, give or take, and the ARPU is up like 1.5%. So, from that perspective, the ARPU has actually moved up, right? And it has moved up on the back of 2 reasons. One is that there has been some residual tariff hike benefit, and secondly, there seems to be increasing data consumption, which is also helping, the company from an ARPU uplift perspective. Now, in terms of how do we sort of think about ARPU moving ahead? See, end of the day, there will be more hikes, right? So we are expecting a hike somewhere in the next 1.5 to 2 years from the last hike. So the last hike happened in June of last year. So roughly, say December 25 to say June 26 is when we expect a hike, and on a compounded basis, we expect that the ARPU of say Jio should probably increase by 8 to 9% over the next say three years, and there will also be benefit of subscriber addition. So on the whole, we do expect a healthy top line growth for Jio in the coming 2 years.
All right. Hi, Gaurav, and gentlemen, thanks a lot for joining in. Gaurav, since we're talking about the ARPU and the telecom sector, the segment for Reliance, are you factoring in the IPO sometime during this year? And what kind of value are you ascribing to this part of their business?
Yeah, so it's difficult to give timelines on IPO. We don't have much information, right? The only thing we know is that a fundraise with external investors has happened in 2020. So it's been 5 years since that. So difficult to give a time on the IPO perspective. In terms of the valuation, see, from an EV perspective, our EV is roughly around $125 billion for Jio, which is roughly valuing it at like 13 times March 27 EBITDA multiple. This is roughly in line with what we ascribe to Bharti India.
Okay, all right. Got that point, Gaurav. Thanks for that. Let me come to Prabal to size up the energy business. Prabal, good to have you on the panel this morning. We'll talk oil and gas, E&P, all of that. But what was interesting that I noted was that brokers now have started ascribing value to the new energy business. I think I read a Motilal note. I think they're factoring in about 75 rupees from this piece. But you tell us, how did things fare? E&P was a little below estimates on volumes, KGD6 volumes, like we said. But what was your takeaway, and how much value are you giving to new energy right now?
Yeah, to answer your last question first, new energy, I think people have been valuing at a multiple of capital employed. I think what will probably change is as visibility continues to emerge in terms of the timelines of completion of some of these plants. All of us will probably start to sort of build in specific tangible numbers coming through from the segment. So the valuations will probably see a rejig up or down. We don't know at this point of time. But as far as we are concerned, we are valuing it at about 1.5 times the initial capital investment that was announced of 750 billion rupees, which translates to, I think, something like 50 to 60 rupees a share. So that's something that is there in our SOT. That's one. As far as the first part of your question in terms of how the energy business performed, I think in terms of KG-V6 performance, yes, probably the production was a bit lower than expectations. But to be fair, the management had already, always maintained that these were not exactly new fields. These were essentially satellite fields These were standard fields that they had basically developed to, sort of increase production from KG. So they were always going to have a relatively lower shelf life in terms of a peak period as well as a plateau period. So some decline, I think, was to be expected. If I look at the commentary that was made, I think they are looking to sort of stem this decline to the extent that they can. How successful they are, I think, is only going to be seen over the next couple of years. But, obviously, I don't think that they realistically, Upstream can actually show any huge growth in the near to medium. I think the OTC segment business is where I think the attention needs to be probably built in, given the kind of uncertainty that we're seeing, in terms of the global margin environment. The management themselves were very clear to point out that petrochemical margins are near a decade lows across certain key commodities. And I think that is something that remains a bit of a worry. That from this base, while there is capacity expansion now that is there on the anvil by FY28, that should sort of commission and start to contribute. From a margin perspective, I think that remains a key monitorable. When do we actually see any recovery, both in the refining and petchem part of the OTC business? I think that is something that remains a bit of a worry for us.
And what's the timeline of recovery that you're factoring in, Prabal, given where oil prices are and, where demand seems to be?
I really think that from a demand perspective, I think refining is not doing that badly. Petchem, there is a little bit still of oversupply. So, I would expect recovery probably in refining slightly ahead of what happens to petrochemical. But just to be specific to Reliance, I think what they have done well is they continue to sort of diversify and, be flexible between the kind of several multiple inputs that they use in the petrochemical business. As you know, they have a substantial amount of ethane-based capacity. They have an ROGC-based capacity, and then they have internal naphtha-based capacity. So, beg your pardon. If they are already trying to source much more ethane for the expanded capacity that they will have on stream. And I think even within the existing part, the ethane pricing benefit is something that has actually kept them afloat. If you look at some of the trends that were there in margins, the fact that Reliance has still managed to deliver 150 billion in EBITDA, I think it's a function of the fact that they have a diversified and a very flexible sourcing mix, rather than any huge change that has happened in pricing per se. I think that will probably continue on.
Okay, all right. Let's address the other part then. Karan Thorani as well as with us. Hi, Karan. Always good to see you in. Let's hear your thoughts then. The retail part of the business was a bit of a worry. But in the past quarter, that seems to have grown quite well. And it's laid a solid foundation for growth in FY26 as well. What was your reading in terms of the performance in the past quarter? And what are you penciling in terms of a path ahead?
Hi, Nigel. Good morning. I think if you look at the retail business, I think the performance was slightly disappointing. Majorly on two counts. I think this is in line with expectations as well, largely. Reliance, as you know, is a large conglomerate. They operate more than about 19,000 stores. They have been kind of rationalizing their store growth. If you look at the net store addition this quarter around, it was extremely low. If you look at the last 7 to 8 quarters trend, the net store addition has been kind of coming off. So this could be, concerns relating to the digital businesses. So if you look at the grocery business, we have seen disruption that side because of quick commerce. If you look at the beauty personal care category, even that is moving very aggressively, towards the online segment. So I think putting these things into perspective, they would have kind of, curtailed the stores. Every segment is seeing increased competitive intensity. The apparel category, the fast fashion segment, all these segments are seeing increased competitive intensity. And maybe that's why they're trying to rejig their portfolio, curtail the stores. And this may be a near-term thing, right? I mean, it's going on since the last 4 to 6 quarters. But the big question mark is, how long does this last for? Is it for another 4 quarters, 6 quarters, 8 quarters? What exactly are the plans in terms of store rationalization? Because unless the stores don't move up in terms of growth, you will basically not see, the overall growth coming back for Reliance Retail. So if you look at Reliance Retail as a portfolio, overall growth was in the range of 15 to 18%, which is now come to almost about 3 to 4%. So I think store growth is very important to come back, and how they kind of execute that, what are the plans there, that's a very big monitorable. Second monitorable is around the digital businesses, right? So I mean, all these businesses, whether you call it electronics, the FMCG, beauty, personal care, because of quick commerce, e-commerce, there's a lot of disruption there, and there is extremely high growth on a digital part. Offline is kind of struggling because of footfalls and also because of increased competitive intensity between D2C brands and many players coming in the market today. So I think how Reliance executes their digital business plans, that's also one very big monitorable, because if you look at the contribution in terms of digital businesses for Reliance Retail as a company, it's been range of 17 to 18% for the last 8-10 quarters. So no doubt, I mean, the contribution has remained stagnant, but it's not grown, beyond the point. So they have to really scale up digital businesses, which will come on the back of better execution, maybe better assortment, or they're trying to rejig their strategy, doing JioMart 30-minute delivery. They're trying to launch Shein as well. So how they execute these online businesses is going to be a key monitor in terms of how growth pans out for Reliance Retail as well, apart from store expansion coming back on track.
Okay, all right, gentlemen, thank you very much for a very comprehensive 360-degree perspective on Reliance, all of its businesses. Very, very helpful this morning. Thank you for weighing in. So now let's quickly go to Prakash, if we can. Prakash, we have lots to discuss, but quick, 30 seconds on Reliance. All the analysis, everything put together. What's the call on the stock?
If you were to accord a 10 lakh crore EV value to Jio platforms, to retail, and all the O2C, O2G, and of course the new energy business, it kind of lands up at about close to about 27 lakh crores of market cap, which is a significant move from where it is in the next 2 years. So my math is pretty clear. The SOTP is extremely favorable. Quarter on quarter is difficult to analyze Reliance, but from a long-term trajectory that it's kind of aiming for, it's going to be exciting. Probably one of the best large-cap stocks that's available at the current juncture. So quite enthused with these numbers. And of course, we'll wait for the EGM commentary to kind of consolidate or validate these expectations.
All right, fair enough. That's all of Reliance. We'll take a quick break on that note. Come back, more stocks to discuss, more fundamental analysis as well as technical. Sudarshan Sakhani and Mitesh Thakkar joining in with today's trading setup.
Welcome back. There's 8 minutes to go for the pre-open session to kick off. Flashes at the bottom of the screen. It looks like it's meaningful. Sonata Software has bagged a 5-year contract worth 73 crores from a US technology, media and telecom sector company. So for a company the size of Sonata, it's a pretty meaningful, large contract which is coming through. We'll try and connect with the management a little later in the day. Sudarshan and Mitesh are with us for now with what they'd want you to do in terms of trades. Gentlemen, good morning. Good to have both of you here. Sudarshan, you go first. What's the picture looking like? How are we set up in this fresh new week?
The last 3 days we were choppy and sideways and in a narrow range. My suggestion then was do not trade. Luckily, today is a very different day. We have gone through a deep correction and that is probably behind us. So I would be a buyer today. Now, when to buy is a question of tactics. Each trader may have a different view or a method, but you could buy on an early morning dip. You could buy partly on a gap up, even if it's a gap up, and then add to your positions. Also remember that if you are taking this week's options, the options will expire on Wednesday, not Thursday. So you have only 3 days of risk and the markets could do nice things. So be a buyer today.
All right, buy the dip. That's the call from Sudarshan. Got it. Gentlemen, good morning to both of you. Mitesh, what about you? What would your approach be today?
Good morning. So, I think on Friday we highlighted 23,900, 870 as the probable support area. We got a low of around 23,850. I think this is a zone where, important support levels kick in. And as long as we are not breaking below that, I think this could be a market which could do 24,500 on the upside as a range and 23,850, 900 on the downside. So I think we are in for some consolidation in the next few days. But with what Sudarshan said, I think it's important to note that around these levels, today could be a day to buy because you're now trading at the lower end of the range. So this could be a good level to buy. But I would be slightly nimble given the fact that I'm expecting some consolidation. I think if you get profits on a 1-2 day kind of a basis, be fast to book them at least 50% and around 24,500. I think exit and then wait if there is a chance of breaking beyond that. So for the timing, I think there's a consolidation going on, but purely from a today's point of view, I'll be on the downside.
Okay. All right. Got that. What about individual stocks? What are you trading today, Mitesh?
I have all buy calls. SBI Life is a buy with a stop below 1680 for targets of 1740. Adani Ports has come down to support areas, so buy here with a stop below 1172 for targets of 1245. Similarly, a buy on Power Finance Corporation with a stop at 407 for a target of 430. And Emphasis is a buy. Keep a stop at 2515. Look for targets of 2590.
Sudarshan, what about you? What would you trade?
Well, I have 3 buy calls and 1 intraday short. And the short is mainly to temper the optimism. Markets can do anything. So the short is IGL, Indraprasth Gas, and we know what is happening there in that sector. It's an intraday short with a stop above 183. Reliance comes in my buy list after a long time. Reliance is a buy, and as usual, once Reliance is a buy, it's not just an intraday trade, it's also a positional buy. So Reliance is a positional buy, intraday buy with a stop under 1282. Grasim is another stock, it's coming in the same group, positional intraday buy with a stop under 2675. And the third one is Chambal Fertilizers, which is making new highs in this market. Again, it's an intraday buy and a positional buy. So there are 3 positional buying opportunities. Chambal is a buy to stop under 660.
All right, gentlemen, thank you very much, both of you, for joining in with those specific trading ideas. What we'll do is we'll, of course, come back to you at about 9:10 with new calls. Pre-open is about 4 minutes out. We're going to come back with the management of Dr. Lal Path Labs on their 4th quarter earnings. Stay tuned.
Welcome back. Lots of other stocks to go over and earnings to go over as well. Prakash, let me ask you about Shriram Finance. Let's pull up the stock. I mean, Shriram ended down quite sharply on Friday itself. The numbers that were trickling in just as the market was closing out And it seems this rise in credit cost and the whole asset quality issue that's not going down too well with the market. But your thoughts on what you made of the numbers?
So the numbers have not been very encouraging, not the best set that you would expect from Shriram. But look at this in comparison to a lot of the other NBFCs. I mean, you may have a Poonawalla that's shown AUM growth, but it's at the cost of probably quality or even margins. You look at M&M, definitely disappointing. So I think the NBFCs are still facing the heat in terms of cost of funds. Whereas it's the banks that have actually gone ahead and taken advantage of the softness that they enjoy in terms of CASA and whatever. So I was very impressed by DCB numbers. Of course, it's a very small bank, doesn't really move the needle much for most portfolios. But, NIMs at NII is at 20% kind of growth from a last year basis, or even from that perspective, the credit quality improvements. These are distinct changes that are happening. So I would still stick with the banks, Subi. I don't think NBFCs yet have a place under the sun, as long as the banks are offering you a much better proposition from the next couple of quarters perspective.
Absolutely. And just a reminder, the stock closed off 8%. Shriram Finance on Friday. Pre-open rates will hit us in the next 1 or 2 minutes. Let's see. But brokerages have really downgraded estimates across the board.
Absolutely. And but stock's done phenomenally well. I think second largest NBFC still. I think, and of course, Chola, Shriram both reporting numbers back to back on Friday, and we have the managements back to back this morning as well. 9:40 and 9:50 is what you will hear from both companies in terms of guidance, etc. Dr. Lal, PathLabs is the company that we want to focus on. Fourth quarter numbers in focus. We have. We'll talk about the environment and, of course, Swasth Fit, which is such a big focus area, bundle testing, basically. We have Shankar Banerjee, CEO of the company, now joining in. Mr. Banerjee, good morning. Good to have you with us here. Prashant, this side. Could you, so we have a kind of guidance for FY26 as well. So could you just sort of break that up for our viewers? It's only slightly better than what you've actually ended up FY25 with on the top line front. Is it still all going to be volume-led? How is pricing environment looking?
Right. I think the guidance we are giving is slightly better than what we did this year. So maybe 11% around or slightly better than that. You see, we've mentioned this before. Volume can be measured in terms of patient visits as well as sample growth. So even in this quarter and for the full year, our sample volume growth has been about 9.5%, whereas our overall top line has been at a 10.5%. So it is a lot of volume driven growth because we hadn't taken any price increases in the previous financial year. Going forward also, the focus would be to see how we can keep, the sample volume growth high. And we are also working on to improve the patient visit numbers. So yeah, the focus on volume will remain.
All right. Hi, Mr. Banerjee. Good morning and good to see you. And you all have also been talking about focuses on tier 3 cities, right? If you could tell us where do you see this number headed, what is the focal point out there? And what is the difference if you compare tier 1 with tier 3? What is the pricing difference between the two?
So tier 3 cities for us is an ongoing, expansion project. And even, this financial year or the year that went by, we've grown at mid-teens kind of numbers in the tier 3 plus. Our focus in the tier 3, tier 4 cities is primarily in our core geographies of north and east. And, pricing isn't so different. Pricing is more or less same for the given geography. So the urban, semi-urban and the tier 3, tier 4 in a given compact geography, we would operate at similar pricing. So we don't really have any serious pricing differential between, the tier of cities.
Mr. Banerjee, what about margins? FY25 margins at slightly over 28%.
Yeah.
What can we expect in 26?
So 26, we are guiding around 27%. We would like to be investing, into new infrastructure. So we've opened 18 new labs last financial year, and we are looking to open again 15 to 20 new labs in this financial year. Also looking at strengthening our field force, spending on technology. So there are a lot of other investments that we intend to do. So we would be looking at about 27% kind of EBITDA margins.
Which will translate into an EBITDA per patient of roughly around 240, 250, because that was the pleasant surprise that we saw in the past quarter. The street was at roughly around 230. You came in at around 249, I think, or thereabouts. So that should be the rough number.
We really don't, track the EBITDA per patient kind of a number.
Got it.
I think, yeah, overall, I mean, that's a derived number which one can look at, but that's not a metric.
We'll focus on the margins then. We'll focus on the margins, Mr. Banerjee. All right.
Yeah.
Let's focus on the other big aspect. You're sitting on a good amount of cash in your books, close to 1,100 crores odd. And you all have mentioned in the past, inorganic growth is something that you will look at. Have you all zeroed down on anything? Something we could hear in the next couple of quarters? Maybe the geography, maybe the expertise or the area of specialization? If you could give us a sneak peek.
Yeah, so using M&A as a tool to expand our geographic reach, specifically in the markets of South, where we are relatively weak in terms of presence, and also maybe parts of West. So we continue to look for opportunities which can give us a platform on which we can then maybe grow the business. So that's something which we are continually looking at. And the cash on books is primarily there to help close any deal as and when that is ready. As of now, there isn't anything that we can report right now, but the discussions or the search and internal discussions on that continue, and we are hopeful that there should be something which we should be able to come up with.
This, and what about, could it be in tier 3, since that has been the focal point? I think it's around 35% of your mix as of now. You could correct me on the tier 3 exposure. And the inorganic growth could be in that direction?
So tier 3 is a lot in our core geographies. So tier 3, tier 4 expansion is actually in our core geographies of North and East. Okay. However, for our M&A opportunity, we would like to build our access in some of our underrepresented markets with low brand strength, specifically in markets in South, maybe parts of West. So it is unlikely to be tier 3, but we don't foreclose any options. But the focus would still be on South and West when we are looking at M&A kind of opportunities.
Final question before we let you go, Swashvit. That's around 26% of the mix. You all have indicated in the past that will scale up a little bit, 30-40%. For this year, what kind of a number should we work with, and by when do you get to your goal?
So this year we've closed not at 26%. We are done at the quarter was about 25%, but if you look annualized, we did about 24%. 24%. Swashvit contribution. And, every year the contribution is increasing by about 2 percentage points or 2.5 percentage points. We would like to see that trajectory, and there are still, geographies and, town classes where we can penetrate further. So we believe, and even I think the market is seeing a lot of appetite for bundle testing. So we believe that even this financial year, we should be able to keep that trajectory going.
Mr. Banerjee, we wish you all the best of luck. Thank you very much for F526 and beyond as you and your team continue to execute. Thank you. So that's Dr. Lal with focus on the business and some numbers, few forward-looking numbers as well. We've seen the worst of the Trump tariff dip. That's essentially the word which came in from Ramdev Agarwal of Motilal Oswal Financial Services. We spoke with him on the sidelines, of course, of the numbers that they reported for the fourth quarter. So just want to play out a quick snippet of that bite. Focus on markets. Listen.
I think we are just about getting over this Trump tariff risk, which was kind of hogging the limelights in last 1 month or so. So that portion is, my sense is that we have seen the worst of that, globally also and locally also. So I don't think market is going to be scared second time out of the tariffs. You can't take the global markets or local markets lower than whatever we have seen in last 1 month because of tariff. Now this new issue of Indo-Pak has come up, this Pahalgam, which is very serious, and one will remain cautious because this brings a very different kind of India localized kind of a risk factor, and how things will move, we have to be at the guard and be cautious on that. I think India is standing out as a shining star in the global framework, in the sense that I was meeting few FIs. They are saying that they're underweight America, they're underweight China. So I said, where is overweight? So they said Europe and India. So I think India is standing out very clearly. And if you see the last 10-15 days flow, that clearly shows that which way the wind is blowing as far as FI's attitude is concerned. But let's see. I think in this year, 25-26 will be Indian markets for FIIs. They'll come big time. But things are peaceful because now credit flow is coming. The tax benefits are going to flow in. The regulators are talking about growth. So I think everything is positive for this thing. And in this kind of environment, and particularly it's a corrected market. I mean, 25-26 at index level, it's just about 6-7% up. So we have a fully corrected market. 25-26 should be more like 18-20% kind of thing.
Okay, that was Mr. Ramdev Agrawal on the market and the way forward. Back to our technical experts for the 9-10 calls. Sudarshan, what stock would you go with?
Well, Chambal Fertilizers, consider buying Chambal Fertilizers with a stop under 660.
Chambal, okay, got that. And Mitesh, what's your stock?
Buy on SBI Life for targets of 1740.
Just one, SBI Life is that name. Of course, numbers were super strong and the stock was higher, and then as the market was correcting, it came off because of the market, but otherwise it was very strong. Mitesh, you know, the big winner of last week were technology and IT stocks. Tata Elxsi was up 14%, Coforge was up 12%, Tech Mahindra 12%, Emphasis 12%. Anything stands out for you?
I think two strong stocks, which appear very interesting to me are HCL Tech, which I would recommend buying with the stock below levels of 1530. For a target of around 1620, possibly even 1670. And Tata Elxsi, you already mentioned that. I think that's another stock with a big reversal. And then on Friday, it gave a strong pullback, giving you a good risk-reward entry equation from here. I would look at a target of around 5900 over here and recommend a buy with a 100-point kind of stock.
Just two more names. Vari was up 15% last week. I mean, enough price history for a call here. And Blue Star sold off 14% last week.
Why I'm not tracking Prashant also is the fact that the price history is also well limited. Blue Star is something, yes, on my radar, and it is some kind of breakdown which has happened on the weekly charts. Though I think there's a monthly pivot around these levels of 1690, 1660. If it starts breaking below that, I think the stock can go into a big correction and even look at a period kind of a target. So keep 1660 in mind, 1660, 1690 zone in mind, and as long as the stock is above that, hold on to it, but I think that should be a trading stop loss. A reversal would only happen if the stock starts getting past 1850.
Okay. All right, got it. Gentlemen, thank you very much for that. It's about 9:11. Markets consolidating. By the way, along with Shriram Finance, also watch out for L&T Finance today. Both of these stocks are down after numbers. On to Sudarshan then. M&M and SML Isuzu. So the SML shares in pre-open are down 5%. That's because of the open offer price, lower than current market price?
That's correct. So as far as M&M is concerned, it's a good deal for SML because open offer is going to be made at a price which is at a discount of almost 12% to Friday's closing price. Open offer to acquire 26% stake by M&M is going to be done at rupees 1,555 per share, and the company is acquiring nearly 59% stake from promoter Sumitomo and Isuzu Motors, that is the public shareholder, total nearly 59% stake at a rupees of 650 per share. Company is expecting to complete the deal by December end, and it's an all-cash deal. And the objective of M&M to acquire this SML Isuzu is to expand its truck and bus segment, and in the capacity of more than 3.5 ton commercial vehicle. Currently, its market share is 3%. It's looking to expand to 6% post the acquisition, and by FY36, it's looking to increase the market share in the range of 20-20%. So overall, it's very positive for M&M, but as far as SML is concerned, in pre-opening move, it's indicating that it's not a great deal for SML Isuzu.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Rima. She's here to tell us about Oracle. Rima?
Well, three reasons why Oracle in pre-open is higher. One, Big margin and profit beat. While the top line of the company was flat, margins expanded by 300 basis points to 44.6% and profits were up 18 to 19%. So that's reason number one. Secondly, the stock has already tumbled 32% down on a year-to-date basis. And the third reason is the company has declared an interim dividend of 265 rupees per share, which is the highest dividend declared by them in the last 10 years. Back to you.
All right. Okay, that's Oracle coming through at this point in time. You know, I just want to quickly take a look at, there's about 2 minutes to go for the market open. Maybe we can look at these microfinance companies as well. You know, the news flow out of Tamil Nadu once again, perhaps will have an impact. Maybe look at Credit Access, Ujjivan Small Finance Bank, and others as well, and just see if there is any impact at all. Credit Access perhaps will nothing at all actually this morning in terms of the MFI stocks. Or okay, 4% lower on Credit Access in the pre-open. So there is something, of course, that's a big one which always is in focus for one reason or the other, industry or company-specific news flow. But help from Tamil Nadu government in terms of a draft which is being proposed to you know, protect borrowers against coercive kind of recovery processes from lenders. So that's the news flow, and I think we saw something similar in Karnataka, and we are now starting to hear of this in Tamil Nadu as well. So what do we have? The first rates as they start to come up, it's going to be very, very stock specific because there is enough and more to move names. And we will sort of course track what comes up there as we go along. The open on the indices as the pre-open has left us is kind of mixed. Small cap is down, Nifty is up, Nifty Bank is flat. So what do we have? It is 24,088 on the Nifty, about 0.12, 0.1%, so nothing on it at all. The Nifty Bank is again got nothing on it, 54,624 or so. So just blinking red and green. The Nifty is now picking up a little bit, about 0.25% higher. We've got the mid-cap index up about 0.25%. I think the small-cap index is absolutely flat to begin this session. 640 stocks are higher, about 1,000 stocks are lower, but this is the very first, minute of the market open. Heat map, perhaps, if we have it, just quickly gives you a view of how things are looking. It's mostly in the green, but you got about 14, 15 names which are in the red. Reliance is at the bottom of the screen. There's a 2% pop. Surabhi.
Yeah, Reliance was up and about, but look at Shriram Finance, another 8% down after an 8% tumble on Friday. These large NBFCs, it's a rare disappointment of such magnitude. Remember, credit cost is much higher than the street estimated. There's pressure on margins, and there seems to be a bit of an NPA concern building up as well. So that's the big result casualty. But out of the Nifty, the other major one is L&T Finance. Don't take your eye off on that because L&T also started 8% down on L&T Finance, 8% down on Shriram Finance. Same situation with L&T as well. There's pressure on margins, and the gross NPAs have inched up slightly, and the street just doesn't want to have any of it. So there are your result disappointments for the morning. But otherwise, the market's holding up. So let's go back to the green side. Reliance is still in leadership position, 1.5% up on the stock. M&M is reacting well to the news of the purchase of SML Isuzu, 1% higher. Actually, since I'm talking about the deal, let me check SML as well. SML is down 9%, is very quickly correcting that arbitrage. Remember, Sud just told us the closing on Friday was 12% higher than where the open offer price is. Open offer is coming in at 1,555 crores, roughly 54 crores, 55 crores. So it's very quickly correcting that arbitrage. Anyway, other large stocks that are moving higher, Dr. Reddy's, Eternal, IndusInd Bank, BEL, these are your other gainers, SBI and Axis Bank. The banks are looking good. SBI Life is continuing its good form from last week as well, 0.5% higher. There's some gain on names like Hindalco as well, L&T. So otherwise, the Nifty is fine. And lots of other large cap stocks making up for the disappointment. But these are the names that are on the downside. HCL Tech is slightly lower, 1.5% down. Today is a day of big headline stock moves, really. Nifty otherwise is fine. 100 points up to begin with. Nigel.
All right, few stocks that are on the radar. RK Forgings, they've uncovered some discrepancies in inventory that could dent the company's net worth by around 4 to around 5%. So RK Forgings actually is a stock that's got a hard knock this morning. I think the stock should come up for you on the screen. Tejas Networks, that's the other one that's losing out in trade. There were a couple of one-offs in those numbers, mind you. But for the time being, the street has just looked at the absolute margin number, and that's the reason why that stock is down closer around 10%, though it's recovered in the last few minutes from the low point of the day. Pull up Ramkrishna Forgings. I think that as well should come up for you on the screen because of those, those discrepancies in the inventory. Motilal Oswal continues to see some selling. Remember, Friday's trading session, it came out with its set of numbers, but the stock was under pressure. Mr. Ramdeo did clarify on that, but for the time being, another 4% lower. Industars, that's a stock that's opened up higher because they'll be considering, a buyback at their board meeting on April 30th. So on the back of that, that stock is doing well. Stocks that are really doing well from the banking pack, DCB Bank and RBL Bank, both of them flying away in today's trading session. So the start is pretty okay for the Nifty. You have SML Isuzu. Those that were buying for the deal, they seem not too happy about the deal because the pricing is something that's hurt. And, Mahindra got a good deal. But for shareholders of SML Isuzu, not too great. Stock down 10%.
The stock had already rallied this year. Yeah. SML, in anticipation of this deal and how many suitors are quoting it, is up 20% in 2025 when the Nifty is absolutely flat. So it's perhaps in the price. And then this is a formula-based thing with the open offer pricing. And I guess that final formula price, now the stock's very quickly moving towards that, which is 15.54.
RK Forging, I mean, I don't know if you've put up the
I just mentioned.
Okay. So the stock maybe. So that there's a release which has been, and I think there's a call at 11 o'clock as well. So there is an inventory mismatch which has been reported. A release to the exchanges says that the promoters will make good the difference by permissible instruments, etc. So keep an eye out on this one. I mean, it just came to my notice because last week it was a top loser. One of the top losers, when I looked at the NSE 500 list, it was down about 12%. Friday to Friday, this morning is down about 5%. And now we've got some clarification coming through as well on RK Forging. All right, well, what else do we have? Dixon is up 2.5%. It's got... is it that Apple news flow? Although Dixon doesn't work with Apple, but it's got the entire Android ecosystem on it. Indus Tower about 2.5 higher. Blue Star, I was talking about this with Mitesh earlier. Blue Star lost 14% last week. It's coming up with about 3.5% pop. There is Kalyan Jewelers, which is up about 2.25%. Actually, almost 3% on Kalyan Jewelers this morning. There is Kim's, the hospital company, which is up 4.5%. 704 on that one. Torrent Pharma is up 2%. PG Electroplast is up about 2.5%. And so it goes. But volumes are, I mean, limited. If you just sort of go beyond the first 10, 12 names, as is the case most of the times. But it's all, Shriram Finance and IDFC First is down about 2.25% as well. Chola Finance is down 3%. Poonawalla FinCorp is down 3%. Lal Path Labs, we just spoke with the company, is down about 4% as well this morning. So, that's the overall picture. Market breadth is flipping a little bit on the downside. So keep an eye. 1,400 stocks down, about 850 stocks which are higher. Pratik Gupta is with us, CEO and co-head at Kotak Institutional Equities. Pratik, good morning. Good to have you with us here. As of last Friday's close, Nifty is India's the best performing large Asian market from the Trump Liberation Day tariff announcements from the close of 2nd of April. We've crept back into the positive territory, YTD. We just played out sound bites of Ramdev Agarwal, who was telling us that in his interaction with foreigners, what he's hearing is that, global mutual funds, foreign investors, etc., are underweight the US and the positive Europe and India. I mean, that's the feedback that he got. What are you picking up just in terms of foreign investor sentiment and from a flows perspective? Because last 8 days, there's some 32,000 crores worth of foreign money which was coming.
Good morning, Prashant. Yes, I would agree with that assessment broadly that foreigners are definitely, especially the non-US investors, the Europeans in particular, for example, they're looking at India or looking to firstly get out of the US, trim their holdings in the US, and some of that money is finding its way back into markets like India. And even globally from the US, we are seeing some increasing interest from asset allocators to investing in emerging market funds. The number of inquiries has gone up. The passive funds have seen big flows coming into EMs, and India is benefiting as a part of that. Within that, when we speak to our clients globally, we are seeing that a lot of folks were seeing India as sort of the least bad emerging market, meaning that there were issues with other markets, especially China in particular, where despite the cheaper valuations over there, a lot of folks are still worried about the long-term implications of the trade war. Even before the trade war, China was going through a pretty severe slowdown. And now you have the trade war, and who knows how that thing pans out. So despite the cheaper valuations in China and despite the somewhat more expensive valuations in India, we had been through a bit of a market correction in February and even in March. So we had started seeing some interest coming back in. So to that extent, yes, we are an expensive market, but just given the lack of better alternatives, we were beginning to see some money coming back into India. Now, the one change which has happened last week is obviously this terrorist attack in Kashmir, and we don't know how that pans out, how badly it escalates. So that's something which is, I think, once again going to be a little bit of a fly in the ointment for the short term. But I think fundamentally we are moving in the right direction.
Pratik, hi, morning. Good to have you on the show today. So if you're saying we're fundamentally moving in the right direction, if you could sort of give some further indication on that. If we leave aside the tariff issue, for an instance, leave aside what's happening on the security situation, let's just talk earnings, right? Because that's the bread and butter of any market. There, we still hear of several concerns. And I mean, look at the accidents this morning. I mean, NBFC is showing up some asset quality issues here and there. On earnings, what are you penciling in? Because the big worry is that we're not out of the woods as yet, and whether we are going to be seeing more downgrades for FY26 as the year progresses.
So, Surbhi, yes, on the earnings front, we've anyway been conservative for quite some time. And we have, even right now, I believe our estimates would be below the street estimates. At Kotak, we're penciling in about 12% earnings growth in FY26, followed by another 14% in FY27. And you're right, I think we are likely to see more earnings cuts. So maybe that 12% becomes, we end up being 9 or 10%, which would be in line with the nominal GDP growth. But I think what I meant where things are improving is things like, for example, the RBI is becoming a lot more, I guess, they're cutting interest rates given the decline in the inflation level. Liquidity is improving quite dramatically, and RBI is committed to providing more liquidity. The stance has moved to accommodative. And even from a regulatory perspective, RBI is becoming a lot more sort of business friendly and removing some of the onerous regulations. LCR, for example, has been pushed back and diluted. So one is the RBI stance. Second, I would say we've seen about almost a year of government capex being somewhat slow. And you've had a change at the helm in the finance ministry, 4 new secretaries coming in over there. So we think once again, the capex, the government capex cycle, which was anyway sort of picking up, will get a fresh, with these fresh faces at the helm. I think you'll start seeing that being pushed through more aggressively. On the currency front and trade war front, Scott Bessent, the US Treasury Secretary, said last week that India and the US are quite close to signing a trade deal. Now, we remain skeptical as to what will be the contours of this trade deal, given that farm products or even 100% retail, 100% FTA and retail is going to be quite difficult for India to agree to. But nonetheless, if they manage to work out something, that would be a pretty big positive. And then not to mention things like a normal monsoon, which should help. And so the point about earnings remains, and which is why we are not bullish on the market, but neither are we saying that we are in an extremely expensive zone. What's keeping us cautious right now is still the valuations. 10 days, 15 days back, we were beginning to get into slightly attractive territory. And the way the rally has happened in the last 10 days, again, we've become sort of more towards the expensive side once again. So again, we're back to being somewhat cautious again.
Okay, all right. Hi, Pratik. Good to hear your thoughts. As always, a little bit cautious with a hint of optimism on select spaces. Let's talk about the changes that you've made, in your portfolio. Reliance Industries, that's one of the key reasons that we're holding in the green this morning. And the stock actually had seen a big correction of close to around 20%, and it wasn't holding one end up for the Nifty. But in the last couple of weeks, in fact, it's found its form. You'll have gone ahead and increased your weight out there. Give us the rationale.
So I think the main reason for Reliance has been the improvement in the performance of its retail business, where some store rationalization and pickup in the retail revenues that's really helped a lot. And not to mention the telecom business is doing well, potential for tariff hikes later this year. And also in the context of the overall market, where we think there will once again be a flight towards large caps. The small mid caps are no longer as attractive as they were perhaps 1-2 years back. So in that context, and also given the decline in global crude oil prices, that also helps. So with all of those considered, plus the strength in the retail business, the outlook for the retail business and the telecom business, given that the core petchem business is chugging along quite well, from a valuation perspective, Reliance is beginning to look attractive compared to the other options you have in the market, say in the consumer discretionary or consumer staples, or even IT services, where the stocks have come off, but there's a pretty sharp earnings downgrades happening over there. So in that context, that's the part of the reason for Reliance is again amongst the least bad alternatives out there within a model portfolio.
That's the problem, right, Prateek? I mean, just to go back to what you said, 10% move and suddenly you're worrying about valuations because there's no help from earnings coming through. If there was a bit of lift from earnings, then you kind of sort of can, it gives you leeway. You can imagine higher multiples, etc., but that is just not there as of now. Do you think it'll be a second half story? It's possible. What's your sense? The RBI is not holding back in terms of helping on liquidity, etc. Maybe you need something, those tax cuts, etc., perhaps will start to come in from May, the impact of it at the margin. I don't know how much though, but can it be a H2 story, earnings?
Prashant, yes, that's what we are banking on. We think it will be a second half story, not just one is obviously earnings. By then, hopefully, the worst of the earnings cuts would have been, we'll probably have a weak March quarter, possibly a weak June quarter as well. And September, December onwards, we start improving on a Q-on-Q basis and on a YOY basis. Projections are for a normal monsoon, so that should help as well. By then, I think the impact of the RBI rate cuts, the better liquidity environment, a more stable rupee, all of these things, and a lower oil price, lower commodity input prices for a lot of the companies, all that will start feeding in. The problem right now is we have a very, very weak demand environment, which has been continuing for the last 2-3 quarters. And as I said earlier on, with the weaker, the lower interest rate environment in India, plus hopefully you'll start seeing government capex picking up more steam, both central government and state capex picking up more steam by second half FY26. All of these things should hopefully start improving the overall earnings trajectory. And the markets, yes, you're right. We're once again back to almost 21 times FY26 earnings. Again, trading at almost a 95% premium to China, for example, to the MSCI EM index. So again, we're back in expensive territory. Most investors globally are sort of frustrated that they missed the boat in the last 2-3 weeks, just when they were sort of getting ready to deploy more capital. A little bit of money comes in, the market just runs away. So a little bit, again, back in the sort of neutral to cautious zone again.
Yeah, all right. Thanks a lot, Prateek, for joining in. Good to hear your thoughts as always. Rational as always. Preferring the large caps. The markets may not be out of the woods and maybe earnings could disappoint on the downside, but optimistic about the second half of the year. Let's get straight to our next management on the show. We have Tata Technologies. The revenue came in a little weaker than expected. EBITDA margins as well did see some bit of improvement. We have with us Mr. Warren Harris, the Managing Director and CEO at Tata Technologies. Hi, Warren. Good morning, and thanks a lot for joining in. Well, how do you see things panning out? The first half of the year could have its share of uncertainties because the globe itself is a bit of a flux. The ER&D space has been having its own challenges. So what are you penciling in terms of the first half of the year? And are you expecting a recovery in the second half?
Yeah, well, we expected about a month ago. We expected a very strong start to the fiscal year. I think the tariff uncertainty has certainly undermined that, and the current visibility that we have is that the first quarter is likely to be soft. But our optimism in terms of the full year is really informed by the fact that a lot of investment decisions were delayed last year. You know, if you look at the United States, there was a lot of uncertainty in terms of who was going to be in the White House. We've seen a lot of regulatory change and incentives for EVs run off in Europe. We expected that situation to be clarified. We were engaged in a lot of really encouraging discussions with our customers leading up to the end of the fiscal year, and we had a lot of optimism. But you know, clearly the tariff situation has confused that, and we're hoping that will provide some we'll get some sort of understanding of how that's going to pull through in the next month or so.
All right, Warren, request you to stay with us. For the time being, we're just hopping across here. Dr. Anish Shah, post Mahindra & Mahindra acquiring stake in SML Isuzu. Let's go there and we go back to Warren.
It was under the scanner of capital allocation 5 years ago, and a business we decided we had a lot of strengths we could turn around. It has done very well over the last 5 years, in line and slightly higher than our expectations as well. We've got a very strong team now and a good product portfolio. Rajesh will talk about the details of the business, and then we'll have Vinod up here as well to answer questions that you may have. But this is a business that we really like and we feel can do a lot, and which is where we got the opportunity of an acquisition which we feel will position us very well, an acquisition which we feel is an appealing one and a very strong strategic fit. So with that, let me invite Rajesh to come up and talk about some of these details.
Thanks, Anish. So we've just announced on Friday evening, as you know, the acquisition opportunity of SML Isuzu, as it's called. We're looking at buying 59% stake of SML at 650 rupees per share. Sorry, the 59% stake includes a stake from Sumitomo and Isuzu both. There will be an open offer that gets triggered based on the regulation, and that will be for up to another 26%. And
we'll cut back, and hear out what Rajesh as well as what Dr. Shah have to say. We'll keep getting you snippets, and keep an eye out on the bottom of your screen. All the most important flashes will be out there. Warren, thanks a lot for waiting by. As you were telling us, the global environment is still a little bit uncertain. But what are you penciling in for the year? I was looking at a JP Morgan note. They are factoring in, single-digit revenue growth with margins staying more or less flattish. Would that be a little bit conservative? Are you optimistic if things recover, you can do better than what they're estimating?
Again, I think a lot will very much depend upon the macroeconomic environment, and again, specifically whether or not we get the type of clarity that I think the markets are looking for in and around tariffs. If we get that, and we get that within the first quarter, I would be very bullish that we can do better than single-digit growth as far as this fiscal year is concerned. Again, a lot of our customers have built up a need to invest over the last 12 to 18 months. And as soon as there's clarity, we believe a lot of that will be discharged, which will provide tailwinds for organizations like ourselves.
An outside chance you even give double-digit revenue growth?
Well, I think we're certainly planning for that. And certainly at the beginning of the year, we were optimistic that that would be the sort of North Star of the achievement that we were looking for. But again, we've got to be very cognizant of the macroeconomic environment and adjust our expectations accordingly.
Warren, hi, good morning. Prashant here. It's a very uncertain world, isn't it? As you began by saying, I mean, companies don't know where they should build. I mean, that's the basic starting point, whether they should move, not move. So in that sense, I mean, I guess investment decisions take a bit of a backseat. JLR, for example, is an anchor customer for you, about 15% of revenues.
Yeah.
Is this, what can you do? I mean, this environment, say, for example, if it stretches through for the next many quarters till the end of the year. For example, I mean, India is said to be the first in line for a deal, and that is only sometime in the fall. when we start to see the outlines of a deal.
Yeah.
So if this uncertainty stretches for the next 2 quarters, what can Tata Tech do internally to mitigate some of the impact, especially on operational efficiency, etc.?
Well, I think you make a very good point, Prashant, about the need for clarity as far as investments are concerned. But I think one of the things that I would say is that the business that we are in, the manufacturing sectors that we are in, they're essentially product-led sectors. And so the automotive industry, for instance, if you're not making investment decisions today, you're compromising or mortgaging your future in 2 to 3 years' time. And a lot of investment has been put on hold in the last 12 to 18 months. And there's a lot of latent demand to deploy that investment and make decisions on products. I think different markets will play out in different ways. We're seeing India being somewhat immune from the tariff play, particularly those manufacturing companies that are focused almost exclusively upon the Indian market. I think Europe is making decisions in terms of interjecting resilience into their supply chain and standing in a position that's less dependent upon the United States, for instance, and the US is very much committed to the repatriation of manufacturing. And so our approach to those markets are going to be calibrated in the context of the specific opportunity that we see. So we're having to be agile, but at the same time, we're hoping for some of the volatility that we've seen in the recent past to settle down.
All right, final word from you, Warren, before we let you go. Since growth is going to be a little bit uncertain, what about on the margin parameter? You've been holding around this 18.5% odd mark. You want to give us a range?
Well, I think our priority, first and foremost, will be to continue to protect margins. I think we've demonstrated our ability to do that in FY25. I think you've seen also in the fourth quarter the flow through of the contribution of the joint venture that we have with BMW. So net profit and earnings per share has significantly improved. And again, our priority in the first part of the year will be to protect margins. But if we see growth coming through, and we're still confident that will happen, then we will certainly look to improve upon the margins in which we finish the year.
Warren, great speaking with you. Thank you very much. We wish you all the best of luck in this tough, uncertain macro environment. But as you said, a lot of the pending investment decisions also means latent demand when things clear up a little bit. By the way, the market here in India is continuing to chug along very nicely. I think we're at the day's highest point, 24,200. We're up 0.7% at this stage. So some big movers there coming through in a bit from now as well. Cholamandalam Investment Finance is the next company which is on radar. Reported a strong set for the fourth quarter. We have Arul Selvan, President and Chief Financial Officer of the company, to take us through some questions. Sir, good morning. Great to have you with us here. Prashant this side. And a good set. But although I want to start with something slightly on the negative side, which is credit costs, which remain high at about 1.4% in a seasonally strong quarter. Could you give us a sense of what you saw and what we should expect in FY26, sir?
Sure. See, the credit cost had not reduced to the extent it would have reduced in any given Q4, as if you see last year Q3 versus Q4, across products, including vehicle finance. So to that extent, there had been a little bit of a higher cost. Apart from that, what we have also done is the business on fintech, which we have been exiting, we created a certain one-time provision, because as we move down and reduce the exposure there, you will have certain hits on the balance portfolio, which is running down. So to that extent, we created incremental provisions. Both these put together has kept the credit cost little elevated. FY26, we should see around 15 to 20 basis points credit cost on a full year basis as compared to current year. That's what we are targeting as we move into FY26.
Has Mr. Selvan, has stress generally sort of increasing? Is it what is your sense? Also, talk to us a little bit about growth. I mean, AUM growth, I think, has slowed down a little bit if you look at on a quarter-on-quarter basis, especially newer segments, etc. So what's happening?
So AUM growth in the traditional products continue to be better, especially in the mortgage businesses. In vehicle finance, it has been a little muted considering the slowdown in the auto. But we are moving into other products like used and two-wheeler to keep the vehicle finance AUM, chugging along. New products, yes, there has been a bit of a reshuffle as when we reduce the fintech exposure, we have consciously brought down the exposure there, but that would be compensated by our foray into consumer durables, which we have started. We have been doing Samsung Mobile earlier. Apart from that, we have now started other products also. So that would start picking up to make the new product disbursements and the AUM growth bring back to its old levels. However, overall, unsecured, we are holding our target at around 10% of the overall portfolio, so that would not breach that number. But other products will continue to grow.
So 10% is the capping you are putting at, putting for unsecured loans.
Yes.
And overall growth has been really solid, sir. I'm looking at the AUM growth. I mean, you're up almost 27% year on year, 6% quarter on quarter. All segments have done well. But talk to us about your gold plans, because the gold market is where there's a lot of competition. NBFC is fighting to retain their turfs. Banks have been aggressive. The RBI is changing regulation. What are your plans on the gold financing side?
No, like any other product, we would start slow and build it over a period because, as we don't jump in with both legs into the water, we will go slow. We are starting with 100 and odd branches initially. So we are targeting around 1,500 to 2,000 crores in the first year. As we move on and we get comfortable with the product, we will scale it up. As you know, here we cannot leverage the existing branches. We need to create new branches. So we are in the process of creating new branches because the operation structure in the branches are different. So we need to create new branches. We are in the process of doing it. We have already started opening branches across East and South region. But we will move slowly. Sorry.
Sorry, sir. My question was, we were just trying to understand why you're looking at this avenue. Isn't this already a crowded market? Like I said, so many players, ever-changing regulation, fight for turf. I mean, do you feel that your existing large segments like CV financing, etc., do you see a plateau ahead? Is that why you are opening up the gold avenue? And again, as a percentage of the book, like you mentioned, unsecured won't go beyond 10%. Eventually, say 2 years down the line, as a percentage of the book, where would you want gold to stabilize at?
See, it's not that the other products are slowing down and that's where we are going into gold. Our long-range plan is that Chola will be a complete end-to-end lending institution where we will offer products, especially in the secured side. We will have the full exposure built across all products. Gold is a product where you have better security and a better return. As I know, it is crowded, but there our credibility will come into play as a credible player and a well-known name, and the trust of the customers would come into play. We have seen a large amount of vehicle finance borrowers also doing gold loan. So that is what we are wanting to try and tap into to see that whether we could bring those customers into our fold. We will do it slowly. As of now, I would rather not give a number on the gold because if it pans out well, yes, we can scale it up. But if it does not, we will be slow to learn and pick up, and we will pick up and do it. It is highly regulated. As you know, the recent regulations have come in which are actually in a way good because we start with the new regulations and we do not have to go back on what we have done. So that all these augurs well for us to enter at the right moment with the full regulatory framework in place.
All right, Mr. Selva, and do you think that, other listed players like, say, Manappuram and Muthu, they were having, too easy a ride and there's an ample opportunity out there. So you said, let's go take some part of that pie.
I don't want to say anything of that sort. Yes, there are enough and more in a growing economy like India. In India, I would rather say the unorganized segment is still a large, the bottom of the pyramid, as what we used to project. That's a large segment which is moving into organized segment progressively, and that opportunity with a credible name like Chola can be tapped into and grown. And especially in the rural market where we are strong and our name has been well known, we see that this would be a good opportunity for us to tap into.
All right. And so for the first year, it'll be around 1,500 crores is the target. Is that correct?
I would say so, yes.
All right. Let's get a couple of numbers out of the way then. AUM growth for the year, what should it be looking at? And if you could bifurcate it in terms of segments. And also if you could tell us, what about NIMs? You could get some kind of benefit because the cost of borrowing will go down. So how do you see yields as well as NIMs going ahead?
Yeah, on the AUM first, I will answer that we still target the same 20 to 25% growth as we move into FY26 with all the products, with the mix of all the products coming into play. The mortgage business would certainly have a slightly better improvement as we move into these segments into this year. And on the NIM side, yes, we will see improvement because cost of funds would improve, but it will not be a step change immediately because a large part of our borrowing still is relying on the MCLR change of banks. And if MCLR change, then we will see the step change. Otherwise, the marginal borrowings would be the one where we will see the benefit, but certainly you will see NIMs improving. We will have to share some part of this cost of fund reduction on the floating rate products, which are the mortgage products. But we will see the benefit coming through on vehicle finance where the book is of a fixed rate.
Right. Mr. Selvan, just a quick last clarification before we thank you, sir. On credit cost, when Prashant asked you, you did mention that you're looking at maybe 15 to 20 bips. So that's higher. Could you just tell us FY25? What was the credit cost final number and where do you see it in FY26?
See, we closed the year with around 1.3% on assets on the credit cost, and we think we should do it at around 1 point. We'll close at around 1.2 or lower as we move into FY26.
Your credit cost will go down then, you're saying, from 1.3 to 1.2?
Certainly, our target is to keep it below 1.2 and we should try to do that, yes.
Yeah, okay. All right. All right, sir. Thank you very much for joining in for that clarification. Thank you. We'll just correct that flash as well. Now it's completely clear. From 1.3%, the credit cost for Chola will go down to 1.2% this year. So we'll just rework the numbers on the screen there as well. All right. Have to take a very, very quick break on that note. But the discussion with the large lenders continues. Up next, coming up, a conversation with Shriram Finance. Welcome back. As promised, we're continuing a conversation with the earnings analysis for many of the financials. The Shriram Finance stock is still down 8%. And this is after an 8% decline. These numbers, remember, came out just as the market was closing out on Friday. So there's a big slip that's come through. Now, what is the market's concern? There is a large write-off that Shriram did in the quarter gone by. There is some pressure on the margins and some issues around asset quality. So let's clarify all of that and more. We have, of course, our next guest joining in. Thank you, sir, so much for being with us. So, like I said, the market needs a little more clarity on the write-offs that you've taken, your credit cost estimates, and what's really happening with asset quality. So, Mr. Revankar, sir, if you could just start right there. With these write-offs, I mean, the gross NPA level has come down. Are you intending to take more write-offs? And what is the guidance on credit cost? Are you seeing more stress build up?
No, it was a policy decision taken at the board meeting that where we already provided for, we thought for accounts not performing more than 12 months to be written off. So that's a one-off, and I don't think there will be further anything. We just wanted to go forward with those accounts, and the recoveries are still on. It is not that there's no recovery on that. Every quarter we have recovery, and as and when recovery happens, it will become the income part of it.
Sir, can you give some guidance that would help? I mean, what is the kind of recovery, whatever visibility you may have looking at the book right now, say over the next 1 or 2 quarters, and on credit cost as well, I believe it's at 2.42% right now. If you could just clarify, and where do you see this number of 2.42% moving?
See, we have been giving a guidance of around 2% plus or minus 10% on the credit cost, and we are at 2.07 as far as Q4 is concerned, and for the full year it's around 1.92. So we are within the guidance on the credit cost for the whole asset. And going forward also, next couple of quarters, we don't really see any challenges. The market is good, the rural demand is quite good, and the rural economy is also doing well. So we are quite confident the credit cost will be maintained at the present level.
Mr. Revankar, good morning. Prashant here. Good to see you, sir. Is this increase, though, led by some specific geographies? Could you give us a sense of what we've seen? It's one-off, and maybe some recoveries will happen. But the underlying, is it rural is better, but urban seems to be a little slower? Across companies, commentary. I mean, I'm sure you've heard the Maruti management talk about that 2 days back. We just heard from Chola earlier. So give us a sense, what's happening.
No, overall, the economy is doing quite good. I don't really see any pain anywhere. Some geographies, as you rightly put it, central part of India, there were certain challenges in the rural area. That now the rural markets have improved. I don't think there is any further challenge. It is already addressed. The Rabi crop is supposed to be bumper. It will definitely help the rural credit demand and the rural credit quality to improve further. So I don't really see any challenges. The urban is a little slow because the infra spend has been slow by the government for the last full year. I think the infrastructure projects are coming back, and next financial year it should do well. We expect the demand from both urban and rural to go up, and credit quality to remain stable.
Hi, Mr. Revankar. Good morning and good to see you. Ben, let's focus on the gold portfolio. It's a very small part of your business, but we just had a peer who, was just telling us about his foray. Chola's foraying into gold. For you, as a percentage of your book, it's small, but you've seen a degrowth out there. Why is that? And could you tell us what plans you have on this vertical going ahead?
See, the gold AUM has some degrowth, but if you look at the Q4 disbursements, they were higher by 20% Q on Q. So we are back into gold. We will be growing the book in the next financial year, and we will keep growing. We are also adding more branches to the gold network. It requires certain reskilling and re-engineering the process, which we have already done. So here on, we'll keep growing the gold book.
Okay, all right. So then since you briefly spoke about growth, you are guiding for mid-teens growth. So could you tell us segment-wise what kind of growth are you looking at for the year? And particularly, are there signs that the CV growth is petering out a little bit? Or do you believe that, it's pretty much in fine fettle?
We still believe that CV growth is continuous and it will keep continuing to grow. Maybe between 12 to 15%. Last year also we had given the guidance of 12 to 15%. We grew by 14%. This year too, we believe it will grow in similar lines, even though the sales have been flat, year on year have been flat. And it's mainly because the infra spend coming down, bulk material transportation, which is dependent on CV. And whenever there is a slowdown in steel and cement bulk material transportation, the CV demand comes down. However, we still feel there is a shortage of vehicle on the road, and there is a full utilization of vehicle. The repayments on the vehicles are very good. So we continue to believe that demand will come back into CV, and the used vehicle market will grow faster in the next couple of years because the sufficient number of used vehicles are coming into the market now, because the new vehicle sales started 3 years back and it will come into the market. So we believe overall there will be a growth going forward in the CV. Passenger vehicle will grow faster at more than 20%. And of course, MSME gold also will be growing. We will be growing 20% plus. So broadly, I can say that CV and construction equipment will be growing between 10 to 15%. And the MSME, passenger, and gold and two-wheeler will grow at 20% plus for the next.
Overall 15%.
Overall 15%,
Yeah. Mr. Revankar, on margins, what can we expect, sir?
So margin, we have given the guidance of 8.5. We should go back to 8.5. The last quarter's 8.25 was because of higher liquidity which we are carrying. Let's see, we have been looking for raising long-term resources in the international market. We did have raised certain long-term resources, which has a maturity of 7 to 10 years. And since we need to really plan for it, we did raise that money at that time. And that will be utilized in the next quarter. So we will be able to manage our excess liquidity within the control, within the 3 months normally, which we keep. Now it is around 6 months. Next 2 quarters, it should come down to around 8.5 level net interest margin, go up by 8 to 8.5. And we should be able to maintain at 8.5 for the full financial year.
Okay, so margins should recover to 8.5, which is where you were in the third quarter. Q4, it dipped a bit, but you're saying it'll go back to 8.5 and sustain there. Got that point. Sir, on gold loans, just to go back, I mean, you gave us a whole breakup, how you were arriving at the 15% AUM growth expectation for the year. On gold, really, what's going on? We were just discussing this with Mr. Selvan, when one of your peer NBFCs just earlier. They're also getting into gold loans. It's a very exciting market, it seems. But what's the situation on ground? Is there too much competitive intensity? And the RBI obviously is looking at it with hawk-eye. And some sense of the growth. I mean, how do you come back to growth? Will it be Q1, Q2? And for the full year, what do you expect from your gold book?
Now, if you really look at how the gold financing happens, more than 50% of the gold financing, I still believe, is with the pawnbrokers and the unregistered lenders. So there is a huge scope and opportunity because people would like to walk in to nearest place, nearest pawnbroker or jewelry shop for raising money. That's how it happens. So the kind of holding Indians have the gold is one of the highest in the world. So if you are able to plan it well, if you are having a branch network and contact with the customer, then we'll be able to grow the gold. So there is enough scope and opportunity for gold financing. And especially at the time when the gold prices are going up, it's an extremely safe lending opportunity for us. And also to the existing customer of ours. There are many SME customers, two-wheeler customer, any customer for a small requirement, temporary requirement, a working capital requirement, he can go to the nearest office of ours and raise money. So that is the opportunity.
Yeah, and it's a very powerful sort of instrument now with gold prices being where they are at the hands of the borrower, which is why just trying to get an estimate. Full year, what is your AUM target for gold loan growth?
See, we are at around 5,500 crores. We are planning for a growth of 20% plus. We should reach around 7,000 to 7,500 crores in this financial year.
All right, Mr. Revankar, thank you very much, sir. Good speaking with you. Thank you very much for joining us with those details. So 15% growth, credit costs 2% plus minus 0.5%, margins about 8.5%. These are what Sriram is aiming to do as we look ahead into FY26.
You know, interesting because the stock is trading at very juicy valuations, at the start of today and post the 7% downtick as well. If you look at it on the price to book or PE or even the return ratios. But for the timing, 15% frontline name, getting a hit like that, in a couple of trading sessions, it's a little bit worrying.
Hearing him, you wonder whether
15%,
where's such huge concern coming in, because
management sounded confident.
Doesn't sound so concerned.
The entire story of Shriram got re-rated. It was a merger, right? It was Shriram Transport Finance, Shriram City Union.
City Union. Yeah.
Transport Finance was lumpy. City Union was kind of stable.
Smaller business,
but stable.
Stable, yeah.
So that provided stability, and the business started re-rating 2 years back. Otherwise, it always used to be the cheapest, by far the cheapest NBFC.
Indeed.
So I don't know if the market is making too much of it, and it's not, because on Friday it was down, and I think, as you guys said, over the last 2 weeks or so, it's down 13-14%. So it's actually the first hit we've seen in many, many quarters on the asset quality side.
I think on the valuation parameter, if you compare it with Chola, it's trading at 50% discount in comparison to it. So it's trading, I think, at around 1.5, 1.4 times or thereabouts.
All right, well, let's just quickly take a look at what the market is doing. So it was doing very well earlier when we looked at it 15 minutes back. Oh, wow, 188 points on the Nifty. So just shrugging off, some of these worries at the margin and just sort of charging ahead. 24,230 is where the Nifty is at. Is a 200-point pop, which we have. So this is basically a complete reversal of what we saw, almost a complete reversal of the 250-point drop that we saw coming through on Friday. So very, very good going so far. Market breadth is not wildly positive, but 1340 stocks are higher and about 1150 stocks are lower at this stage. And I mean, sectorally, if I just want to take a look at it, so it's oil and gas, defense, and PSUs. That's the bulk of where gains are coming in from. Maybe a pharma, FMCG. I mean, actually, very few things actually down and out. IT is a notable loser. It's the biggest 0.9% cut on the IT index after the bounce that we saw, I guess, last week. Mitesh is with us. Mitesh, what would you do in terms of trades?
Good morning again, Prashant. I think a couple of names, Supreme Industries is one which has caught my attention today in the F&O segment. It's cleared the last few days of pivot of around 35. So keep the stop just below that. Look for target for around 36.75, 36.80 to begin with, and eventually one can look at even higher levels. The other stock which I like is Lupin, which is just at the 200 average. So here I'll give a conditional trade. If it starts getting past 2095, buy with a stop at about 2070 for a target of 2150.
Okay, all right, got it. Thanks, Mitesh, so much for that. We'll take a quick break, come back on the other side. We'll have Manisha Gupta joining in with the latest from the commodity markets. Welcome back. So the markets are cruising along 217 points higher. Mid-caps are also in fine form. Actually, all the key indices, Bank Nifty, Nifty, Mid-cap, everything's up about 0.5%. So it's a good Monday morning, good start to trade. As promised, let's now shift the focus to the commodity markets. We have Manisha joining in with the latest. Manisha, good morning. So what did the weekend bring?
Well, profit taking in metals. So you have gold prices down almost 6% off from its all-time highs, and the metal prices are down by a percentage point in the Asian markets right now. But what seems to be doing better really is the crude oil prices. After that very sharp decline that we saw on Friday when the prices fell by 2%, we have seen some bit of a opportunity buying coming into the markets. Well, the reason for that is that you have China and Politburo meeting over the weekend on stabilized jobs and unemployment insurance funds as well. There also is more conversation continuing, and in retaliation or on reaction to the tariffs, there is an expectation that China would be looking to increase consumption, and we could be looking at some more measures coming in. And then there is an explosion on the weekend at Iran's Bandar Abbas port on Sunday, and that has also added some premium to the prices. Markets also are seeing some support on the back of uncertainty in sense of trade talks in US and China, with an expectation that you could be looking at a step back from both of those countries coming in. US already has said that there are conversations going in, and there have been reports on how US has softened the rhetoric and China has exempted some US imports from 125% tariffs. But that's exactly where the bullish cues for the crude oil prices end. Because come the month of May, you will have OPEC and allies increasing supplies by 411,000 barrels per day. And the expectation is that you could be looking at more barrels being added from the month of June as well. Also, when you look at various statements, we do understand that there is some kind of a disagreement with various OPEC and allies members, Kazakhstan and Iraq especially, saying that they will be adding more barrels. So this disagreement also poses a downside risk when it comes to the crude oil prices. The US dollar index has strengthened. It's off its 3-year highs. You also have US-Iran reporting signing of progress in nuclear talks in this week itself. So those are some of the factors which have led to premium going off in sense of crude oil prices. IMF cutting US growth by to 1.8%, recession odds being added to 40% are some of the other factors also. So when you look at the prices, while we may be 1.5% up on a weekly basis, but in this year until now, we are down by 12% for the crude oil prices. And when you look at the last 12 months, we are down 24% in sense of crude prices. But this is going to be an important week because you have so much data coming every day of this week. Monday, that's today, you have Canadian federal elections. Tuesday, you have consumer confidence numbers coming in. If you look at Wednesday, you have first quarter GDP numbers, employment numbers, pending home sales, and Bank of Japan monetary policy meeting. That's also on Wednesday. Thursday is US weekly jobless claims, and on Friday, you have US non-farm payroll data. So as I said, every single day there is data coming in from the global markets, and that would set course ahead.
All right. Thank you very much. Commodities there in focus, Manisha. Appreciate it. Well, what's the MFI pack doing, the microfinance stocks doing? A news flow coming out of Tamil Nadu, a little disturbing from a lender's point of view. Abhishek, take it away.
Well, it began with Karnataka and now flowing into Tamil Nadu as well. So, as per news report, Tamil Nadu Money Laundering Entities Bill 2025 has been laid down. The key objective over there is to protect economically weaker sections from coercive, practices by money lending entities. So, there are 3 key provisions which have been mentioned over there. 3-year jail term for coercive recoveries. Loan recovery agents can be penalized for harassing borrowers or their family members. Microfinance institutions are prohibited from forcibly collecting dues, and dues to be resolved through district level committees only. So the impact on MFI companies would be that there would be a short-term impact with respect to disruption in their operations and collection efficiency over there. So there can be a dip in collection efficiency as and when this gets implemented. A potential exception would be the MFIs registered and regulated by RBI might be kept out of the bill's ambit. So state-specific impact with reference to the percentage of book or presence over there. Tamil Nadu accounts for significant portion of AUM for microfinance entities like Credac, almost 20%, L&T Finance, around 20% of the rural branch network is in the state of Tamil Nadu. Equita Small Finance Bank has a huge presence in the state of Tamil Nadu as well. Others who have smaller exposure over there, Fusion Microfinance that has about 6 to 7% exposure over there, and Spandaran less than 2 or 3% of their book is in the state of Tamil Nadu. Back to you.
Okay, all right, got that. Abhishek, thank you very much for the details over there. We need to take a quick break. On the other side, we will be chatting with the management of IDFC First Bank, talk about the bank's fourth quarter performance and the outlook ahead.
Okay, we continue with our earnings analysis, and IDFC First Bank is in focus. It reported a weak set of numbers compared to what the market was expecting. Net interest income and profit after tax came in below CNBC-TV18 polls, while FY25 credit cost ratio was above even the company's own guidance. However, the non-MFI stress was stable quarter on quarter, and that is a very big positive. To discuss these and more, we have with us the big man himself, V. Vaidyanathan, Managing Director and CEO at IDFC First Bank. Good morning, Mr. Vaidyanathan. Thank you very much indeed for your time. Actually, the market is worried about both stress and income because the numbers came in adverse. Can you first tell us about this whole credit cost issue? It's high. How do you see it going? It's higher than the guidance.
Well, actually, it's playing to script. Let's be very, let's put the numbers out properly out there. 2.45% is a credit cost for this year for the bank. And this includes the impact of the MFI and also includes the impact of that Mumbai entry point toll road issue, which is a legacy, the infrastructure account. If you take this thing out, because we'll talk about them separately, it's only 1.76%. And our gross NPA is holding up at about 1.87%. Net NPA is 0.83%. In credit cost, to complete the picture, is 1.76%, excluding those two items. So actually, this is, like you rightly pointed out, that our MFI has been higher, but our core book, that's really good news, that it's very stable.
Okay. Would you say the worst of MFI stress is over?
Yes. Which, we should be very watchful. It's a very sensitive segment. I want to be really watchful. But let me just say that as we had said the last quarter, I had spoken at your channel also, we had said that Q4 will be the peak of provision. And then we said in Q1 should be less than Q4 and Q2 and so on progressively. We feel definitely it's progressing on this direction as far as the eyes can see. And best part of being able to establish that is the SMA pool, because SMA feeds to NP and provisions and all that. So our SMA pool has come down from 777 crores to 640 crores. So that is SMA 012 put together for MFI. The whole block has come down. So naturally, in the subsequent quarters, provision should come down.
Okay. Can you take us also through income? Your costs are high, obviously, because you're building the bank. But income has also kind of faltered. What kind of, income growth or interest income growth can you, guide us?
So income also, this MFI thing is affected on two fronts. We talked of credit costs. I don't repeat that because it is higher than expected. I also agree. It was high. But coming back to, but frankly, that happened to all the 200 players who played in this market. We are not the only players. But the other impact of MFI also was income, because we shrank the book, just for the record. We shrank the book from 13,500 crores as of March 31, 2024. So 9,500 crores is a big dip of 44,000 crores. So that also brought down income with it, because the yield on this book was like 23-24%.
So it's an interest reversal, is it?
No, the book shrank. So you accrue less income, like I told you, numbers. So basically the book, so composition of MFI in the book has come down from 7% 1 year ago to now 5.some, maybe 4.8% now. Next year will come down to 3%. So net, we have ambitions of being, a large bank. We don't want to forever be in the mid-tier bank. We want to be a larger bank category. And MFI cannot be a big portion of a book. So that is a phenomenon playing out. But to estimate the next year, let me put it like that, to your question. So we expect our OPEX to further moderate next year. Our OPEX growth last year was only 16%. Next year, we're guiding to be like 13%. So OPEX coming down is a very material movement that should impact the operating profit and the PAT of the bank next year. But certainly, short point is that we expect that 26 numbers of PAT to be much, much better than 25.
Actually, you took away my next question. I did want to talk to you about OPEX. Over 4,000 crores, right? Now, this near almost 5,000 crores. 4,991 is the OPEX. Now, this is like, pretty close to, say, Kotak's OPEX or something. And they have many, many more branches. So what explains such a large OPEX? And when will you be able to milk it? Because that also means cost to income is among the highest in the industry.
Yes, that's absolutely correct. So basically, we added, Lata, we had 200 branches 5 years ago. We have 1,000 branches now. We had 200 ATMs. We have 1,100 ATMs. We hired the people. We put up the infrastructure, the whole thing. We start up so many lines of businesses like cash management and FASTag and credit cards and the liability franchise, the current account. It's a new bank coming up. All things had to be spent. So that's the way it is. So, but the good news is that now incremental, let me just tell you 4 numbers. It will help you very easy to understand. YOY growth on OPEX for Q1 of last year was 21%. Q2 YOY growth was 18. Q3 was 16. Q4 is 12. You can clearly see we are really clamping down on OPEX now. And next year, we expect this to be only about 13%. So we are really going after OPEX, and there are many ways of going after it. And that, we believe, is a material reason why our PAT also should look up next year. The other thing, Lata, is that I want to just put the correct numbers in front of everybody so that it's very clear to expect from us. While the loan book next year may grow up by about 20%, income growth will be like 14% because the microfinance component as a percentage will come down. But income comes down, income grows at a slower pace, but OPEX also grows at a slower pace. Operating profit will still improve next year meaningfully.
Okay. So the slowdown in income growth will be countered by the slowdown in OPEX growth as well, is what you're saying.
Absolutely.
Right?
And the year after that, now the bank is really well set because the machine's running, good franchise, good brand, all that has come. Now, when you look forward, let me say just 1 year forward, I don't want to get too far away, but let me say 27, we expect the income, OPEX to still grow only by that zone, like 13%, but we believe income will go up by 18 because by that time, the microfinance would be in the base case itself. So I really expect that 27 to be materially improved and 26 also to be much better than 25.
Okay. But that also because you're stressing less on microfinance, your margins are coming down. I mean, you were 6+. Now you are a little short of 6% in terms of margins. What's the trend? If that will go down, then that again hurts income, hurts ROA.
No, it's true. Absolutely, you're right. You called it right. So the way we look at, I'll just put some numbers out to just put some clarity on this. So on the margins front, last quarter, which come down to something like 595, as we progress to becoming a large bank, I told you our ambitions of becoming one of them. So there'll be some sort of a moderation there. But let me give you a next 1 year picture. So we expect the repo rates to already come down to 25 basis points last quarter. We expect another 50 basis points to happen. So to the extent we have 30% of a book is linked to repo, we do expect the income to dip according to the amount. But good thing is that we're also going to cut the cost of deposits. Only today, might be just fresh off the press, we brought down our interest rates on fixed deposits to as low as the large banks. Okay. It's a very material development for us, like as low as the big banks. And, it was like a 200 basis points more than those banks 3, 4, 5 years ago. It's now like match the rates. So when we drop the rates also, this also will come down. But together, impact on margin next year should be 10 basis points over Q4 of FY25.
So 5.85 is what we should be prepared for, you're saying?
For next year, vis-a-vis 595 of this year.
Yeah, no, I see, that is understandable. You cannot always be at the 6% mark. But ultimately, as your OPEX, everything will crystallize in the ROA. So give us an ROA guidance. That also has fallen, which may, that perhaps explains why your stock is down 1.2% on a day when the market is up. The ROA would be a disappointment. What would your guidance be?
So we believe that by end of this financial year, we should go back to the 1% kind of a leak. And I agree, it's like 0.3, 0.4%. We had that twin impact, right? Income came down, credit cost went up. Just a strange combination of events came together from MFI. As the impact of MFI recedes over the next 4 quarters, ROA should come back to 1% is what we are working towards.
Okay. Do you release some money because of the lower LCR rules, especially in wholesale and even in retail, lower than at least the draft?
Well, it's much better than the draft guidelines. in the draft guidelines, as per them, it is much benign because the draft guidelines, we had to put out 10,000 crores of extra cash to meet LCR. In the new guideline, our expectation is about 1,000 crores. So it's like markedly better, and 1,000 crores for a big bank like us is really nothing, or for a size of our bank, really nothing. Think of it like 1 or 2 basis points.
Oh, that's excellent. So that also reduces costs
So
or
there's
at
no
least
issue.
improves margins in a big way. You have more money to lend to more profitable areas. So give us a guidance in terms of growth. Okay, the other vertical. What is the vertical you see giving you growth now that you've pulled back a little from microfinance? Will it be SME, MSME? What is your growth lever?
So there are four segments we work with. One is the retail segment. Second is the SME segment. Third is the commercial segment. Commercial is the sitting between SME to the large corporate, that commercial segment. The fourth is the corporate segment. And fifth is the agri segment. Think of it like these five sectors. And there will also MFI. So we will, of course, mute MFI because, like I said, we don't want to be hostage to one product holding the bank hostage to numbers. So we will mute that. But the all other businesses are set for growth. In fact, since I'm on a channel, let me also say that we are looking to build a commercial banking team, the one that sits between the small corporate and large corporate. And we are looking to build a proper team there. So anybody hearing the program want to reach out to us for a proper role, I'll be happy to.
Okay. No, I wanted to, just a final squeeze in a question, though we are being warned of end of time. Your cost per branch. Now, I have not done this math. It has come from someone who's watching this show and is sending the question. He says your cost per branch is as high as 19 crore, whereas for ICICI, HDFC Bank, Bank of Maharashtra, it's much lower at about 6-7 crores. Any reason why your branch, first of all, is this number right? Is your branch cost that much higher than your previous employer, ICICI? And why?
No, my previous employer is a great bank. But let me just say that these numbers are not are absolutely wrong. Actually, very misleading way of comparing banks, actually, because cost per branch is pretty much the same like every other bank, except that we are less branch-heavy bank. We have only 1,000 branches, and we're originating 50,000 crores a year of deposits because our digital machinery is running a very big way. And then we have so many other businesses that are running. Like imagine you're setting a card business. If you go load the card OPEX or a cash management OPEX onto a branch, how does it make sense? So these numbers are not exactly the right benchmark. The real thing is the bank has many new lines of business launched, which we had to do, and they all have a cost. So they have to look for their own independent paybacks and stuff, and they should not, you should not load them to a cost of a branch. A branch cost is similar to other banks.
Okay, your previous great employer, KV Kamath, spoke to me recently. And, as he looked into the future, he said banks, given the way in which fintechs have come in and, technologies coming into the NBFCs, he said banks will have to cut their their cost to income to 1/4 their current number. And he was looking at, ICICI and saying they have to go down to 15%. Give us some guidance. What does your cost to income is sitting at 75? Where does it go to, say, in 2 years, in 3 years?
We think that a good, stable cost income of today's modern times, at this point of time, I agree with Mr. Kamath about the longer picture. But for now, it's more like the 50s, 40s, 50s, let me say late 40s kind of stuff.
Okay.
So we have no doubt that we will get there. Like, we have zero doubt because it's just a scale. Nobody should forget. It's a 5-year-old bank or a 6-year-old bank. Those banks are 25, 30-year-old banks.
Yes.
You really can't compare. But markets are markets, they always compare. So in the long run, I have no doubt in my head that we will get there. And I'll give you one number about how technology is really helping in this cost-to-income ratio. Last year, we added only 58 branches. But our deposits went up by 25%. That is, we grew the branches by 7%, deposit up 25%. This year, we're planning to add branches only by 10%, but we expect deposits to grow by 23-24%.
Yes.
So the power of technology is really showing at our bank, and we believe it will be material progress for the bank in the future. And finally, it's also helping the customer experience.
Okay, no, there's no taking away that everyone who looks at your bank is impressed by the deposit growth, even under very difficult circumstances. Take your point with that, and congratulations for that. Thank you very much for joining us, Mr. Vaidyanathan. Out of time, we have to wrap up on Bazaar. On that note, the market's still in very high spirits. Chartbusters will take the action forward.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and we have got plenty lined up on the show. So let's get straight to the action. Focusing on earnings first. Hindustan Zinc, well, they reported a pretty good set of numbers. The revenue as well was up by close to around 20% in comparison to a year ago. To help us out with what's the way ahead, we're joined by Mr. Arun Mishra, who is the CEO and whole-time director of the company. Hi, Mr. Mishra. Thanks a lot for joining in. Always a pleasure speaking to you. Well, given that Trump's tariffs and the global demand-supply dynamics, what could be the broad zinc price range that you're working with?
So if you look at global situation, US consumes about 700,000 tons of zinc, which is hardly less than 1 million ton out of 12 million ton production world over. Of course, US has put some amount of tariff on 25% tariff on steel and aluminium coming into the country. So there are 2-3 options. One, in the near term, 3 months to 6 months, nothing more happens in the on the tariff side. 90 days freeze gets extended to say 180 days. In that scenario, the world would reset to the new level of doing business with somewhere 10% tariff, not impacting much on the productions or the costs. And we see a price range of $2,500 or $2,600 to $2,750 per ton remaining unchanged for maybe 6 to 9 months. Second option, some rollback happens from US side and business goes back and starts usual, then we would see a recovery of price earlier towards the third quarter, maybe around November, December or so. Otherwise, I see very clearly if this stalemate continues and maybe China price, even if it is corrected by 70-80% of the current tariff, meaning that suppose China tariff remains at 25%, January onwards, you would see a better price of $3,000 per ton kind number.
All right, take that point. That's clear range that you've given for the next 6 months on zinc. But silver prices, they've been fairly volatile as well, holding around $31, $32 per ounce. While gold has surged away, do you see silver prices, focus there as well? Where do you see them stabilize?
No, silver is in for a better time. It's a timing gap between the gold peaking and silver peaking. Immediately, people are rushing to gold because of the lack of certainty in the money market. So that rally will continue for some time, but then it will be followed by silver. A current of $33 to $34 per troy ounce silver, we see a clear future going up to $36, $37 per troy ounce. And yes, further better times in silver will come. Remember last year when I said silver should go up to $33 when it was actually at $29, $30 a ton, all of us thought it will take much long for silver to come to 33. Now that's the reality.
All right, Mr. Mishra, could you outline what are the volume targets for FY26? And also, could you give us an update? How is the FUMA functioning?
So the FUMA plant has been commissioned. Both furnaces are running. They're running currently at 75-80% of the capacity. Another 1 month down the line, they will run at full capacity and add up to 30 tons of silver in a year. So that's done now. That's behind. That difficulty is behind us. Last year, we finished at 1,052 KT of metal, about 1.052 million tons, if I can say so. We know we had an opportunity of another 20-25 KT. Also, the new roaster coming in, that should come on May 20th, will add another 40 KT of metal. So altogether, next year, 1.1 million ton metal is easy to make, and we are all gunning for that.
All right, so what is the pricing band, though, you're looking at if you have to increase the silver production?
Silver, we will focus operation mostly on zinc plus lead mode all through the year. So we will not be silver specific, and we will look at silver around 700 to 710 tons of silver. But if silver prices go further higher and zinc comparatively becomes less attractive, we may change our decision, reduce metal production and increase silver production. We'll look at that as the situation evolves.
Yes, sir. So, given that silver you're guiding closer to around 700 tons, but you're looking at how the situation evolves, then what will be the guidance? What is that price band you're looking at between silver and zinc to focus more on silver, if that's the case?
No, so coal, again, we have done extremely well in making domestic coal available. In the Q4, we had 46% mix of domestic coal in the total coal, and annually we are at 44%. Just a couple of years back, it used to be hovering around 10%, 15% only domestic coal. So we have come up thus far. And second, our RE power mix, renewable power mix has been 13% this year. Q4 has been 15%. Next year, it should be 30%. So given all this, I'm sure that our cost numbers, currently we have done about $1,050 per ton. We should remain closer to that and maybe $10, $15 or $20 lesser.
All right, sir. Could you give us an update on unlocking value of the business? That's something that you have spoken at in the past.
No, it is happening, not in the route that we prescribed. When we spoke that our valuation was 16 billion, but in the meantime, commodity rally happened and we went up till about 28, 29 billion. Then we came down to 21 billion, and we are now focusing on growing our bottom line. That we should be expanding by another 1 million ton. That project, part by part, we should be able to make announcement in another month's time. Starting June onwards, within a span of couple of months, we should be making full announcement, maybe 3 phases of announcements, but we'll be announcing up to 1 million ton expansion. So that will double our EBITDA, and with the 8 times multiple, our valuation will go up further. So the original, even without demerger, we can do that. But I'm sure when the expansion happens, silver number will go to about 1,200 to 1,500 tons. Demerger will become a reality.
And what about the capex plan for FY26 with and without the demerger?
No, as of now, our guidance capex is $225 to $250 million, which is mostly for tapering of expenditure of the earlier projects of fertilizer and roaster and maybe some equipment replacement and some amount of money for debottlenecking. Once we make announcement for growth of 1 million ton, that will come with its own capex. The numbers are being calculated. Rough cut, as I had spoken earlier, enter 1 million ton, maybe about $2.5 billion. So as we complete the calculations for every phase, first phase could be 0.3 million ton, and whenever we are ready by in a month's time, we will make that announcement to take us to 1.5 million ton.
So we'll wait by for the capacity enhancement announcement, but for the time being, you're telling us ramping up capacity and increasing capacity is the focal point. Final question before we let you go. Any update of an OFS in the government of India? Are they looking to sell some more? What about Vedanta? Will they as well look to dilute any stake?
No, nothing. I have not heard anything from both sides.
Appreciate you joining in, Mr. Mishra. Thanks a lot for giving us that quick update and also outlining the way ahead. Well, for the time being, we slip into a short break. On the other side, we'll focus on the primary markets. We'll be joined by Tarun Mehta, the Executive Director and CEO of Ather Energy. Stay with us.
Investing. Welcome back. 200-point run on the Nifty right now, 24,250. That's where we are, and a large part of that is Reliance. Reliance reported a healthy set of fourth quarter numbers led by the consumer business, and the stock surging away, currently up 4%, so the top contributor to the gains on the Nifty today. But today also marks the first main board IPO for FY26, with his Ather Energy's near 3,000 crore IPO that opens for subscription, closes on the 30th of April, comprises of a fresh issue of close to around 2,600 crores and an offer for sale by the promoters as well. Tarun Mehta, who's the Executive Director and CEO of Ather Energy, now joins in to discuss the IPO launch in a lot more detail alongside the business as well. Thanks a lot, Tarun, for joining in. Good luck for your D-Street debut. Just wanted to understand a couple of things before we move ahead. One, you've earmarked about 40 crore for debt repayment, and your last known debt is over 1140 crores. So post this IPO, your debt still remains at 1100 crores. So what's your debt repayment plan on that? That's point number one. And secondly, I just wanted to understand the rationale for capacity expansion, because you currently have around 4.2 lakh vehicles in terms of capacity, but you're able to sell only about a lakh point 10 at best annually. So while you're at 35-40% capacity utilization currently, why are you looking at nearly tripling your capacity?
Right. So thanks for having me here. So first on the debt piece, just to clarify, we actually have roughly about 500 odd crores of debt, not 1100. That 600 crores was a convertible instrument that converted before prospectus. So that's just one point. We feel pretty bullish about our accruals in the coming quarters and years. If you notice our FY25 numbers, 3-quarter data, there's been a massive turnaround story. Our profitability our EBITDA has improved quite materially. Our PAT has improved quite materially. Losses have come down despite growing volumes almost 45% in the same period. So we're feeling bullish, particularly because our unit economics and something that we've been very focused on at Ather has started to pay off really beautifully. Even without incentives like PLI, our margins have doubled from 9% to 19% by Q3 FY25 year to date. So this massive growth in margins and reduced losses and the surge in volumes is what's giving us the confidence around our ability to repay debt in the coming years. So first, not 1100, 500. Second, on capacity utilization, same on the volume point, just to give you 2 data points. Our capacity is about 35,000 units per month. But in the last 1 year, this surge has been amazing in volumes. We launched our new family scooter, Rista, last year, and that's really put our volumes up there. To give you some context, Festive 23, October 23, we did about 10,000 units. Festive 24, October 24, we did 21,000 units out of a total capacity of 35. So you will notice that this is nowhere close to the 1 lakh annual number that from the RHP date. By the RHP, by our prospectus date, things have changed quite materially. And the reason they've changed is because we've launched our mainstream product, Ather Rista, our convenience family scooter. This which is really driving our volumes, which is really driving growth across the country, particularly in the non-South markets. South, Ather has always been a very strong player. In fact, in recent months, we've been market leaders with 25% market share in many months. But with the new product, even in markets like Gujarat, Maharashtra, we have seen market shares of 12, 15, 25% in the last 6-9 months. So that's what's giving us the confidence.
Okay, all right, Tarun, but you have to be extremely confident if you're going to be increasing capacity by that sort of range. But we take your point on board. You're bullish on prospects, so let's see how that goes. But on market share, where do you see your market share headed from here on?
Right. So again, market share also, FY25 has been a very successful and pivotal year. While at the start of the financial year, our market share was roughly about 10%, 9-10%, which is what probably closer to a historical average. But with the launch of Ather Rista in Q2 and its subsequent ramp up over Q2, Q3, and until recently, we've seen our market shares go from roughly 10 to almost 15% in the recent months. In fact, you can see Vahan data even today, and we are very close to 15. So market share has been trending in the right direction. We are clearly growing faster than the market, which is what we've always estimated and hoped for with this new product. And we've been able to do this while growing margins and being very, very, very disciplined with our pricing and our overall profitability.
Okay, all right. Just one more point I wanted to make. With regard to your gross margins, as you mentioned, they have improved. They have improved because of the various measures. That's correct. I've got that on board, and that's good on y'all because you have taken a lot of focus out there on the cost-cutting measures. So kudos on that. But one metric that the street will track, since you're going to be a listed company soon, is going to be the operating cash flows. Those are still negative. When do you see that turn into positive?
So a few things that investors need to understand about our business. Unlike some of our industry peers, we are not very high on capex. We are a very firm believer. In fact, we have written a long section on this in the prospectus that we are very, very, very focused on capital efficiency. So, for example, Ather is not getting into certain endeavors which are very high on capex, like, for example, cell manufacturing. These are businesses that we believe are better run by suppliers. We are very razor focused on keeping our cash focused on things that give us a great ROI. These are technology, product, design, brand. These are things that really give us the maximum bang for the buck. Building a premium brand like Ather, that's what we focus our money on. For example, our distribution is all with dealers, so we don't have to put our capex or opex there. Ather is not into cell manufacturing, so that saves us thousands of crores of capex. And despite that, we've grown the kind of margins that we already have. So we expect our gap from EBITDA to PAT and cash break even would not be substantial. It'll be quite a healthy, quite a small period. And that also in recent months has continued to trend positively, especially when you look at the operating level.
So do you turn EBITDA profitable anytime over the next couple of financial years if you have a targeted financial year for that? And since your operating cash flow will follow that, one assumes that maybe the year you turn EBITDA profitable is the year you turn cash flow positive or profitable as well. Does that happen in FY26 or first half FY27 or towards the end of FY27? Because then you have the big capex coming on stream as well.
Right. So obviously, specific guidance I can't share. But what I can talk about are two things which are the cornerstones for achieving profitability in our business. First is unit economics, and second is how your volumes are trending. On unit economics, we've already, as I've talked about, gone from 9% to 19%, and that's even without production-linked incentives. But the big thing that gives me confidence are what's coming ahead on our margins, on our unit economics. So first, we are transitioning to lithium-ion LFP batteries for a healthy part of our portfolio. LFP batteries are generally generally cheaper compared to NMC batteries, which is what we use today. So they are expected to help improve costs. Second thing we've called out in our prospectus is that we are working on a new platform for scooters, which is called the EL platform. This is a more cost-effective platform compared to the current expensive aluminum frame platform that we use. So that's also expected to help reduce costs. Third is just our overall track record with our engineering. So Ather from day one has been a company very focused on its engineering. Like we almost believe engineering is our superpower. We've invested so deeply and so solidly in it. Both founders were engineers that began this company, both of them. So our track record on that is over the last 3 years and 3 quarters, our teams have delivered a 31% cost reduction for our product.
Got it.
So that's
so Tarun, your passion clearly shows through, but just one final question before we let you go and then, talk about your business when you list. First part, you've spoken a lot about your back end. In the front end, what is your expansion plan on retail, but more importantly, after sales? What is your expansion plan on services? Because what are the kind of service complaints which are outstanding right now? What's the outlook here?
Right. So until last year, Ather's distribution, our distribution was far more focused towards the southern part of the country because the product that we sold much better in south. So we kept a pretty tight control and we did not open a lot of distribution in the northern and the western markets. But with the launch of a family first product, Ather Rista, West and North audiences have responded really well to it. So our market share, all non-South markets has trended has almost, I think, doubled in this time period. Particular focus I want to highlight is Gujarat, where we went from 5% market share before the launch of this product to 25% market share. That success is what's giving us a lot of confidence to now expand into the hundreds of cities in the non-South market where our competition is already present. And we have not opened our first stores also. So a large part of our distribution growth will come from an expansion in the non-southern markets and adding more depth in the markets in south that we're already presented. So that's on distribution. In fact, I do believe very strongly the distribution upside possible here that distribution might be a largest lever for growth in the short term. On servicing, by investing almost a decade in building a platform from scratch here in India with all IP here in India, I think what we've created is a very stable product and something we're very proud of its quality for. One thing that we achieved successfully is insisting that every dealer of ours sets up a service point in support of a sales point.
Got it.
The vast majority of our sales points have a service point at the back end, which gives our customers a lot of comfort that know where to get the vehicle serviced easily.
Okay, all right, Tarun. Apologies, we're a little short on time today, but I'll tell you what, you'll have built a great product. All the best with regard to that. Now the test is with regard to how the stock market takes it. We look forward to having a longer chat with you on the day of listing. Thanks a lot for joining in. For the time being, we slip into a short break. Come back, we continue our focus on markets.
M&M has announced a major acquisition. The company will acquire a 59% stake in commercial vehicle manufacturer SML Isuzu for 555 crore rupees and will also launch an open offer for 585 crores for an additional 26% stake as it looks to strengthen its position in the trucks and buses segment. With the acquisition, M&M is likely to immediately double its scale of production and is eyeing tripling that by FY31. Joining us now to talk about the road ahead is Anish Shah, the Group CEO and Managing Director of the Mahindra Group. Anish, many thanks for joining us here at the CNBC-TV18 studio. It's great to have you and congratulations on getting this deal done. But let's start with valuations. A big difference between what you offer the sellers and what the minority shareholders get. It's 650 versus 1554. Take me through how you arrived at the 650 valuation.
I would just say that it's a fair valuation for all concerned. And for us, we've always followed a very structured process in terms of focusing on certain businesses, investing where it makes sense. And it made sense for us to invest at this value because we feel that from here we can grow the business and deliver returns for our shareholders, which is a very important aspect in how we look at this. And therefore, a blended value is what we really saw. That's what we're finally investing. And on that basis, we feel that it's a fair and appealing deal, which has a very good strategic fit as well.
I'll talk about the strategic fit in just a second, but let's just get through the nuts and bolts of this. By when do you anticipate all the approvals to come in? And of course, you do also now need to make an open offer. By when do you hope to close the deal?
So typically 60 to 90 days is the process. And we hope to be able to stay within that time frame. and close it then.
I know you've said that you intend to keep this a listed entity, but is that the plan as far as the foreseeable future is concerned, or is that the medium to long-term plan as well? Do you envisage a future of this being a separate listed entity?
That is a plan right now. I'm not sure whether that will change or why it will change, but we feel that it is important for this to stay as a listed entity and be able to compete in its segment effectively.
Okay, let's now talk about the synergies, and let's address this at the back end to start with, and then I'll get to the front end. At the back end, what do you believe the synergies can be, you know, both in terms of the capacities that you have and how you intend to make use of those? What's the plan on the back end?
So, Shireen, scale matters. And there are synergies across the entire spectrum. To start with the back end, it's looking at first the product complementarities and the investment made in developing new products. It is about procurement, the manufacturing strengths that come in. And this is where M&M's manufacturing strengths will play a huge role as we look at building a stronger stake in this segment. But before that, let me even take a step back and talk about why this makes sense overall. If you think about different segments we play in, we're in a strong leadership position in almost all the segments we play in today. SUVs, we've gone from a 12% to a 23% market share. And we don't really play in all the SUV segments as yet. Despite that, we're at 23% market share. In tractors, we've gone from a 38, 39% to 43, 44% now. In electric three-wheelers, which is a space where we really had a small business in ICE three-wheelers at a 7-8% share, we are now at a 43% share in an ultra-competitive market and we're the #1 player in that segment as well. In LCVs, we are at 51.9%, up from the low to mid-40s a few years ago. So we're playing in a very significant way in multiple segments. This is one segment where we have a 3% market share. And there are actually different parts of this segment, because when we look at greater than 3.5-ton commercial vehicles, you've got a light and intermediate commercial vehicle segment, and then the MHCV after that. In light and intermediate, we've got a lot of strengths that play to what we do elsewhere. And that's where SML Isuzu also has a number of strengths, and that combination is a powerful one. So as we think about that scale, and therefore coming back to your question, at the back end, from a manufacturing, product, sourcing standpoint, and the talent, of course, there are significant things that are positive for us.
I'll come to talent in just a second, but you know, the growth aspiration, especially leveraging on the back-end synergies that you spoke to us about, 10 to 12% market share from the current 3.5% market share. You feel confident of being able to get to that by FY30?
We feel confident we can get there, and we have a target of 20% plus for the next 5 years. And therefore, we want to put this business on a very significant path for growth.
And what does this now mean as far as the front end is concerned? You know, in terms of dealerships, in terms of franchisees, what happens on that front post this deal going through?
So there again, we see a number of synergies, but we will leverage what we have in the business today because we are in a growth mode. This is not an acquisition about a cost rationalization. This is an acquisition to help us broaden the footprint to go bigger on growth. And that's where the dealership footprint that exists in SML Isuzu will be a very meaningful one for us. In addition to that, how we sell to the customers, the service we can provide, the ability we will have to be able to meet their needs across a much wider footprint, all of that is a positive for both the businesses, and which is where scale comes in a bigger way.
So when you talk about growth, you know, you gave us some indication of the kind of levers that you intend to deploy as, in order to drive growth. What could be potentially some of the others? Because you've made it very clear that this is not about cost rationalization. This is really about your aspiration to grow in this space. What will be the growth drivers, the growth engines for you here?
So it starts with products, and that's the advantage we have in Mahindra Trucks and Buses as well, is a very good set of products, and that's similarly what we see in SML Isuzu. The second aspect is the ability to deliver those products at a compelling price for our customers, and that's where our manufacturing sourcing strengths come into play. The third is the ability for customers to be able to look at what they get from this, save cost, be able to address any challenges very quickly, have a wide footprint to be able to get service and parts and everything else that they require. And as we look at all of these three aspects, if they're done well, that allows us to play in a much bigger way in this segment.
Speaking of playing in a bigger way in this segment, I mean, this is a fairly competitive space as well. But since you're talking about forecasting for the future now, is an ICE future the only future that you're looking at, or is an EV future also part of the plan as far as this segment is concerned?
ICE and EV. And SML Isuzu also has a very strong pipeline for electric vehicles. They have showcased some of that at Bharat Mobility. And that combined with our strengths in EV will allow us to put forth a compelling set of products.
How soon can we expect the EV side of this portfolio to be out of the market?
I don't have a timeline on that, but from my understanding, it's going to be in the near future, not too far off.
Near future would mean, a year, 2 years, a longer period?
My sense is probably in less than a year.
In less than a year?
But as I said, we have to do more work to really fully understand it. And once we fully understand it, then we can commit to time frames.
So in terms of next steps now, are there likely to be any changes on the people front as well? Are we likely to see any restructuring on the people side as well?
So we have a lot of respect for the management team at SML Isuzu, for the business, for their employees, dealers. I think it's a very well-run business. That's a big plus. And therefore, as we think about growth, we're going to leverage the talents and skill sets. So we will work together to see what makes sense overall for every leader and for every employee. But we are going in with a mindset where we have a high degree of respect for them. We feel that they can do a lot. And they can help us actually build this business and take it to where we want to take it.
Just stepping out of this particular acquisition to what's happening as far as the marketplace is concerned, I'm sure you've seen the comments that Mr. Bhargav has made at Maruti Suzuki on what's happening really as far as the low-end market is concerned, where the pain continues to exist. What is the sense that you get, about spending capacity at this point in time and how that's likely to drive consumption or not aid consumption as much as it ought to?
A lot is defined by the products that we have as well. And we've seen and continue to see a good demand for our products. More on that, Shireen, I will hold off till our earnings call, which will be exactly a week from today. But on balance, we've seen a good market. We have stayed with the commitments we've made year to date at least. And as you've seen our numbers for volume, for both SUV and tractors, month over month, they have been fairly healthy, the volumes that we have declared publicly.
On the EV launches that you did, and that of course was a big pivotal moment as far as the journey is concerned, what's the update? What's the status check? What can you share with us on how that's panned out so far?
Our customers love the car. I love the car. I
Is
love
that what
driving
you're driving?
it. Yes, absolutely. And it's just so much fun to drive. The power, the technology in the vehicle is just truly amazing. And I can't drive another car after this right now. And that's the feedback we're getting from customers. Right? We've had customers who see the car and literally, even friends of mine who've just seen it and said, okay, so when will I get the car? I'm buying it now.
What is the growth curve, Anish, really, as far as electric mobility and electric cars in specific are concerned? And I'll also ask you this in the context of what we're seeing happen globally, where we have seen a sort of tempering, a significant tempering as far as electric mobility is concerned. What's the sense that you get here? And, in a future where perhaps in a not-so-distant future where we're going to see more competition in the form of Tesla and Elon Musk entering the Indian market?
A lot depends on product. Because if the product is a wow and delivered at a reasonable price range, the customer is going to want the product. Right? The next question will be on charging. And our vehicles today offer a 500 to 550 kilometer real-life range, certified as 682 and 656 for the two vehicles we've launched. So we've taken that anxiety away. I charge once a week. And most people in cities will need to charge once a week only, unless you're going out of town. Charging on highways is not there as yet, but that will come up very quickly. And that's something I know the government is very focused on and is driving as well. So once all of that happens, an EV offers a much better value proposition in many ways than an ICE. There will be specific ICE products that customers will want, and that will continue. So we don't see ICE going away completely. But we see EV taking a significant stake of the overall share.
So what is the current market share and what's the aspirational market share as far as the EV segment in the car space is concerned?
For India, currently it's 1.5%, which is very, very low. With the products we have, we feel that we will get to 30% EV penetration in the next 3 to 5 years.
You know, a large part of your tenure so far has been about consolidation. It's been about making sure that you fix what needs to be fixed and then focusing on the growth gems that you want to take forward. Do you now feel ready and comfortable to take on more M&A likely, just the way that you've done this particular deal?
We will continue to be very structured in our approach. Our first year was focused on capital allocation. Then we pivoted to growth after that, and we really pushed all our businesses to think big, to be able to deliver a lot more, and that's what we've done across our businesses, including our growth gems. Starting last year, we said we will again pivot to delivering scale, and that is a faster growth trajectory, which is again something we have been able to demonstrate across businesses. And that's the phase we're in right now. But we will look at each business, make sure it can actually deliver what it promises. And if it does, we will put more power behind it, more capital behind it, and enable it to grow.
So, you know, you talked about some of the tailwinds that you're focusing on, but if I could ask you about the headwinds currently, it is a very, very volatile global environment. It's an uncertain global environment with the way the tariffs are playing out. But specifically from your point of view, what are you concerned about today? What is worrying you in terms of potential headwinds?
The world is a very, very uncertain place, a lot more than we had ever imagined it would be. I remember we talked about black swan events that happened sort of once in a lifetime. Now they probably happen every month. So our approach is to be agile and to be able to respond to things as they happen. Having gone through COVID, it's made us much stronger. The semiconductor crisis was a very significant one for the auto business. Therefore, what worries me is actually what I don't know in terms of what's going to happen tomorrow. What we know, we've got plans in place for, and therefore, we want to stay very agile to be able to respond to things as they happen and pivot where we need to.
You know, exports was a big part of your plan of growing the business as well, and that's been a fairly small percentage driving your revenue so far. Does that change, or are you approaching the export business differently in light of the current state of flux?
So it's been a little slower than we would have liked, largely because of the success we saw domestically, because the kind of demand we got for the products we launched, we just couldn't deliver in time, and sometimes that's a good problem to have. Now we are focusing on exports more, but specific markets. We want to try to get to a 15% market share in certain markets before we go to the next set. So it's a fairly ambitious set of plans, but again, one that's done in a structured and disciplined manner, where we're picking certain markets, trying to get to a certain market share there and then move elsewhere.
So where are you closer to being able to get to that 15% market share in the markets that you've already forayed into?
In South Africa, Australia, and Chile.
Okay.
Right? These are three markets also that have very little domestic manufacturing. And that's one where we've played in over time. We've had distributors set up a brand that exists as well. And the products that we're launching there now are seeing a lot of very good demand. So we should be able to we are in 10% in one of the markets already in a segment we play in, at 5% in another market. And therefore, we're on our path.
You know, digressing away from auto for just a second, because one of the other potential growth areas, especially again in light of all the developments that are taking place globally as well as locally, Mahindra Defence, you know, what's the playbook looking like at this point in time, given the many factors that you have to contend with?
So we play only in the transportation and security areas of defense. So armored vehicles is one that we have been supplying to the Army for many years and continue to be at the cutting edge of technology there. In fact, that's where our trucks and buses business helps as well, because there are synergies across both. We're doing a lot in terms of security systems, in terms of counter UAWs, in terms of surveillance mechanisms and surveillance underwater systems and so on. So it is a big area, and we feel that in transportation and security alone, there is a lot that can be done. We do not want to play in the ammunition-related areas of defense, and we are therefore staying away from that.
Back to the deal, and you said this is going to be a win-win as far as shareholders are concerned. So, you know, outside of the expansion, what is it going to mean in terms of the margin profile changing as well, given the many synergies you already spoke of?
So our focus is on growth right now, and therefore
Will that also entail significant investments? Or
we feel that the investments that we plan for in our trucks and buses business should be sufficient. We may come back and take a look at it. There may be some changes, but I don't expect a whole lot. And SML Isuzu is generating a fair amount of cash as well, so that will help in their investment plans. Margins will improve over time, but our primary focus right now in the short to medium term will be on growth. And as we drive that growth, we will see a continued improvement in margins.
Well, Anish, it's always a pleasure. Many thanks for joining us here on CNBC-TV18, and thanks very much for taking us through what this deal means, but also a whole host of other issues that you're focusing on. And of course, look forward to hearing more from you once the results are out and the silent period is over. But thanks very much for joining us here. That's Anish there taking us through what the deal with in the LCV space means for the Mahindra Group and how this is going to be a strategic opportunity that they intend to build on. We'll take a short break here on the record and return with the markets right after this. Stay tuned.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Vinny Motiwala. And it's a strong start to the trading week. Benchmark indices holding with a gain of nearly 1% at 11 o'clock. The Nifty is closer to 24,250. Reliance Industries 4% up move 4.5% up move is a big contributor to the gains today. Banks are doing well yet again. The Nifty banking index moving lockstep with the benchmark indices, and pharma is having a strong day. So that's up close to about 2%.
Absolutely. Good morning, Rima, to you as well. An interesting day coming in. While pharma is managing to hold on to gains, we're seeing a bit on the flip side. IT, that's not managing to do well. It's down 0.7% in today's trading session. Now, that's one of the sectors that is only trading in the red today.
But you know, that's also because last week, the Nifty IT index was up 7.5%.
True.
So it just got re-rated last week. So there is a bit of profit.
Why not? Why not? And like you can see on the screens as well, in terms of contribution that are mainly coming in, Reliance, like Rima mentioned, and other than that, banks are the names coming in. Private banks specifically are seeing a good up move in today's trading session as well. Broader end of the market, that's also managing to hold on to gains today. So whether you look at the Nifty mid cap holding on to gains of 0.8%, small cap managing to hold on to gains of almost 0.3% as well. So good day coming in for the markets as of now. Look at individual names on the broader end of the market. Ramakrishna Forging, MRPL, Cochin Shipyard. These are some of the names in the last few minutes also. I managed to see some bit of an up move. So that'll be interesting to watch out for, Rima.
Okay, let's straight away get to and invite the first corporate on our show today. That's Mahindra Resorts, Mahindra Holidays and Resorts. They've reported about an 11.5% drop in the profits in Q4. The company's top line too has declined by 2.7%. Joining us is Manoj Bhatt, MD and CEO of Mahindra Holidays and Resorts India. Mr. Bhatt, thank you very much for joining in. This is Rima here. Let's start with your top line. While for the full year, FY25, you've clocked in a revenue growth of 2.8%, in Q4, things seem to have slowed down for you. There was a drop in your revenues. Can you explain that? And, you know, what was the reason for that? And what can you guide for the first half of the year at least?
So first of all, thank you, Rima, for having me on the show, and good morning to all the viewers. So if you look at our numbers, firstly, I think Q4 is a quarter where there are two things which are happening. I think the India business showed a very strong growth, but I think our Finnish operations were not up to the mark in terms of the performance there, and that's because of the weather pattern changes there and the economic kind of conditions. So that's the reason for the minor drop. But I think if I look at profits, I think if I exclude some of the one-offs, I think the one-offs are pertaining to potentially some of the forex swings which have happened recently, as well as, you know, some tax refunds which we had in last year. I think on a full year basis, our profits at the consolidated level, excluding one-offs, grew 37% YOY. So which kind of reflects the core strength of the business. Also, if I look at just the India operations, I think that has shown a 25% profit growth year on year on a full year basis. So I think we are seeing two trends here. So one is, of course, some seasonal variations caused by weather in Q4, but otherwise, pretty much on the bottom line, I think a very strong performance.
Tell us a little bit more about the Finland business, because this is not the first quarter, you know, which where a poor performance there has impacted your revenues. I remember even in the prior quarter. What exactly is the problem, and when will it get resolved? Are we seeing early signs of an improvement there?
So if you look at what's happening in Finland, I think 2 or 3 trends. So one is probably the overall economy is not doing well, which if you look at our business, I think there is, of course, the vacation ownership business as well as the conventional hotel business. Those are the 2 things we do in Finland. I think both of them have been impacted. The second thing is, of course, more long-term is about the Russia-Ukraine situation. And a lot of Russians used to visit Finland, and that's kind of affected the overall business. And the lastly is about some changes in taxation, etc., which has been happening at the local level. So that's come up kind of in the past. I think as we look forward, I think 2 or 3 positives. I think the economy is expected to bottom out and start potentially growing. So that's positive for the business. The second thing which is happening is, I think, and this is kind of looking into the future, whether any reconciliation is possible on the Russia-Ukraine thing, and that could be a real positive for the business, because I think a lot of the business was also impacted by, you know, or rather benefiting from Russians visiting that. That should really help the business, I think. And lastly, I think today the team is focused on, you know, the operating metrics at the bottom line and cash management. I think not so much on the top line, because the economic conditions over the last 12 to 18 months have have not really supported a lot of top line growth. So that's where we are. I think my own sense is that we are working on this, and I think we will look at the trends which are coming out from an economic perspective as well as a geopolitical perspective. And I'm hoping that that should be an improvement from where we are today.
Hi, Mr. Bhatt. Good morning. This is Vinny joining in the conversation as well. Mr. Bhatt, what I want to also know is in terms of the outlook that you have for your quarterly membership, the run rate that you have over there, right? In Q4, I believe you added around 2,118 members. FY25 around 12,393. But Q4 specifically has seen some bit of a decline, right? So what is the run rate expected going forward in FY26 quarterly, as well as 5,000 anytime on the card soon?
So I think, Vinny, that's from a membership addition perspective, I think it's a broader view we are taking. And the view we are taking is, I think that how do we improve availability overall? So if you look at our last year's summary, right, you're right, at around 12,400 members we added. But also we added a lot of rooms. We added about 520 keys, which is the highest ever in our history. And what that does is it brought down the member to room ratio. And so it's about 52 members to a room from 56 last year, which has actually helped in terms of making sure that the member availability goes up. So that's our first focus area, which is driving better customer experience. The second thing which we did, and I've spoken about this in the past, is looking at which are the kind of members our offering can serve really well. And so we have exited certain markets, exited certain channels during the course of the year, and focused on getting the right kind of membership inflow, which then we can service better over a period of time. I think both of these have contributed to the contraction in memberships, but my own sense is that's probably going to be a trend. I think the past kind of membership addition is not what we are targeting. We have focused more on making the overall customer experience better and premiumization of the product, if you will, which then kind of means that the volumes could dip a bit. But I think if I look at the overall metrics around what we track is average sales value, that's up very, very sharply. In if I look at even F25, it's up about almost 40% plus in terms of average sales value, which then denotes the kind of members we are attracting are more premium in nature.
Right. Mr. Bhatt, then if you're focusing also on premiumization, that's one of your strategies as well. I just want to overall understand how does your margin profile change as well? What is the expectation in terms of FY26 margin overall for the business, as well as, the EU side of the business? What is the EBIT target on that front, given that there was some bit of a pressure there?
So I think let me first talk about, I think the overall business at the consolidated level. I think from our perspective, if you look at Q4 numbers, it's been a very strong performance on the India business. And if I look at reported numbers were up about 72% Q4 to Q4 in terms of PAT. And even if I exclude some of the one-offs, I think it's about 61%. So very strong performance in profit growth in the India business. Coming to the EU business, I think our focus there is to maintain and slightly better performance into going into the next year. I don't think we are building in any dramatic improvements there. But when I combine the two, I think I do believe that our profits will go up. I think if I look at the last full year, excluding some of the one-offs, I think our profits grew about 37% year on year. My sense is that it will be slower than that, but I think we'll definitely see a growth in profitability as we go into F26.
Okay, Mr. Bhatt, thank you so much for joining in with us this morning on the show, explaining us what to expect from the company going forward in FY26 as well. It's a pleasure talking to you this morning. But on that note, we're going to slip into a very short break and a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now and submit your entry for SME Champion Awards Season 2. Welcome back to Trading Hour on CNBC-TV18. Now let's bring on board Soni Patnaik, who's joining in with us to give us a quick check on the technicals on the market. What is happening over there? Soni, good morning and thank you so much as always for joining in with us. Markets, what are you looking out for in terms of levels today? Yes, we are seeing that bit of an up move that is coming in. But what is important to track for the Nifty as well as the Bank Nifty?
Hi, good morning, Vinny. Thank you so much for having me on the show. So I think it's very simple when it comes to Nifty. It has defended 24,000 on Friday as on closing basis. We've seen a very strong recovery from those levels. Now, again, it is reapproaching the resistance which it was facing the previous series, that is around the 24,350 odd levels. Very crucial resistance and fresh upside can be seen once this level is crossed. So any move above 24,350 can take Nifty towards 24,600 and above that would be 24,800. So these are the levels to watch out for. We would continue to hold longs for Nifty as long as 24,000 is defended on closing basis, and look for targets towards the 24,600 plus levels in next 2 to 3 days. Coming to Bank Nifty, I think Bank Nifty is also approaching its resistance of around 55,500. Now that's very crucial because it has a lot of call writers positioned themselves around that level. So it has to move above 55,500 so that above that it can move towards the 56,200, 56,500 levels. As of now, all bets could be on Nifty as it seems to be holding that mark, and any move above the 24,350 levels, so you can see it heading higher.
Okay, and Soni, what are the stocks that you're tracking as well on the technicals?
Right, so both would be on the buy picks today. First buy pick is from the defense space, Bharat Electronics. It is an official recommendation. One can buy BEL at current levels, keeping a stop loss of 300 and a target of 320 to 325 can be seen. It is just approaching a fresh breakout above a 310 levels. Any move above that, you can see it heading towards a 320 plus levels for May series. The second buy pick is in ONGC, again an official recommendation. One can buy ONGC around 249 and on any declines up to 245, keeping a stop loss of 237 and targets of 265 to 273 can be seen.
Thank you very much for that. Let's talk about Maruti, which holds a huge share in India's passenger vehicle segment, has flagged concerns on growth. Sudarshan now joins in to give us details on this. Sudarshan.
So Maruti had held an investor call after its Q4 earnings on Friday, and today you can see that stock is currently high or say off lows. Now it has talked about majorly two topics. First, FY26 outlook, and second, why entry-level sales remain a concern. So first, talking about the FY26 outlook, company says that if you would have heard SIAM, it's expecting FY26 domestic growth to be in the range of 1 to 2% versus 3 to 4% that we recorded in FY25. So here the picture is not that bright. But what might hold good for Maruti is its export growth is improving. In FY25, its export growth was 17%. Now it believes that in FY26 that growth can increase to 20%. So that's the reason total sales might improve going forward. But the entire industry is talking about the entry level where Maruti is the leader, and why the sales have been falling. It's not been falling for the last 1 or 2 years. It's been falling for the last 5 years since 2018 and 2019. Now, what was the reason? If you compare from that level, currently the sales are 10% lower. So RC Bhargava has given few reasons. First, if you talk about the household income for people who are earning less than 5 lakh, there are 200 million of total 300 million households who are earning less than 5 lakh. Now the cost of these cars, of entry-level cars, if you take, for example, of Maruti, Wagon-R, Celerio, price of these cars have increased significantly over the last few years, and that's the reason people who are earning less than 5 lakh have stayed away from buying these cars. Also, another 30% of households have income in the range of 5 to 12 lakh, and this bracket also has kind of stayed away because of increase in car price. Why the prices have increased? So he has given few reasons. First, like regulatory changes. Second, commodity costs have seen a sharp increase. Now, what does the industry need? If you would have heard in the budget, Finance Minister had announced that income tax would be reduced. And second, upcoming 8th pay commission. So will these two help improve the demand for entry-level car? As per R.C. Bhargava, the big answer is no. He believes that government has to do GST rationalization to improve the demand. Let's listen to what exactly he had to say on this.
The demand has been falling for the last many years. If you look at the small car market, or let me go beyond that. If you look at the household income distribution in India, 200 million out of 300 million households are below 5 lakhs in income. The people in this lower income households, and they comprise the bulk of the Indians, were suddenly faced with sharply rising costs of small cars, largely because of regulatory requirements and the cost of meeting those requirements, partly because of commodity prices and other things. But overall, the prices have gone up very sharply. And so they have dropped out of the market. The projections made by SIAM on the auto industry for 25-26 do not show a better picture than 24-25. Last year, we grew at about 3%. The forecast made by SIAM is 1 to 2%. So the domestic demand is not growing beyond what it has been in the past, maybe falling a little bit. Where we see a silver lining is that our exports are going to grow. We grew exports at 17% last year. We expect that exports this year may grow at about 20% this year. So that is going to make up a lot of what may or may not happen. People at the entry-level segment have numerous demands on their income. There are people who don't generate surpluses every year. And a lot depends on each family what their priorities are. The amount of money which is required to make up the extra cost of buying a car runs into 70,000-80,000 rupees. I'm not sure how much money this income tax refund will give, or not income, but lower income tax rates will give them. Will it give them enough to afford to buy a car and pay for the higher installments? Some families maybe yes, some families no. But we have to see, this thing just started, the impact has just started to come.
Okay, on that note, we know we're going to slip into a very short break. Up next, we'll discuss the market fundamentals with Nilesh Shetty, Portfolio Manager at Quantum Advisors.
Welcome back. Nilesh Shetty from Quantum Advisors is now with us to talk about the market fundamentals and his top sectoral bets from here on. Nilesh, things have dramatically improved from the last time we spoke about. When we spoke about last time, we were in the midst of a very steep correction. Stocks were getting derated, and now we've snapped back higher. Even in sectors like IT, where there was a marked disappointment in terms of the numbers. What have you been doing in the month of April?
Yeah, unfortunately, we've been trimming a bit in the month of April. Like you said, in the month of February, when the markets were correcting quite sharply, we saw some opportunity to deploy some capital. But after that, the rebound has been very, very sharp. So we've had broad weights, large weights in financials, in two-wheelers and IT services companies, of which the two-wheeler pack is getting expensive for us. So we've been trimming because they've had stellar 2024 as well. But apart from that, getting value outside of these three investment basket has been very tough for us. So our cash levels tend to be relatively elevated. Even today, it's about 14%.
Okay, you spoke about private banks, two-wheelers and IT. These are the dominant holdings for you. In that, two-wheelers is now getting expensive, so you're trimming your positions.
That's correct.
Okay. What about IT? What did you do in the month of April? Did you add on to any positions? Or, how will you navigate, looking at IT, say, for the next 6 months?
Yeah, unfortunately, IT may not be a 6-month play, given the uncertainty around recession, probably in the US, and this risk of AI. You may have to be a bit more patient as an investor. What sort of we like was valuations where they were at the lower end of the historical bands. But we don't see any meaningful catalyst over the next 6 months. You may have to be patient. Perhaps once this uncertainty recedes a bit and US corporates start investing back again in the discretionary spends, you may see a pickup coming in revenues. But till that time, these stocks may sort of hover in a small range and they may not go up materially.
Okay. So wait out at least for IT. You're not going to get near-term gains. Maybe there may be something that you should watch out for, but long-term, it's a good story. That's what you're saying. Nilesh, what's your thought coming in on any other sectors? You're finding value anywhere else? Obviously, we've seen the correction coming in the recent times. So something like a pharma, real estate, anything on that front that you would look at?
So the portfolio sort of is a value portfolio with the governance filter. So unfortunately, real estate, we've not had companies pass a governance screen when we are evaluating a lot of these companies there. So we've never had allocation in our last 25 years to real estate. Pharma is something we've been watching very closely. So when Mr. Trump announced there could be significant tariffs, you saw some correction coming off, but then they rebounded again. But that is probably you will see some names come through. We are watching the consumer durable space and the consumer staple space closely. There has been correction, but the valuations were so high, they still, despite the correction, are expensive. But if this underperformance continues, we expect more names to come through in that basket. But barring that, very few opportunities outside of that.
Okay, very few opportunities there. So, Nilesh, then are you going to be waiting out and watching for the earnings season to, pass by and then look at adding something? Or, what is your thought process right now?
So the portfolio is stock specific, so there could be opportunities that may come anytime. And again, we are sector agnostic. So whenever we find a stock coming at levels that we are comfortable with, we are happy to buy. Right now, the closest that I see is a pharma company and probably a couple of consumer durables company if they come through. But again, nothing immediately very close to our sort of levels that we would be adding them to the portfolio.
And pharma would that be focusing more in terms of the domestic side of exposure, or companies which are more focused towards domestic side? Given we still don't know what's happening on the tariff front, right, in the US. So would that be more domestic facing?
No, the correction has actually happened in the companies which are facing more to the US, and that is where we think there could be an opportunity if you assume things will normalize. So if you go with that assumption, the valuation correction will give you an opportunity to add some stocks there in the portfolio.
Since private sector banks or financials is your top holding right now, and you've been bullish on it, with the right disclosure, can you tell us some of your picks there?
So we've been primarily focused on the large private sector banks. You take the top 3 largest private sector banks, we have them in the portfolio. We've been holding them for a while now. Last 3 months is when they really started outperforming. Before that, they were underperforming for a long time. So we think there is still significant upside there. They've still not moved materially enough for valuations to indicate they're expensive. Our sense is they're probably in the early stages of a rally which may last for the next 2-3 years.
Okay. And outside of the top three private sector banks, do you have any financial exposure?
So we are very bullish on the insurance space, both life and general. Valuations have been attractive there because of a lot of regulatory headwinds that came through. I think there could be more names actually which may come through there in the insurance space.
And nothing in the mid-cap arena in, at least when it comes to financials? Like today, for instance, you've got an RBL bank, DCB bank, they're all up 8-9%.
So we have a penchant to ensure that we don't want to worry about the bank once it's in the portfolio. So like I said, in the mid-caps bank, there are other issues, concerns on the book which may come up, which we don't want to be exposed to. So we actually just stuck to the larger well-known names.
Okay. Nilesh, thank you so much for joining in with us, giving us your views on the market as well as sector-specific, especially coming in on the banking side, IT, pharma as well. It's an insightful conversation that we had there. But on that note, we're going to slip into a very short break and we'll get back the co-founder and managing director of Rossari Biotech after the break to talk to us about their numbers. Welcome back to Trading Hour on CNBC-TV18. Let's move on and talk about Rossari Biotech and shift our focus there. FY25, they reported their numbers. Met the revenue growth guidance that they had given of 12 to 15%. The growth came in at around 14% for FY25. EBITDA margin slightly below the guidance in terms of the range of 13.2 to 13.5%. We have the management of the company joining in with us, Sunil Chari, co-founder as well as managing director of Rossari Biotech, to discuss the year gone by as well as what is the outlook for the company going forward. Good morning, sir. Thank you so much for joining in with us on the show. And, what I want to start by asking is in terms of your FY revenue growth, right? You're given a range of around 12 to 15%. You came in at around 14%. Now, this is specifically when I'm looking at the HPCC segment. That's our good growth as well. What is your outlook for FY26 in terms of the guidance that we're watching out for? Similar level of growth is something that we could see continuing, and the segments that will be driving the growth.
Good morning. Last 3 years have been very volatile for the chemical industry. As such, if you see all our peers, we have been able to navigate these volatile times very well. And I feel the future is very good. Even the future looks uncertain. The world is very volatile. We think that we will grow very well in the coming years, especially now that we have done some expansion last year. We are practically at a very low debt level. The net debt levels are at just 70 crores. And in the 3 main companies where it is our B2B business unit of Rossari and TriStar, we have 0 CC utilizations. And in Rossari and TriStar, we have 0 term loans. We have announced some more expansions this year, and we see good possibilities for both domestic and export. Last year, exports were 27%, and we hope to continue with the same exports percentage of the total sales or more. Export seems to be an area where we want to focus, as I've said in all my past calls on CNBC. In terms of R&D, and that is where we have scored over our competition, our peers in India and abroad. And the ethoxylation chemistry is something where we see we can grow volumes, and then there are other areas like esterification. And our R&D lab at IIT Powai is churning out new products regularly, and this is giving us an edge in winning more market share. FPC, as we said, is now more than 70% and growing continuously. But the textile and the AHN business continue to do well, and we hope all the three segments will grow well. Last year also was heartening that we grew on the volume front, and then we had about more than 10% growth on the volume front. In terms of quarterly, the quarter four normally is not the highest, but we had the highest sale in quarter four last year. I feel in the coming days, the markets should reward us well in terms of market share in all our shares, because quality, consistency, supply timing is something which are liked by our overseas customers, and we've done well with this.
Mr. Chari, morning. This is Rima here. Let's talk about exports, since that's clearly a focus area, as you highlighted, and you did very well last year. I think the growth was about 27%, which was ahead of what you were also anticipating at the start of the year. Now, given the tariff uncertainty, how has the export outlook changed, and what can you guide in terms of an export growth or export contribution to your revenues?
So I was in China last week, and I think this is a golden time for Indian specialty chemical exporters to US, to the American markets. We should all grab this opportunity. This is a once-in-a-lifetime opportunity which has come up, for us. It may take time to get approvals. It may take time to get customers to buy the products, but we should all renew our efforts to win a greater share than what we have in the American market. But also Europeans, they are following the Americans, and we see a good possibility for us to expand into both these markets.
Okay, expand into the markets, but what would be the growth that we're watching out for in FY26? This time, surely it was a very good growth. Rima mentioned 27%. A number that you could give us in terms of a guidance that we should keep an eye out on?
So I think, because I cannot predict the future, the China, Taiwan, the US, Ukraine, India, Pakistan, I would go by at, double-digit growth, maybe around 10-15% growth. That is what I would like to, give guidance today. But we will pray and work hard for certainly more.
And 10 to 15% even for the overall business?
Yes.
Okay, so 10 to 15% for overall, but export you've been outperforming. So won't you do better in exports, given the golden opportunity?
So we are 25% plus, and we would like to be, what we were 27% last, we want to grow higher than 27% in exports. And I think we should do much better than what we did last year in exports.
Okay, much better than last year means about 27% is what I'm saying, at least for exports then, no? What we are keeping out for.
It will be more than 27%, definitely. That is our target.
Okay, and just in terms of overall margins then, how do we see that moving as well going forward? What is the outlook for margins that you're keeping? FY25, 12.7%, right? So versus FY24, a bit of a subduedness. Overall EBITDA margin outlook.
So we would look at the total amount of money we earn rather than percentage, as we have always said in my calls. We did 265 crores again, which is the highest. We did 69 crores in EBITDA in the last quarter, which is again the highest. We did about 583 crores sale, which is again the highest. And I would expect the EBITDA also to grow, by 10% plus in this year. So what we did, we are aiming to touch, 300 crores in EBITDA this year.
Okay, aiming to touch 300 crores in EBITDA. Also, sir, you do have some announcements that came in, I think, on capacity expansion for your subsidiaries as well, right? So could you help us understand in terms of what is the new product line that could be added there, as well as what is this in terms of strategic move for both the subsidiaries where you're planning your expansion?
So we are planning to add capacities in MDA. It is called methyl diethanolamine, MEA, monomethyl ethynolamine. And then we are planning to expand our pharma ethoxylates capacities. We are planning to extend our loop ethoxylation expertise. Plus, we are planning to add this year more products on the amine chemistry and more on the ester chemistry this year, both at Rosari Unitop and even some products in TriStar. One big focus which we pushed last year was on our R&D, and we have recruited quite a number. I think we have expanded our R&D strength by nearly 4 times last year. We are opening up in the TriStar facility a beautiful state-of-the-art R&D, and in terms of our gross margins, if you see, our gross margins have been highest ever in our Rosari history. But we have spent a lot of money on creating a market for Rosari products globally. We have taken part in more than 25 exhibitions in the last year. We have added more than 150 people, and mostly in sales, basically last year. And this year we also divided, our focus into the B2B business, which is our strength, but we have a small consumer-focused businesses. And this has been a drain on EBITDA in the past year, and we hope that these do well so that our EBITDA as a percentage also which improves. But our focus would be to grow our EBITDA as an amount always.
Okay, continue to grow your EBITDA as well. 300 crores is what we could expect in FY26. Thank you so much, sir, for joining in with us on the show and talking to us about the outlook of the company going forward in terms of growth. 10 to 15% for the overall business in FY26 is what we could expect as well. But on that note, we're going to slip into a very short break. We'll get you more news and updates on the other side.
Welcome back. Tejas Networks is a stock which has taken a big fall. Just to quickly run you through the numbers, the revenue is down 28% on a quarter-on-quarter basis. Though on a year-on-year basis, it's gone up by close to about 44%. But look at the way the EBITDA has fallen. The EBITDA for the company was moving at a pretty good trajectory. It was about 300 crore, went to 550 crore, but it's dropped off to 121 crore in Q4. And there is a provision for inventory obsolescence or write-down of 117 crore, which could have affected the company's bottom line. Even on the bottom line, the company has reported a loss in Q4 at nearly 71.8 crore rupees. And that doesn't seem to be the only problem. Now that the BSNL deal, because they were executing, maybe that's, dropped off to some extent. The order book has also halved on a sequential basis from being more than 2,000 crore, 2,700 crore. It's just come down to 1,000 crore rupees. So loss this time, margins have shrunk considerably, and the order book has tanked. So these are some of the concerns weighing on the stock.
Absolutely. These are big concerns that are coming in for Tejas Network as well. That's why the stock is down 10.8% as of now, almost near the day's lowest point. But yes, that's Tejas Networks. Nonetheless, we're seeing the markets managing to hold on to gains. Nifty almost around that day's high level. We're keeping it around that level, 24,237. So keeping an eye out on the markets. But with that, we're going to wind down this edition of Trading Hour on CNBC-TV18. Thank you so much from Rima, myself, as well as the team who put this show together. Don't go anywhere. Up next to your halftime report.
Stocks chase a rebound after Friday's week close, with energy, healthcare and industrials being the big gainers, even as IT drags today.
Reliance puts up a resilient show despite headwinds in the O2C business. Streamlined retail operations, strong geo performance and FMCG expansion are the key positives. Analysts lift their target prices for the stock on the strong show.
M&M is set to buy 59% in CV maker SML Isuzu from Sumitomo and Isuzu. This will be followed by an open offer to the public. Mahindra Group CEO Anish Shah tells the blended deal valuation is fair and he hopes to scale the business to 20% market share in a decade.
Maruti Suzuki chairman R.C. Bhargava says 88% of Indian households cannot afford to buy a car. He also challenges the premiumization argument, saying that India's base of high-income earners hasn't expanded.
Anant Ambani is appointed to the Reliance board as an executive and whole-time director for a period of 5 years from May 1, 2025. Anant was earlier a non-executive member of the board.
Good afternoon. You're watching Halftime Report live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia. With me, as always, is Mangalam Malu. And Mangalam, we are almost recovered everything that we lost on Friday, heading towards Friday's highs as well. It's a firmly green screen, and it's green across the board as well.
Our 250-point uptick on the Nifty is what we're seeing. Reliance is the key contributor, telling everyone that, the big boy is here. The good part is earlier, the first leg of the rally was led by the banks. Thereafter, we saw last week recovery from the IT stocks that came by. And now we have Reliance. So the three large weights on the index doing well for the index itself. We'll talk about the markets in just a bit, but let's cut across to Shireen Bhan, who's currently in conversation with the Maharashtra Chief Minister, Devendra Fadnavis.
When we look at the opportunities through IMAC, I think we have a great opportunity to become the logistics capital. We can move a lot of logistics from Mumbai. We actually are looking at advanced manufacturing. We are looking at agri-tech. We are looking at fintech. Of course, Mumbai is a fintech capital. So I think the clean energy push, the green manufacturing, all these areas I think are very important for us, because they will not only play a major role in making us $1 trillion economy, but they will be also the drivers of the IMAC corridor.
Well, speaking of the drivers for growth and urbanization, infrastructure development, connectivity, as you outlined, are some of the key areas that the government is focusing on. For the benefit of our audience here in the room, as well as for those who are watching on TV and online, Mr. Fadnavis, what is the aspiration in terms of infrastructure development? Is there a number that you're working with that over the next 5 years, this is potentially what you would like to invest as far as infrastructure is concerned, to ensure that you can realize the many dreams that you've spoken of?
Absolutely. You see, between 2014 and 2019, we invested somewhere around $30 billion in creating infrastructure. You can see the coastal road, you can see the Atal Setu, you can also see the Samruddhi Highway. There are many iconic projects, the new Mumbai airport, many iconic projects which we built during this tenure. Now we want to do more. So recently, we have tied up with Indian financial institutions to raise a sum of around $50 billion. And in next 3 to 4 months, we'll be tying up with foreign investors to invest into $50 billion more. So there will be a huge push on infrastructure side. We are building a lot of access control roads, airports, ports. Now, you know that the new Mumbai airport will be ready very soon. Now we are building a new airport in Pune. We are also building one more airport in Vadhavan, which will be the third airport of Mumbai. We are actually building a new airport terminal in Shirdi. We are building a brownfield airport in Nagpur. So across Maharashtra, we are building, airports. We are building roads. We have already built Samruddhi Highway. Likewise, now we are building one more highway, which is Shaktipit Highway. This will connect Nagpur. It will be from Nagpur to Goa, and it will actually connect the entire, that area of Maharashtra, which is up till now a little backward, to all the major centers of business. And this will actually transform our economy. And we are also actually building a lot of river connectivity projects. So actually, if you look at Marathwada area, which is water stressed, in that area, now we are building a river linkage project by which we'll be bringing 50 TMC water, the water which flows from west flowing rivers, which directly flows into the sea. That entire water will be brought to Marathwada and will make Marathwada drought free. Again, one more project which we are doing is more about urban floods. So we usually every year we have a lot of floods in the area of Kolhapur and Sangli. This entire water we are bringing through diversion canals to Ujni and to Marathwada. So there are huge projects around water, there are huge projects around infrastructure, roads, ports, airports. Again, you know that we are building Vadvan, which is, Vadvan is a game changer port. And you see, today, the biggest port of India is the JNPT port. It accounts for 60 to 65% of the container traffic. And this Vadvan port is 3 times bigger than JNPT. And actually, on its day one, it will be amongst first 10 ports of world. So this port...
All right, so that is the Chief Minister of Maharashtra in conversation with Shireen Bhan, speaking about the massive infra push that is taking place in the state of Maharashtra, connecting it to all other parts of the nation, but more importantly, other parts of the world as well. But speaking about, growth, let's talk about SBFC Finance. That's the first management on the show, reported a good set of numbers, a 28% growth in their disbursements, or rather in their AUM. The net interest margins as well came in fairly healthy. We have Mahesh Dayani, who's the Chief Business Officer at SBFC Finance, now joining in. Thanks a lot, Mr. Dayani, for joining in. Congratulations on a good set of numbers. The question, obviously, that begets asking is that this 28% growth that we've seen in your AUM, is that sustainable? I mean, what's your AUM growth target for this year? And also on your margins, what we want to understand is, in a scenario where interest rates might be reducing going forward further, where do you intend to maintain your net interest margins?
So the first question on growth, I guess we've been guiding 5 to 7% now for probably more than 8 quarters in a row. That's obviously coming out from a low base. So we don't see that as a challenge of even sustaining for the next 4 quarters. So our guidance has always been that even at an elevated base, we will continue to grow at 5 to 7%. So on a compounding basis, you would be in the range of anything between 25 to 30%, and we'd like to stick to that guidance as well. If you look at our last quarter numbers, the disbursements were fairly firm for both our mortgage business and our gold business. Gold business obviously did see an uptick because of the price, but even if we were to discount on the price, I think the volume growth was in the range of 15 to 16%, which means that it is a sustainable runway for the next year as well. Coming to your question on the price, what we've maintained is that our cost of borrowing continues to remain where it is. In case it comes down, that's the bonus for us that's going to come in, but we've not penciled in as yet, because we feel that the transmission does come with a bit of lag. So with all our projections, we've maintained that we'll be able to maintain our spread all through the year. In case the reduction happens, that comes in as a bonus.
Mr. Dayani, good afternoon. Thank you for joining in. We are in this declining interest rate environment, right? We have already had a couple of rate cuts from the RBI as well. Now, with that happening, how does that impact your yields and your margins going forward? Because there are also more rate cuts that are on the anvil as inflation cools down. So what does that do to your yields and your NIMs?
So if you look at our spreads have largely been constant, probably marginally upticking. If you look at the commentary's been, obviously the rate cuts are going to come in. It hasn't really translated to your MCLRs being reduced by most of the banks. I guess that's also going to come in, but it's going to come in with some bit of lag. So even if we look at a reducing interest rate scenario, most of our book is variable. We would be able to pass it on, but we'll get the benefit of it from the banking system as well. So our spreads largely are not going to be compromised or not going to be impacted even in the next 4 quarters.
Right, spreads will, stay where they are. I'm wondering about the asset quality. If you are growing at the pace at which you are, 5 to 7% every quarter, which implies about 25 to 30% annually, will that at some point hit asset quality? Just trying to understand what's the kind of asset quality targets that you have. So far, it's been maintained. It's been, in fact, improving, if anything. Net interest or rather net non-performing assets are close to 1.5%. What's your asset quality and credit cost guidance for the year?
So our credit cost guidance has largely been in the range of 1%. That could probably move 10 basis points here or there. Given the construct that you see, I think last year we had actually gone a little slow with respect to our disbursals, and that was consciously by design that we decided to move ahead. And this was largely because we did see the leverage at an individual level, at a business level moving up. And as you know, the delinquencies always come with a lag. So we've been cautious whole of last year. Our view doesn't change significantly. So we don't expect too much of volatility even in our delinquencies moving forward. And hence our guidance on the credit cost to be at the present levels of 1% doesn't change from here.
So, Mr. Dayani, do you expect this asset quality number that you reported around 2.7% for the quarter, do you expect that to trend down, or do you expect it to remain in this 2.5 to 3% range as we go along in the new financial year as well?
So I don't think it's going to come off significantly. It's going to probably be very, very range bound. One of the advantages of being into secured is that you don't see significant volatility on a quarter-on-quarter basis unless and until there's a large event unfolding. So you wouldn't see too much of volatility even in our gross NPA numbers moving forward.
Are you looking at increasing the securitized part of your book? And at the same time, if you could give us a sense on whether you'd require capital anytime soon. I see your CRAR at 36%. You're fairly comfortable, but the pace at which you're growing, maybe at some point you would require to raise capital, right?
So we're not looking at raising capital at least for the next 8 quarters. If you look at our ROEs are closer to 13.1 odd percent, 13.1 to 13.2. Our capital adequacy is 36%. We're vending out almost 95 crores of profit, which gets further supplemented to your capital. So we're fairly comfortable on the capital as yet. We would probably not get back to the market at least for the next 8 quarters.
And Mr. Dayani, your provisions too, I was just looking at your numbers, your provisions went up both on a sequential and on a year-on-year basis. Would you believe that this is a quarterly trend, or do you be proactive and you provide more just to ensure that there is no further slip up?
So we feel that, obviously if you have a fantastic season and you have provisions available, there's extra management overlay available. So you would want to really scuttle that in and provide for it. So that's the reason you see our provisions being at almost 45.5%. Now, this is the highest that we've reached in the last 8 to 10 quarters that you would see. We'd like to, keep providing for it as and when we get the opportunity. We'd like to run on a full momentum with full gas available so that if in case there's an event which happens, it really doesn't disturb our earnings outcome in any way.
All right, so spreads above 8% around current levels, NIMs above 10% around current levels, growth between 25 to 30%. We're looking at asset quality maintained at current levels with credit costs being sub 1%. We have all those numbers. And since the mood is such, you're giving us a bunch of numbers as well. If you could give us a couple of more numbers as well. One is on the cost to income ratio. It's currently sub 40%, 39.7% in this quarter. And the securitized book that we, did speak about, you missed giving that answer. Currently about 1250 crores. How much of your overall book do you intend to securitize going forward?
So one is, that's not a securitized book. So what it comes is largely is in the form of co-origination that we do. So where 20% is with us and 80% is with the co-originating partner. So in the overall AUM, it just comes in, but that's not a securitized book. So probably that answers your question on the securitized.
And cost to income?
So cost to income, we've always been guiding that as our distribution sweats, we've guided that our cost is going to come down by almost 50 basis points. Last year, it came down by almost 70 to 75 basis points. This year's guidance is that it will continue to come down by 50 basis points. So that's going to have a positive impact on our cost to income ratios, which will improve all ratios, including the ROEs moving forward as well. So if I were to actually summarize, we have a very boring outcome it's as good as you predicting what our next quarter is going to look like or next year is going to be look like. So our guidance doesn't change. We're as predictable as boring as we can get.
Boring is good. In this
Boring
market,
is
boring, predictable is incredible.
Indeed, boring is indeed good, Mr. Dayani. Thank you so much for joining in, and wish you good luck for the rest of the quarters as well. There's a management there of SBFC Finance on the road ahead. By the way, the Nifty growing from strength to strength now at the highest point of the day. 24,312 is where the index stands at. 24,365 is a Friday's high that needs to cross for the first leg that needs to cross. But for now, at the highest point of the day, 275 points higher on the index. Take a short break. Up next, we'll be joined by the management of Chennai Petro. Managing Director H. Shankar joins in on the other side. Stay tuned.
Look at some of the commodity names. They're doing extremely well. Not only is Reliance at the top of the pops, up around 5% on the back of good numbers coming in from their consumer-facing businesses. Look at BPCL. That's up around 4.5%. We're seeing some traction in ONGC as well, which is up around 2%. And we are also seeing some purchase in names like Exide. We're seeing Whirlpool, which has surged. And we have Aurobindo Pharma and Indian Bank as well. But the stock on our radar is Chennai Petroleum. That's the next management on our show. Reported a strong set of fourth quarter numbers. The gross refining margins came in healthy and they're back to levels that we last saw in the first quarter of FY25 itself. So to discuss this and more, we do have with us Mr. H. Shankar, who's the managing director at the company. Thanks a lot, Mr. Shankar, for joining in. Let's talk about, your GRM itself. It seems that crack improvement that you saw in January has sustained through this quarter. If you could talk about that, and how are you seeing cracks pan out in the very near term? What's your GRM target for the remainder of this year?
Good afternoon. Good that it's a very nice introduction you have given, that we are back to what we have seen in the Q1 of this financial year. So it makes me feel very happy that we are back in the reckoning now after sedate Q2 and Q3. But Q4 has been really good. And it's really not just the cracks which have helped us, but it is also a very good physical performance that we have done. We have given special emphasis on our operational excellence, which is very important to sustain a refinery like ours, which is a standalone refinery. So a broad information on the cracks position is that all through the year we have seen the diesel cracks varying between $9 to $12, and we have also seen the MS in the range of 6 to 8, and we have seen ATF, which is also about 8 to 12. So this is the general variation that we have seen. Nevertheless, we have seen various upswings and downswings in the cracks. We have seen the crack of MS going as low as $1 in the month of January 25, and we have also seen diesel slipping to $5 in the month of September. But on an average, quarter-to-quarter basis, I should be saying that the range is more or less predictable, and it is comfortable for us to sail through. Looking at Q1, it is very early now to say, but currently the cracks are almost in the same range that we are talking about, midway in the range that I have talked about. So Q1 happens to be in the same range for the next financial year.
Mr. Shankar, good afternoon. Thank you for joining in. Of course, this is the first time that you're speaking after taking charge. Mr. Shankar, so fair to say that the first quarter will be as good as the fourth, since you're mentioning that the cracks are remaining in the same range as they have been in the fourth quarter. So fair to say that Q1 will be as good as Q4, if not better?
I would love to say that, but looking at the kind of sudden change that we have seen in the crude position of the first week of April, but still now it is around 68, 70, we are seeing that. But we have a very healthy operating parameters available with us. So I really would love to say that, yes, we would like to have Q1 as good as Q4. Let's see how it pans out in the next fortnight or so, and then it would be much more easier for us to predict the movement.
What about the product cracks for, petrol, diesel and kerosene? How have, if you could split that up for the products, and at the same time, if you could also tell us a little about sourcing mix. Is there any impact of recent sanctions? And you did mention how the positioning changed in April. A large part of that had to do with all the geopolitical developments as well. So has there been a change or impact on your sourcing because of all of this?
Roughly, you can say we have about 50 to 60% of the crude on the term basis. And we also have about 15% crude available through the domestic availability. But we also look at the spot market, which is very favorable sometimes, and sometimes it's not so. But we have a very strong backup in the form of Indian Oil Corporation, our parent company, who is able to source the crude, which is the best available. We just place the requirement of what kind of crude mix that we would like to have to maintain a good operating level, and also to ensure that we make the best of the crude available in our operating scenario. So based on that, we decide what kind of crude mix we would like to take. And as of now, our predominantly the crude availability is coming from the Middle East, roughly about 45%, and also the 15% that I talked about from the domestic. Rest of the things we are sourcing as per the demand, which is my operating scenarios.
Mr. Shankar, you mentioned about the uncertainty in the crude oil prices as well, the massive fluctuations that we have seen. So based on that, have you set yourself a target in FY26 in terms of growing your revenue, growing your margins? Have you come up with a target for that?
See, the crude, again, I'm going back to the previous financial year. Of course, it's easier to now do a postmortem of that. But if you look at the last year also, the crude had ranged from 70 to 92. That was a kind of volatility that we have seen in the crude. Now it is around 68. So we are almost at the same level. But looking at it, I think if we are able to sustain our good operational excellence, then we will be able to maintain a healthy performance in the coming quarters also.
Right, and final question before we let you go, sir, if you could give us a sense on the Kaveri refinery. There was a cost escalation of almost, a little over 10%, 3,600 crores or 12.5% was the cost escalation on a 33,000 crore project. You hold 25% in that. So how does that change your return expectations from this business?
See, Kaveri refinery, we had planned along with Indian Oil as a joint venture, and CPCL holds about 25% stake in it. So what we are looking at is if we are able to get this refinery up and running after the statutory approvals are available with us, which is now with the MOPNG. So we are pushing it from our side, and also the major advantage that it brings to CPCL is that it will add almost $1 or $2 more to our bottom line. So that is a very significant improvement in our profitability as and when it comes in. So I think that is going to be one major project that will come in our hand. Meanwhile, we are also working on the value additions that is possible at outer Manali refinery. We are looking at the LOBS project, which is in the final stages of approval. And once that is done, the coming years should be bringing in better operational flexibility to us in the Manali area also, which is an operating refinery at 10.5.
All right, Mr. Shankar, thank you so much for sparing time and joining us this afternoon. Wish you good luck for the rest of the year as well. The management of Chennai Petro. The Sensex now up 1,000 points. The Nifty at 24,330, almost a triple century now on the index. We talk more about that on the other side, but we'll be joined by the management of Indraprastha Gas before that. Stay tuned. Welcome back. 24,340 now on the Nifty, almost at Friday's high. So good going for the benchmark index. 300 points higher now. The Sensex is also up 1,050. And of course, it is Reliance Industries that is leading from the front now, 5% higher on the stock. But IGL is the next management on the show after a healthy fourth quarter. Higher APM allocations from January till March has boosted results. To discuss more on this, we're being joined by Mr. Kamal Kishore Chatwal, who's the managing director of the company. Mr. Chatwal, good afternoon. Thank you so much for joining in. Now, it seems that there was a one-off in the EBITDA during the quarter. Could you talk about that first, sir?
Yes, there was a one-off, the contingent liabilities that we have provisioned in the books, around 114 crores, towards the trade margin payable to OMCs. So that has been reversed since the issue has been settled with the OMCs. That is a one-off reversal of liability.
Got that. And what about the reported EBITDA per SCM? That's coming at 6 rupees as well, which was much higher than estimates. So if we factor in that one-off, what would be the EBITDA per SCM, the revised one?
If we exclude that, then it would be around 4.42 SCM. EBITDA per SCM would be around 4.42, and inclusive that is around 6.03.
Now, Mr. Chatwal, the earlier guidance for your EBITDA per SCM has been in the range of around 7 to 8 rupees. Would you be looking to maintain that, or would you lower it considering the FY25 number coming in below 5 rupees?
That 7 to 8 has always been our long-term guidance, that that is the range that we feel more comfortable, and we always target that. But due to disruption in the third quarter, where it has the per SCM had gone down to 4.34. So we had given an immediate range of 6 to 7 as a first step, and then 7 to 8 subsequently. Because any price hike has to be a little calibrated, in the sense that in the consumer mind, it should not happen that the fuel is highly volatile. So keeping that in mind, plus the competitiveness with respect to the alternate fuels, the emerging fuels like EV, etc. So we take price hike just to offset the impact of any gas price increase. So one such hike we have taken in Delhi recently of ₹1, whereas in other GAs we were able to increase by 3 to 4 rupees, because they are, the neighboring GAs are at a very high level. So that has been so I can say that the guidance remains 7 to 8, but in 1 or 2 quarters, we may be in the range of 6 to 7.
All right. So the question is, will we see another price hike to maintain your guidance band of 7 to 8? Or, with 6 to 7, you're comfortable even at current prices, even though APM gas allocation is reduced?
The price hike, we always keep on reviewing the situation, and the situation is dynamic in the sense that it's dependent on too many factors. The exchange rate, international prices of Henry Hub, crude, etc., as well as the domestic allocation. So we keep on reviewing that, and the guidance that we have given 6 to 7 immediate for 1 or 2 quarters and 7 to 8, we try to maintain that, and that whatever has to be done, be it in the price hike front or be it in the sourcing front. Gas sourcing is the most critical component here. So in both the fronts, we keep on working and evaluating. But we want to remain competitive, not only with respect to the neighboring GAs, but with respect to the alternate fuels, petrol, diesel, as well as EV.
Now, on the volumes front, and in the fourth quarter, which was largely in line with expectations, but slightly below your exit rate guidance of 9.5 MMS CMD. Now, what would be the guidance on this front in FY26?
So this year, our exit has been at around 9.2, closer to 9.2 in the fourth quarter. So next year, we are targeting 10 million volumes.
Any impact, if at all, if we can expect from the recent draft policy translated to, or rather related to the transition from CNG to EV, especially for 3-wheelers and 2-wheelers?
Firstly, the 2-wheeler is just started, out of, you can say, closer to 1 crore registered vehicles on Vahan portal. Only CNG 2-wheelers are only 3,000 in number. And 3-wheeler autos are around 1 lakh in Delhi. Delhi registered are around 1 lakh. So you can see the difference that the two-wheelers total number on Mahan portal is around 97, 98 lakhs, three-wheelers at 1 lakh. So the impact of three-wheelers was not there, but we have made our submission to Delhi government on the draft policy that the natural gas remains a transition fuel. It's the cleanest fossil fuel. And it was brought in Delhi just to take care of the liquid and solid fuels that were being used. Like it replaced the thermal plant was replaced with gas, then petrol and diesel vehicles were converted to gas. So our submission has been that it should remain a transition fuel, separate from the other two fuels. And it is much closer to the EV in the sense that if we use electricity today, I mean, that is not completely green. So that's around 75 to 78% based on fossil fuel. So if we compare that with gas, so gas is already giving you an advantage of 20 to 30% as compared to petrol and diesel. So it is much more closer to the electric vehicle space. And the pollution, now the numbers that I have given for two-wheelers and three-wheelers, you know, the two-wheelers are too much in number and they are all running on petrol. So that has been our submission that they may relook at these numbers and then decide and leave the choice to the consumers, you know, the user of the vehicle or fleet operator, that whichever is more economical, I mean, India should go for that. Yes, I agree that the tailpipe emission in electric three-wheelers would be less. But if you look at the entire life cycle carbon emission, so I mean, that is a debatable issue that how much benefit would be there in EV.
Sir, for joining in and giving us your perspective on your business and the regulatory framework as well as the outlook for the industry at large, EV versus gas versus fossil fuel. That debate continues, but you're saying gas is better placed in that. You know, you seem to have been bringing good luck for the market. A 300-point uptick is what we've seen on the Nifty, now at the high point of trade, 24,350. Very close to the previous week's high of 24,389 is what you've seen on the index. All through the day, we've seen some strong support coming from the Nifty, Bank and Reliance. But keep an eye out on IT. IT was absent in this pack and now it's recovering from the lows. So can the second half mean another rally and a three-pronged attack on bears from the bulls? IT stocks recovering from the lows, currently just below the flat line. Pull up the intraday chart of Infosys. That's a near 1% recovery from lows. So we've done well for the Nifty, Bank and Reliance. IT, which was underperforming, now likely to outperform. And if that were to happen, then who's to say the Nifty, will it see a further uptick or not in the second half? We take a short break, come back, getting more on the markets and a lot of other stock-specific action.
Welcome back. Now, shifting focus to autos, and Maruti, which has a large share in India's passenger vehicle segment, has flagged concerns on growth. Sudarshan is joining in to give us more details on this. Sudarshan.
So Maruti had held its investor call post its earnings on Friday. In that, company has majorly commented on two things. First, on FY26 outlook, and second, if there is any recovery that we can expect in entry-level segment, considering Maruti remains the top leader. Now, on the first FY26 outlook, company is saying that if you would have heard SIAM for its projection for FY26, it's projecting domestic growth in the range of 1 to 2% versus 3 to 4% that industry had seen in FY25. So the outlook remains grim as far as passenger vehicle domestic growth outlook is for FY26 is concerned. Now coming to entry level. Entry level sales remain a concern, and the sales are not falling for the last 1 to 2 years, but as per Maruti, the sales have been falling for the last 5 to 6 years. If you compare FY25 sales against FY19, sales are down more than 10%. And what's the reason of this? First, there have been regulatory changes. Commodity prices have increased significantly in the last few years, and these have added an increase in the concerns. Now, one major concern that he has raised is about the lower household income. So 200 of 300 million households have income of less than rupees 5 lakh. And now, considering the sharp increase in commodity cost and in resultant price of cars have increased significantly, and that's the reason this significant population of lower household income has stayed away from buying these entry-level cars. Let's listen in what exactly R.C. Bhargava had to say on this.
The demand has been falling for the last many years. If you look at the small car market, or let me go beyond that. If you look at the household income distribution in India, 200 million out of 300 million households are below 5 lakhs in income. The people in this lower income households, and they comprise the bulk of the Indians, were suddenly faced with sharply rising costs of small cars, largely because of regulatory requirements and the cost of meeting those requirements, partly because of commodity prices and other things. But overall, the prices have gone up very sharply. And so they have dropped out of the market. The projections made by SIAM on the auto industry for 25-26 do not show a better picture than 24-25. Last year, we grew at about 3%. The forecast made by SIAM is 1 to 2%. So the domestic demand is not growing beyond what it has been in the past, maybe falling a little bit. Where we see a silver lining is that our exports are going to grow. We grew exports at 17% last year. We expect that exports this year may grow at about 20% this year. So that is going to make up a lot of what may or may not happen. People at the entry-level segment have numerous demands on their income. There are people who don't generate surpluses every year. And a lot depends on each family what their priorities are. The amount of money which is required to make up the extra cost of buying a car runs into 70,000-80,000 rupees. I'm not sure how much money this income tax refund will give, or not income, but lower income tax rates will give them. Will it give them enough to afford to buy a car and pay for the higher installments? Some families maybe yes, some families no. But we have to see this thing just started, the impact has just started to come.
All right, interesting commentary coming in from the big man at Maruti Suzuki, though the stock currently at the high point of trade, a recovery of nearly 5% from the lows. We'll take a short break on that note with the news that the market's doing extremely well. And there's good news for our viewers as well. The CNBC-TV18 app, the India business news leader, is all in your pockets or your fingertips. You can get instant access to breaking news, in-depth articles, financial world updates, all of them anytime in your pockets or your fingertips. You can download the app from either the Apple Store or the Google Play Store, or you can just scan it, which is the code, and put it on your screen. Welcome back. Doing extremely well for the market right now. 300 points on the Nifty. 24,335 is where we are. So perfect time to get in an update coming in from the F&O space. If you look at the Nifty Bank and the mid-cap index, they'll tell you at any given point in time today, if you went long, it was a trending day, you are in the money right now. The biggest contributor is Reliance Industries. The contribution chart comes up for you, a 5% up move, posts a healthy set of numbers, and you have 100 points. A third of the Nifty's gains led by Reliance itself. And then you have contribution coming in from, the banking pack. We have ICICI Bank and HDFC Bank as well. For the large part, we had the IT stocks which were underperforming, and now the IT stocks seems to have come back as well. So the IT index has recovered a fair bit from the lows. So can the second half see recovery from all three major heavyweights, Reliance, IT pack, as well as the Nifty Bank? And that's something we'll keep an eye out on. The acceleration on the move happened this morning itself when we saw a gap up after having conquered the 200-day moving average at close in the previous trading session itself. Where do we go from here? 24,000 put writers, 24,200 put writers, all of them are fairly active, telling you that there is strong support at lower levels. In fact, as we speak, even the 24,300 put is fairly well sold, and that has a premium of close to around 100 rupees, telling you 24,200 is an important support to track. And these are options that expire day after tomorrow. Remember, a Thursday is a holiday on account of May 1. So you have, these options that expire just on Wednesday itself, 30th April, that is. Though we are seeing some writing at the 24,300 call, and that's something I'll be watching out for because it has a premium of 115. If the Nifty stays above that 24,400 mark for a formidable bit, then these near 1 crore option writers will have to cover positions. That would lead to a bit of a melt up as well. But we're ruling out that possibility until the Nifty sustains above 24,400 itself. A lot of short positions added on L&T Finance, so that's one stock I'm keeping an eye out on. And finally, watch out for RBL Bank as well. Fairly well paid in today's trading session, doing extremely well, up 10%, but may enter F&O ban given the sort of open interest build up that it's seen on this counter today.
The top gainer on the Nifty 500 is RBL Bank, now 10% higher. What's not recovered? Those actually before that, there are a lot of recovery seen in the early gap downers. Shriram Finance is one of them. At one point was down 9%, is now down only 4.5%. L&T Finance, as Mangala was just mentioning, was at one point down 8%, is now down only 3%. So some recovery from the lows of the day. But what has not seen any recovery is Tejas Networks, is down 11%, continues to remain at the lowest point of the day. We take a short break. On the other side, Manisha Gupta joins in with Michael Direnzo, the President and CEO of the Silver Institute. Stay tuned.
Welcome back. On the show, we have Michael Direnzo, President and CEO at the Silver Institute, International Institute rather. Michael, hi, thank you so much for joining in. And you are in India right now. And if you look at the numbers in sense of silver, it has been slightly lagging behind when it comes to prices as compared to gold. But how would you look at the gold and silver ratio? And what is your sense on the prices going forward?
Well, it's a great question. And listen, Manisha, it's lovely to be in your great country once again. And I thank you for this opportunity today. Look at the gold and silver ratio at nearly 100 or right over 100 is telling us one thing, and it's saying it's time to buy silver, okay? I mean, it is a ripe opportunity to get into the game. If you're a new investor to the precious metals market, start off with silver. We think it's ripe for potential as we move through 2025 and beyond. And yes, it's lagged a bit, but the fundamentals are strong. You know, they're strong as they have been. We're still calling for another deficit this year in the market, marking the 5th consecutive year of a silver market structural deficit. So we are very pleased to see where we're going to go this year, but we're very optimistic.
When it comes to industrial demand, and as you mentioned, this is going to be a 5th year of deficit right now, do you see a much more pickup in the industrial demand, or is the trade, tariff, global concerns also weighing onto this commodity?
Yeah, we put out a report in January where we had actually forecast another record year for industrial demand, and we've somewhat stepped back a bit until we see what's going to take place, especially with China, which of course is the largest consumer of industrial silver. So we have a wait and see approach at the moment, but nonetheless, it's still going to be a very, very strong year.
How long do you think, Michael, would it take for the markets to go higher from here? Because at the beginning of this year, a lot of banks and brokerages talked about 35 and 38 and even $42 an ounce, but we haven't been able to break above 34 for this year till time. How are you reading the price charts?
Well, I wish I knew when it's going to break out. And when it breaks, it's going to break fast. And quite frankly, we had a 21% increase in the silver price on an average basis in 2024. We're up about 14 to 15% this year. There's a long runway for it to go further. We think the conditions in the market are setting the stage for a major move in silver.
How are you looking at the Indian demand as well? Because while we do understand that a lot of gold demand has shifted into silver because of the all-time high prices here, but overall, how have you seen the first quarter in sense of Indian imports, and what's your sense going forward?
Well, it's been quite extraordinary for India and in turn for the global silver market. Look at last year, we had a decrease in the amount of physical investment globally, but in India, we had an increase in silver physical investment, and that's continuing today. Having just returned yesterday from the India Silver Conference in Udaipur, the market and I should say the participants are very enthusiastically optimistic about 2025.
Any number that you would want to put out, Michael, on what the Indian imports could be for this year? Because we've seen a record number in the last 2 or 3 years, and then some stability in the previous year. Are you looking at higher numbers yet again?
Well, there was a presentation that said they think that number may go higher as we move through the year. But as you mentioned, they've been stable so far. But again, that's coming off of a record late 2023 and 2024 in total.
Michael, when you look at the global markets, what percentage would you say is silver investment demand, and what is the industrial demand at this point, and how does that reflect for India?
Well, on industrial demand, you're looking at over 55, 58% globally for silver industrial demand on an annual basis. Investment demand lowered last year, but we are forecasting a slight increase this year. We think that the retail investor is going to come to the market. We're hearing that the institutional investor is taking a very close look at silver. And India, their relatively new ETPs on the market have been quite strong and are showing no sign of let up.
That's a good thing to know. Michael, thank you so much for joining in as always. And we're hoping next time you're in India, you're in studios here with us in CNBC-TV18.
You can count on it, Manisha, okay? Thank you so much.
Thank you, Michael, for having spent time with us. Well, with that, that's all the time that we have on the show, but Business Lunch will take all the action forward.
Key indices trade near the day's high as stocks stage a rebound after Friday's weak close, with energy, healthcare and industrials being the big gainers, even as IT drags. Reliance Industry puts a resilient show despite headwinds in the O2C business. Streamlined retail operations, strong geo performance and FMCG expansion are key positives. Analysts lift their target price for the stock on the strong show. M&M is set to buy 59% in CV maker SML Isuzu from Sumitomo and Isuzu, to be followed by an open offer to the public. Mahindra Group CEO Anish Shah says that blended deal valuation is fair, and he hopes the scale-up in the business is up to 20% market share in a decade. Maruti Suzuki chairman R.C. Bhargav says 88% of Indian households can't afford to buy a car. He also challenges the premiumization argument, saying that India's base of high-income earners hasn't expanded. Anant Ambani is appointed to the Reliance board as an executive and whole-time director for a period of 5 years from 1st May 2025. Anant was earlier a non-executive member of the board. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwal, and thank you so much for tuning in as always. A good Monday shaping up for the markets, right? We have moved up further higher in today's trading session. 24,350, around that mark is what the Nifty is trading at as of now. So keep an eye on that. 1.2% gain, 3% gain. Day's highest point is what the Nifty 50 is trading at, up 300 points in today's trading session. So yes, market surely doing well. Broader end of the market, let's pull that up. Let's pull up the Nifty mid and small cap as well, because that too is doing well in today's trading session. Mid cap is up 1.6%. Small cap is also managing to hold on to gains of 1% in today's trading session. And do not forget, it did go in the red. So that recovery that we've seen coming in for the market and that up move is surely something that's very interesting. Nifty Bank, that's also trading near the day's highest point as of now as well. Good uptick on that front, 1.5%. Now, PSU banks specifically are also doing well. So let's keep an eye on all those PSU banks as well as private banks. Let's pull up the Nifty contributors right now, because we have Reliance as well as these banking names, private banks, which are doing well in terms of the contribution that's coming. So look at it. Reliance is there in the top supporters for the market. Then we have ICICI, HDFC Bank as well as SBI. So that is why banking space surely is doing well. Other than that, on the flip side, we have IT that's not managing to hold on to gains. HCL Tech is among one of the top drags coming in for the Nifty 50. Nifty IT is the sector that is trading in the red, so keep an eye out on that. But the stock in focus today is also going to be M&M as well as SML Isuzu. Why? Because M&M is set to acquire around 58.96% stake in SML Isuzu, and this is for around 555 crore rupees. Going to be to strengthen its position in the trucks and buses segment. So Darshan is joining in with us to give us details on this front. So Darshan, afternoon.
Afternoon, Vinny. So M&M is high in today's trade, and SML Isuzu, if you see, it's down more than 10%, or currently down 10% trade. And the reason, M&M has announced acquisition and also is going to make the open offer, and open offer price is at a 12% discount to Friday's closing price. So M&M is going to acquire nearly 44% stake from promoter, that is Sumitomo Corporation, and 15% stake from public shareholder, that is Isuzu Motors. And this total stake would worth rupees 555 crore, or say 59% stake. And apart from this, M&M is also going to come out with an open offer to acquire additional 26% stake, and for this price is fixed at rupees 1,555 per share. This is an all cash deal, and deal is expected to be completed by December 2025. So what was the objective of M&M going ahead and acquiring SML Isuzu? To expand its truck and commercial vehicle business. So in the segment of more than 3.5 ton commercial vehicle, currently M&M's market share is 3%. Post the acquisition of SML Isuzu, its market share will increase to 6%, and by FY31, it's targeting the market share to increase to in the range of 10 to 12%, and by FY36, market share should increase to more than 20%. So this was the objective. And in the last 3 years also, SML Isuzu's turnover has increased from more than rupees 900 crore to currently around rupees 2200 crore. So overall, it's very positive for M&A, and that's the reason stock is higher. But considering the open offer price, a discount of 12% to Friday's closing price, you are seeing a sharp downtick in SML Isuzu. Also, till Friday, SML Isuzu was almost 26% higher in 2025.
Okay, thank you so much for that, Sudarshan. We'll keep an eye out on both these stocks. But earlier today, Shireen Ban spoke to Anish Shah, the Group CEO and MD at Mahindra Group. So listen in to what he had to say in terms of the deal as well.
I would just say that it's a fair valuation for all concerned. And for us, we've always followed a very structured process in terms of focusing on certain businesses, investing where it makes sense. And it made sense for us to invest at this value because we feel that from here we can grow the business and deliver returns for our shareholders, which is a very important aspect in how we look at this. And therefore, a blended value is what we really saw. That's what we're finally investing. And on that basis, we feel that it's a fair and appealing deal, which has a very good strategic fit as well. We feel that it is important for this to stay as a listed entity and be able to compete in its segment effectively. We're in a strong leadership position in almost all the segments we play in today. SUVs, we've gone from a 12% to a 23% market share. And we don't really play in all the SUV segments as yet. Despite that, we're at 23% market share. In tractors, we've gone from a 38, 39% to 43, 44% now. In electric three-wheelers, which is a space where we really had a small business in ICE three-wheelers at a 7-8% share. We are now at a 43% share. We will leverage what we have in the business today because we are in a growth mode. This is not an acquisition about a cost rationalization. This is an acquisition to help us broaden the footprint to go bigger on growth. And that's where the dealership footprint that exists in SML Isuzu will be a very meaningful one for us. ICE and EV, and SML Isuzu also has a very strong pipeline for electric vehicles. They have showcased some of that at Bharat Mobility, and that combined with our strengths in EV will allow us to put forth a compelling set of products. We don't have a timeline on that, but from my understanding, it's going to be in the near future, not too far off.
And now let's shift focus to the automaker Maruti, which holds a huge share in India's passenger vehicle segment, has flagged off concerns on growth on that front. Sudarshan is joining in with us and still with us to actually give us more details on this front. Sudarshan, what are we seeing in terms of Maruti? That commentary doesn't seem great, right? So it's a bit of a worry, though the stock is up 1.5% right now.
So commentary was cautious on both the fronts, first on FY26 outlook and also the concerns that have been ongoing for entry-level segment. So first on FY26 outlook, if you would have heard, SIAM, that is the industry body, had projected that FY26 domestic growth for passenger vehicles is likely to be in the range of 1 to 2%, and that would be against 3 to 4% that the industry had seen for FY25. So as per SIAM, FY26 picture for passenger vehicle domestic growth is looking grim, but the major concern, especially for players like Maruti, which is the leader in entry-level segment, now companies saying that sales have not been falling just for the last 1 to 2 years, but it's been falling on a continuous basis for the last 6 years, that is since FY19. If you compare with the sales of FY19 with current sales, currently, sales are down 10% against the sales the company used to see in FY19. What's the main reason? So the main buyers of this segment used to be people in the lower household income. Now, as per RC Bhargava, 230 million households are in the income bracket of earnings of less than rupees 5 lakh. Now, considering the sharp increase in prices of these cars in the last 5 to 6 years, people in this bracket have stayed away from buying the cars, and the reason increase in car prices are mainly because of regulatory changes. Now, considering regulatory changes, all the companies had to meet those regulatory norms, and also commodity costs have been increasing sharply in the last few years. Let's take a look what exactly RC Bhargava had to say on this.
The demand has been falling for the last many years. If you look at the small car market, or let me go beyond that. If you look at the household income distribution in India, 200 million out of 300 million households are below 5 lakhs in income. The people in this lower income households, and they comprise the bulk of the Indians, were suddenly faced with sharply rising costs of small cars, largely because of regulatory requirements and the cost of meeting those requirements, partly because of commodity prices and other things. But overall, the prices have gone up very sharply. And so they have dropped out of the market. The projections made by SIAM on the auto industry for 25-26 do not show a better picture than 24-25. Last year, we grew at about 3%. The forecast made by SIAM is 1 to 2%. So the domestic demand is not growing beyond what it has been in the past, maybe falling a little bit. Where we see a silver lining is that our exports are going to grow. We grew exports at 17% last year. We expect that exports this year may grow at about 20% this year. So that is going to make up a lot of what may or may not happen. People at the entry-level segment have numerous demands on their income. There are people who don't generate surpluses every year. And a lot depends on each family what their priorities are. The amount of money which is required to make up the extra cost of buying a car runs into 70,000-80,000 rupees. I'm not sure how much money this income tax refund will give, or not income, but lower income tax rates will give them. Will it give them enough to afford to buy a car and pay for the higher installments? Some families maybe yes, some families no. But we have to see, this thing just started, the impact has just started to come.
Okay, now let's get more stock specific and on to some other stocks. Reliance Industry, that reported its fourth quarter numbers as well. Performance across all key segments was a steady quarter. Revenue that jumped nearly 9%, driven by strong growth in its digital service as well as retail business, which offset a subdued performance in the energy business. Rima is here to decode the numbers for us. Rima, give us an overview of what happened for Reliance.
Well, it's a strong showing for Reliance Industries in Q4. Profits jumping up 5%. Revenues advancing nearly 10% on a sequential basis. The key positive or the highlight was the acceleration in Reliance Retail. So Reliance Retail's top line up 16% year on year. EBITDA went up 14.5%. And this is a sharp improvement compared to what we've seen in the prior quarter. So just to put it in context, Reliance Industries revenues in the current quarter 16%. This compares with 7% in Q3. It compares with a decline that we had in the prior quarter. And that's what the street likes, the pickup in Reliance Retail. Oil to chemicals was subdued, but still ahead of what the street was anticipating. And the telecom business, that's Reliance Jio, clocked in a steady quarter. The company's average revenue per users improved to 206 rupees. Subscriber additions look strong at more than 6 million on a sequential basis. Another exciting area is new energy, because new energy plans are now unfolding for Reliance Industries, and investors are keenly awaiting that. So Reliance has commissioned a gigawatt-scale AGT technology-based solar module plant. So that's the other positive. Brokerages are bullish on the stock. Nomura says it's their top pick in the energy vertical. They've got a buy rating. They've raised the target price to 1650. JP Morgan, Morgan Stanley also bullish on Reliance Industries. Also remember, in terms of milestones, Reliance Industries has become the first Indian company to have a net worth of more than 10 lakh crore rupees. In 2024, it had become the first Indian company to hit a market capitalization of 20 lakh crore. It just continues to see, scale new milestones. Back to you.
Okay, Rima, thank you so much for that. But on that note, we're going to slip into a very short break. And as we slip into the break, here's some good news that is coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen. Welcome back to Business Lunch on CNBC TV18. Now, there have been conflicting signals over US-China trade war, with Trump saying talks are taking place and China denying any have been occurred so far. US Treasury Secretary Scott Bessent did not back President Donald Trump's assertion that tariff talks with China were underway and said that he did not know if the US president had talked to the Chinese president. Take a look at this report.
Is the US talking to China about a deal on trade or not? Last week, Donald Trump suggested that he had been in touch with Chinese leader Xi Jinping.
I spoke to him numerous times.
However, he didn't say when the contact had happened or what they had discussed. And Beijing has denied that any talks took place. Over the weekend, Treasury Secretary Scott Bessent was then asked whether talks were underway. In an interview on ABC, he said, "I don't know if President Trump has spoken with President Xi. I know they have a very good relationship and a lot of respect for each other." Bessent said his contact with Chinese counterparts had been on issues besides trade. When asked why Beijing would deny that talks had taken place, he said that policymakers there were playing to a different audience. Trump has imposed tariffs on trading partners around the world and 145% levies on Chinese goods. Beijing has responded with 125% duties on imports from the US. The tensions have roiled financial markets and raised fears of a global economic slowdown, though none of that appeared to rattle Trump last week.
As we just said, the tariff will be reasonable, very reasonable, and that'll be the end. That's the deal.
In an interview Sunday, US Agriculture Secretary Brooke Rollins said that the US was holding daily conversations with China over tariffs, but didn't elaborate further.
And on the same lines, let's also listen in to what the former ambassador of US to China, R. Nicholas Burns, had to say on the issues both countries face.
Both governments are trying to figure out how do we climb down from the triple-digit tariff battle that they're in. I think that neither economy and really neither government can sustain a trade war like this at this volume and this depth of seriousness for several months. So I would anticipate that both sides would want to reach out to each other, probably quietly, and begin the process of trying to define, is there a trade deal in the future? And I think the logic for each of them and self-interest from each of them will push them towards that. But the problem is going to be how to negotiate this, how to do it effectively, because I think it will take some time.
Now let's bring you some more news coming in from China. Now the Chinese central bank has said that it will keep its monetary policy loose in order to keep the economy floating. It added that the yuan's exchange rate will be kept at the balanced and reasonable level. The statement came hours after the Politburo called for a cut in its interest rates and reserve ratio requirements. The Politburo meeting, chaired by the president, also sought to help struggling businesses with targeted measures in the face of increased external shocks like US tariffs. And moving on to the US economy now. A number of key economic indicators are set to be announced in the US this week, now which will determine the course of economy as well as the policy interventions of the Fed. On Tuesday, the US consumer confidence is due, while the unemployment data will be out on Wednesday. On Thursday, the US will release data related to manufacturing, while non-farm payroll data on Friday will show the extent of employment in the country. And moving on, another question in investors' minds is whether the Fed will cut rates during the next meeting as tariff uncertainties rattle the market. Here's a former Fed official, Dennis Lockhart, with his take on the same.
Of course, the data are always backward looking, and the data we've seen recently don't yet suggest to me that the economy is in free fall in any way, but there's certainly a buildup of anecdotal information and a buildup of snippets of data here and there that are worrisome. And I tell you, I'm increasingly concerned that the Fed is going to face a stagflationary situation later in the year, maybe temporary, but nonetheless put them in a stagflation decision dilemma.
Let's also listen in to some views on the market and the outlook going forward from some experts.
That's the real difficulty. What's priced in right now? We think we're past the peak in terms of escalating tariffs, and we welcome a lot of the de-escalation that we've seen recently. But now I think we're shifting into the slower burn around digestion. And this week we've got more signals that all of this tariff turmoil is starting to really impact supply chains, and it's already making companies today change their decisions. This week, in terms of what we heard from earnings, one thing that really stuck out to me was how companies are rebuilding their war chest. They're figuring out, how do we increase liquidity? Maybe we're prolonging some hiring plans. Maybe we're enacting some layoffs already. And while the consumer hasn't softened yet in its consumption, the anticipation of a softer consumer is already leading to a softening in business activity today.
And moving on, a trio of polls show that a majority of Americans disapprove of President Donald Trump's handling of the presidency. Voters are also losing confidence in Trump's ability to handle immigration. Take a look at the report from CNBC.
It's nearly 100 days since Donald Trump was inaugurated as President of the United States for the second time. In that time, he has upended the global trade order, defied his own judicial system, and fired the starting pistol on what he called the largest deportation program in the country's history. So far, America appears to have buyer's remorse, with the latest NBC poll showing more than half of respondents disapprove of his performance.
Now, that figure only grows more stark on the economy, with more than 3/4 of Americans expressing disapproval in a New York Times Siena College poll. 44% of respondents say they expect to be hurt personally by Trump's economic policy. This as American equities have underperformed the rest of the world by the widest margin in more than 3 decades this year. The MSCI's USA index shedding 11% year to date. That's versus a 4% uptick for the rest of the world, the widest divergence since 1993.
Okay, on that note, we're going to spin to a very short break, and on the other side, we'll get you the latest updates on the Pahalgam attack. Welcome back to Business Lunch on CNBC-TV18. Now getting you the latest on what is happening in Pahalgam and where India and Pakistan's relations lie. We have Parikshit joining in with us to give us more details on this front. Parikshit.
Well, Defence Minister Rajnath Singh this morning briefed the Prime Minister for about 40 minutes on the security situation in the country and also India's military preparedness for any eventuality. Now, we have seen how the Chief of Defence Staff, General Anil Chauhan, met the Defence Minister on Sunday, briefed him about the security situation and how different forces were prepared. We've also seen over the last few days how Pakistan has been violating the ceasefire along the LOC. There have been at least 4 instances of ceasefire violation at different points at the LOC, and the Indian forces have been retaliating effectively all across the LOC. India has already been carrying out a diplomatic outreach. We've been seeing how External Affairs Minister Subramaniam Jaishankar has been speaking to his counterparts. He also spoke to Foreign Minister of UK David Lammy to brief him about India's zero-tolerance policy on terror as well. The Indian Navy carried out successful multiple anti-ship missile firings in the Arabian Sea as well. So there is a 3-pronged strategy. One, of course, a diplomatic strategy that's playing out, a military strategy, and also the government working out an economic strategy through, for example, suspending the Indus Water Treaty to corner Pakistan.
Okay, Parikshit, thank you so much for that and giving us the latest update on what is happening after the Pahalgam attacks as well as the ties between India and Pakistan. But on that note, we're going to wind down this edition of Business Lunch on CNBC-TV18. Thank you so much for tuning in. Up next, your Midcap Radar.
Good afternoon. You're watching Midcap Radar live from the CNBC TV18 Motilal Oswal studios. I'm Hormus Vatakia. With me today is Reema Tendulkar. Reema, good afternoon. Well, no reason to complain. Absolutely.
What a fantastic start to the week.
Absolutely. And we've recovered almost everything that we lost on Friday, almost at Friday's high as well. So a 1,000-point gain on the Sensex. Great going for the bulls.
Indeed. And the Nifty is now scaled at 24,300 mark yet again. Let's run you through the top headlines and then we'll get cracking on the mid-cap action. Key indices trade near the day's high as stocks stage a rebound after Friday's week close, with energy, healthcare and industrials being the big gainers, even as IT dragged. Mid-caps outperform.
Tejas Networks has tanked over 10% in today's trade after reporting a net loss compared to a profit in the base quarter. The order book has also declined year on year and on a sequential basis to just over 1,000 crore rupees.
Ramkrishna Forgings under pressure after the company discovered discrepancies in certain cases of inventory. The company has appointed an independent external agency to conduct a fact-finding study for the discrepancies.
IGL has surged after reporting a healthy fourth quarter. The management tells CNBC-TV18 that they maintain their near-term EBITDA guidance of 6 to 7 rupees per SCM and a long-term guidance of 7 to 8 rupees per SCM despite a fall seen over the last 2 quarters. Well, almost a 285-point surge on the Nifty, a 1,000-point surge on the Sensex. The bulls are making a comeback, and how? But there are, of course, a lot of specific stocks that are moving. It is the defense stocks that are doing very well for themselves in today's session. And, of course, there are earnings reactions, too, that are going in thick and fast. But, of course, there are plenty of movers. The broader markets, too, doing well for themselves. It's not as if the broader markets are not. In fact, look at Reliance at the highest point of the day now, 5.5% higher on the stock. The mid-cap index is up almost 800 points. The small-cap index too seeing gains of a similar quantum as well. But what are the charts indicating now? Now that we have recovered, we are back above the 200-day moving average. Ruchit Jain of Motilal Oswal Financial Services is joining in for just that. Ruchit, good afternoon. Thank you for joining in. Now that we are nearing Friday's high, but this 24,350 level is proving to be a bit of a barrier for the Nifty. What are the charts indicating here? What do you do now that the dip has been bought into very convincingly? What next for the Nifty? And your stock calls as well for the afternoon.
Yeah, very good afternoon, Harbas. This seems to be a resumption of that high top, high bottom structure which we have been witnessing since last 1 month. If we just recollect that 23,800 to 23,850 was a significant resistance zone in the month of February and March. But we witnessed a breakout above that 23,800, 850 at the start of the April. And if we see the Friday's low, it is exactly in this range. So in technical analysis, what we say, the previous once resistance is broken out, it becomes a support and pullback moves, and that zone exactly has acted as a support. So I think 23,800 becomes a make or break level until this is intact, because this up move has now been again supported by heavyweights today. So I think we should see a continuation of the up move momentum. So any dip that has been bought into, one should hold on to the long positions. Ideal near-term levels that we are watching out on the higher side is around 24,550, which is the 61.8% retracement of the entire correction that we had seen from the all-time high levels to recent low of 21,750. A couple of recommendations, Harmal, on the long side to play this up move. One is, definitely one would be from the defense space, because we are witnessing a breakout in many of the stocks from the defense space. So HAL would be a pick at current levels, where a falling trend line breakout has been seen with very rising volumes. So I think the sector as a whole should do well in the short term. When HAL short-term traders can buy with stop loss below 42.70 for potential targets around 4,700. And pharma names, selective pharma names are looking good over here, within which Sun Pharma, the heavyweight, has given a breakout today with good volumes of last 2 to 3 months of consolidation. So I think Sun Pharma also should do well. One can buy with stop below 1,780 for potential targets around 1,900 to 1,920.
What about Reliance Industries? It's quite a breakout that we've seen today. And I know Reliance has gone through a period of underperformance. I was checking for the last 3 years. In 3 years, the stock is down 5%. So it's not participated in the up move. If it did, it would retrace back. From here on, what are the charts telling you?
So, Rima, I think after a long time, the stock has surpassed its 200-day moving average as well. Every time the stock was showing a pullback move, the 200 DMA was acting as a hurdle, which has been crossed today. And the good thing is that volumes post the numbers today have been very good. So I think we should see a continuation of the momentum in Reliance too. Next major resistance for the stock would be around swing high, which is around 1,550 kind of levels. So I think at least one can expect a move towards between 1,500 to 1,550 from current levels.
Shriram Finance is the top loser, down 5%, and that's breached its 50, 100 and 200-day moving average with the fall that we witnessed. Is there more weakness in store?
So I think overall NBFC space has done well in this last 2.5 months. Shriram Finance has seen more of a consolidation phase. 580 is very crucial support for the stock, which was the previous swing low. So as of now, in spite of last 2 days corrective phase, we have not seen the previous swing lows getting breached in the stock. So I believe that it would continue to see some consolidation amidst the sectoral up move, but definitely not expecting it to be an outperformer within the sector.
Thank you very much for joining in. And now let's get to our mid-cap mover segment. Hormus has now moved over to the big wall, and he's going to tell us about all the mid-caps that are moving and shaking today.
Important numbers coming in from KPIT Tech just a few minutes back. We are still awaiting management commentary on the guidance going forward. Of course, we are awaiting numbers from Ultratech as well in just a few minutes from now. But of course, there are plenty of earnings reactions in today's session, and RBL Bank is the top gainer on the Nifty 500 after its quarterly results, although analysts are still projecting a bit of a cautious stance on the mid-cap lender, but at the highest point of the day now, 10.5% higher. Zensar too having a good day in the office today, but Tejas Networks, that is the one stock that has not seen a recovery, even as L&T Finance has recovered from the day's low, but Tejas Networks making new lows now, 11.5% lower, the top loser on the Nifty 500. Defense as a space is up and about today. Almost every single defense stock is seeing gains of anywhere between 5 to 10%. Garden Reach, Data Patterns, Cochin Shipyard, Bharat Dynamics, you can see the gains here. Paras Defense too is trading with gains of around 11% as we speak. So great going for a lot of these defense names. The newsmakers in today's session are also a plenty. There are plenty of news flow driven names. Sonata Software, after the $75 million deal, is now up 7.5%. Ramkrishna Forgings has had a very choppy session. At one point was down almost 10%, has recovered some of those losses. And Lupin too, after an important drug approval, trades with gains of around 4.5% in today's session. Stocks that are doing well or not so well on the back of strong volumes, and HEG is at the highest of the day, as is AB Fashion, and IGL too, after optimistic management commentary, doing well on strong volumes. And lastly, some stocks that are not doing well in today's session, bucking the trend if you could call it. Chola Finance, after the results, is down 5%. The NBFC space, another 5-star business finance, is at the lows of the day. Lloyds Metal too recovered from the lows, but still down 3.5%, as is Sterling and Wilson, recovering from a circuit, but still down 4% in today's trade. Reema.
Thank you very much for that. Get into a break. We'll get you more on the markets and individual stocks on the other side. Stay tuned.
Welcome back, and almost 300 points higher now on the index, continuing to maintain, but the Friday high continues to remain a bit of a barrier for the Nifty. 24,365 is that level. We are continuing to hover around that 24,330, 24,350 levels for the Nifty. But the mid-cap index too is slightly off the highs of the day, but still holding on to gains of well around about 750 to 800 points. There you can see the dip, that slight dip that came in is now getting bought into again, 825 points higher on the mid-cap index as well. But moving on to a sectoral conversation, the Tamil Nadu Money Lending Entities Bill now, which has been tabled to prevent coercive practices by money lending firms. Now this bill aims to help economically weaker sections of the society. Now to assess the impact of this on the microfinance institutions, we are now being joined by Sadaf Saeed, who is the CEO of Muthoot Microfinance. Finance. Sadaf, good afternoon. Thank you for joining in. I'd like to first start off with this right now. This bill that has been tabled in Tamil Nadu, what do you make of this? And it's a similar kind of situation that has emerged in Karnataka as well, right? So do you see that kind of a situation festering in Tamil Nadu as well going forward?
Good afternoon. Thank you for inviting me here. I think, first of all, let me mention that these are very early days. We are still assessing the bill and its impact. But on the face of it, I think one thing I would like to categorically mention that this is not exactly like how the Tamil Nadu bill was put in place, because Karnataka bill was put in place because Karnataka, after a lot of advocacy, we were able to convince the state government to exclude regulated entities out of the purview of that bill. As we read the Tamil Nadu bill, it already takes into the consideration that the regulated entities which are registered with RBI do not come under this bill. I think from the overall spirit of the bill and the content of the bill, it seems like it is for prevention of coercive practice in lending, which is being followed by unregulated entities. In essence, this is positive. I think this is good because we also don't want unnecessary stress over the customers. There are unregulated entities which are lending and they are following practices which may be coercive and may be forceful in nature in terms of recovery. I think those needs to be prevented. And in the long run, I think this would be good for the regulated entities, because as these entities move out and they don't indulge in lending business, there would be more healthier practice in terms of lending and recovery with the customer, and more market would be available. I don't think so. The impact of this bill would be similar to what happened in Karnataka, because Karnataka that was more driven out of a lot of reportage on various issues which are happening because of money lending activities, and it was envisaged to cover microfinance. But this bill is overall covering all the lending activities, be it NBFCs, cooperative, and other banks and other entities who are lending. So I think it's significantly different than Karnataka bill.
Okay, got that. Mr. Syed, how big is the unregulated market in Tamil Nadu? How many unregistered lenders are there? And what would be the size of, the overall amount that they have loaned out?
Yeah, difficult to gauge, what is the unregulated space in terms of lending. I think it is estimated to be somewhat similar to what book we have in terms of the regulated entities which are there. So it is estimated to have around 20,000 to 30,000 crores of loans which are lent by various entities, which includes online players as well, which are not registered as NBFCs. So they are also there. They are operating from different zones, different territories. Local players are also there, which are lending under different structures. They are not registered with RBI. They don't come under the purview of the RBI.
So to your mind, in your assessment, 20 to 30,000 crore is the amount that these unregulated, unregistered lenders have loaned in the state of Tamil Nadu.
Correct.
And for you, the opportunity, or for players like you, the opportunity is market share.
Yes,
correct?
Absolutely. So we are one of the leaders in Tamil Nadu, and Tamil Nadu is a very mature market. It has always been among the top three kind of a portfolios for microfinance since last 15-20 years, and we have been in operation for 15 years. We are one of the leading players there. So we have seen the behavior of the customer is quite stable, and also the income levels of our customers are much better than some of the other markets. So I think from that perspective, it creates a lot of opportunity for us.
But Sadaf, do you believe that if at all this, firstly, have you seen any stress on ground? You've mentioned that Tamil Nadu is a very mature market, but are you seeing any stress on ground? Because there has been a lot of talk about this MFI stress. The companies have come and spoken on record about it. Have you witnessed anything on ground when it comes to a state like Tamil Nadu? And if at all there is stress on the ground, do you see a contagion effect spreading to the rest of the South Indian market as well, considering that there is a higher share of MFIs in that region?
So South is a very mature market as such for microfinance. I have not seen so far, as I said in my opening remark, these are early days. But as of today, we have not seen any impact on the ground for these news that have come in. But to tell you that the difference between what happened in Karnataka and what is happening in Tamil Nadu seems to be from a point of view of protecting the customers and protecting the vulnerable client. I think what happened in Karnataka was more driven by reportage. I don't want to blame the messenger, but a lot of media reportage happened on microfinance, and because of that, some legislation came into play. But here, I think it's slightly different in Tamil Nadu. It is a preventive measure to ensure that the economically weaker section does not get harassed unnecessarily. And people who are indulging in lending activity which are not registered do not indulge in any coercive practices. So I think these two nuances are quite important to understand. And from a customer point of view, the customer is fully aware that the obligation that they have from regulated entities, they would have to honor. And Tamil Nadu being a mature market, the literacy rate is also quite high. So people generally honor their commitment. So that is what has been our experience.
So you don't fear that the culture amongst the borrowers will change or deteriorate because some section of them, will not have to repay to the unregulated lenders. You don't fear any delay in recoveries or growth impacting for lenders like you.
Yeah, as of now, we don't feel that way. I think there is an important thing to understand that this is not any sort of waiver, or there is no such talk of waiver or any deferral or anything. This is only a talk about ensuring that the collection practices remain as per the RBI guidelines, that they are not any sort of coercive or forceful collection. So I think from that point of view, as long as you are an entity which is operating within the code of conduct prescribed by RBI and the various SROs, I think the business would be as usual. It would not get affected.
One final question from my end, Sadaf. Because of all of this, you mentioned that there are early days, and these are early days. But what about credit costs, asset quality? What is the feeling? What are you anticipating in the current quarter, and of course for FY26 as well?
I'm sorry, we are in the silent period. Our results are very close by. I can't comment on individual company, but I can tell you about the industry. Definitely the credit costs are on the rise. And in the financial year end, most of the people will like to take the provisions or write-offs which are necessary to go into the next quarter in a cleaner slate. So the credit cost will rise. There are many reasons behind this. Of course, there was a credit cycle which changed during the last financial year, and there was a bit of a stress. In Tamil Nadu, there were heavy rains in 25 districts. So because of that also, there was an impact. In our case, we had natural calamity insurance for our customers, so we did not have so much of an impact on Tamil Nadu portfolio. But overall, definitely the credit costs are on the rise for the industry.
All right, Sadaf, thank you so much for sparing time and joining us today on this subject of the microfinance entity and the Tamil Nadu money lending entities bill as well. Well, by the way, some numbers on your screen. Sanghi Industries, a net loss of 117 crores. We just saw numbers from Sri Digvijay Cement as well, where the profits were down 90%, and Sanghi Industries too reporting a revenue growth of 17% for the quarter gone by. But we take a short break. On the other side, we'll tell you a very interesting analysis about the FMCG business of Reliance Industries after the fourth quarter, and mind you, it has become as big as a lot of listed entities. Stay tuned.
Reliance is betting big on its FMCG vertical. Mangalam is here now with the details. Mangalam.
So when you think of FMCG companies, there are a bunch of names that come to your mind. It may not necessarily be Reliance, but it's about time that it should be. Why? Because Reliance in its fourth quarter results told us in the retail segment the scale at which the company operates. However, what stood out was the pace at which Reliance's own consumer products, their FMCG vertical, are growing. In fact, Reliance, remember, entered the consumer goods space in 2022, and within 3 years, it has become a behemoth. Reliance Consumer Products actually sells more than Tata Consumer's India business in FY25, as big as Marico as well. In fact, they're almost as much as Marico and Dabur. If you take out their international business, then they're bigger than them. And for some of the smaller companies, Reliance is actually 3 times of Imami when it comes to sales for the FMCG products itself. In the fourth quarter earnings, Reliance did say that consumer brands became the fastest growing FMCG company in India, with them having achieved 11,450 crore of sales in just the second year of operations. Consumer brands actually expanded their reach through general trade, and that was the big positive, because you would say, okay, with 19,000 stores, it's very easy for Reliance to pump their products in their stores itself. But the part is that they're selling outside of that as well. There are nearly, 3.5 times growth that we saw in Reliance's general trade business. Campa itself has seen double-digit market share gain in key markets. And what are some of Reliance's consumer brands, you would wonder, right? Well, if you go to any of the stores, you would see Snack Tack, which is the food and beverage brand. There's Desi Kitchen. Campa recently launched Spinner, energy drink from Campa as well. A lot of the FMCG groceries are sold under the name of Independence. Then their acquisitions, they made the acquisition of Sil, which is spreads and sauces, Velvet personal care. Then you have some of the dishwashers, Dozo, Glimmer and Puric, which are soaps. Then home care products like, Home Guard, you have Enzo. What's interesting is that 60% plus of these sales come in from general trade, which currently are around 9 to 10 million overall universe. But Reliance's total reach in that itself has been 1 million stores. And have they targeted growth? Oh boy, yes. They are targeting a reach of 5 to 6 million stores in the next 3 years itself. And that would make it at par with some of the largest listed peers in terms of reach. Have they gotten there when it comes to sales? Let's look at how their sales compare on an FY25 or trailing 12-month FMCG sales basis. HUL at 61,000 crores. You have Nestle at 20,000 crores. Mind you, it took Nestle almost 60 years to get to that 10,000 crore mark. ITC FMCG in the last 12 months has done around 20,000 crores of sales. Britannia and Dabur close to 12 and 17,000. And here we have Reliance above Tata Consumer, above Marico, definitely above Dabur's India business itself. So it'll be very interesting to see where they scale from here and go further. Across a lot of conversations that I've had with industry leaders, competition from Reliance is something that they take very, very seriously. So should others fear it immediately? Well, if not immediately, then maybe imminently.
Indeed, as a behemoth that has been formed now, the FMCG business of Reliance Industries. Mangalam, thank you for that very interesting insight. With that, we call time on this edition of Mid-Cap Radar. We'll leave you with the Nifty still 300 points higher, still looking to cross Friday's high, and at that 24,350 mark. From Rima, me and the team that put this show together, thank you so much for watching. Your stocks for the next 30 minutes.
Hello, good afternoon. Welcome to Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Markets, as of now, managing to hold on to the 24,300 level. Nifty, 1.24% uptick is what we are seeing coming in for the Nifty 50, almost near the day's highest point. 296 points up. At one point of time, it was more than 300 points up. But yes, managing to hold on to 24,300, so not bad. Mid and small cap managing to perform in tandem with the benchmark indices as well. Both of them are holding on to gains of more than 1%, 1.5% for mid cap, small cap also managing to hold on to similar level of gains there as well. 1% gain as of now is what we're seeing for the small cap. Sector wise, we're seeing banks that are doing well. So Nifty PSU banks as well as Nifty Bank also is managing to trade around that day's highest point so far. Pharma, that's the other one that's managing to hold on to gains. And other than that, we have IT on the flip side, which is not managing to hold on to gains. That's the only sector that's trading in the red. But this is a show where we solve all your stock-related queries, and to solve all those doubts today, we have our experts joining in with us. Ashish Kail, CMT and author and founder at Wave Strategy Advisors, as well as Gaurang Shah, Senior Vice President at Geojit Financial Services, to solve all those queries. Good afternoon, gentlemen, and thank you so much, as always, for joining in with us on the show. A good Monday shaping up so far, so let's just get started with the queries then. The first query for today is coming in from Sanjay Kumar, who's writing to us from Navi Mumbai. He's holding 10 shares of Axis Bank. This is at a price of 949 rupees per share. Wants to know the long-term strategy and prospect of this stock from here on. Gaurang, your view coming in for Axis Bank. We've seen, these private banks like Axis Bank, HDFC Bank managed to see a steady good performance in terms of the Q4, right? So outlook going forward for private banks and specifically Axis Bank.
Thank you, Vinny, for having me on this show. Good afternoon to you and to everyone, including my good friend Ashish. Surprisingly, for change and for good, Vinny, Axis Bank delivered better numbers than what it used to deliver. In fact, earlier, after they took over the Citibank business, there was a little bit of concern, but now the improvement looks on a steady wicket. As a disclosure, we do have a hold recommendation on Axis Bank from a long-term point of view. My only request to this viewer stroke investor is that don't be content with having just 10 shares. If you do have investable amount, my request would be to, gradually on dips, go on adding it and increase the quantity. Our view at Geojit Investments Limited, Vinny, is that banking and finance is going to perform quite well going into the future.
Okay, banking and finance will do well going in the future, and obviously just don't limit yourself to 10 shares is what Gaurang is highlighting. Ashish, good afternoon, and your view coming in on Axis Bank.
Completely agree with the view coming here. The overall trend for Axis Bank is definitely positive. Even last time we talked about from the banking space, Axis Bank, ICICI Bank both looks to be good. We saw a very sharp rise in Axis Bank from the levels of around 1,067 and now trading around 1,190. The overall tone has turned on the upside. Overall financial sector as a whole looks to be positive. And I think the stock can move towards the level of 1,400 and even much higher from there. So this is an opportunity to enter or buy more of the stock for 1,400 as the target over near term. And on the downside, the support for the stock is going to be around 1120 levels.
Okay, keep an eye out on those levels over there for Axis Bank. Move on to the next query for today. The viewer has a query on two stocks. He's writing to us from Telangana, Anand Pai. 5 shares of Voltas is what they're holding at an average price of 1,435 rupees. So they're making a loss on Voltas right now. And the other one is L&T Technology Services. This is at an average price of 5,685 rupees per share is what the investment price is. So in that one also, they're making a loss as of now is what I can see. Wants to know whether you should continue to hold this or look to sell. Your view, Gaurang, coming in on the fundamentals for both L&T Technology Services as well as in terms of Voltas. L&T Tech, IT space, would you look at any other name, or L&T Tech makes sense, and suggestions coming in there?
Vinny, I would stay put, honestly, because we've been positive on L&T Technologies for a pretty long time now. As far as the numbers are concerned for some of the mid-stroke large-cap IT companies, it has been a mixed bag. Whatever we've seen until now, there are some few remain in terms of delivery of Q4 numbers. overhang of US tariff effect in terms of slowdown of American economy, budgetary cuts, discretionary spends, run rate in terms of ticket size of bills that Indian IT companies used to get may come down. But these are all hypothetical questions. We'll have to wait and watch how the entire tariff related issue has an impact on the US economy, or whether there is a stagnation, or whether there is a slowdown, etc., etc. As of now, we have a hold recommendation. You got in at higher levels if you have investable amount. Current levels of somewhere close to about 4,160 or 170, a decent level to add in case if you got in at higher level. As far as Voltas is concerned, I think this is a sector, consumer durable, discretionary spend, Vinny, if you will. Names like Voltas, Blue Star, Symphony that we have coverage. It's an excellent play in terms of not only the metros, tier 1, tier 2 cities, but also from the aspirations that are going up from semi-urban and rural India in terms of getting these modernized gadgets into their home. And there is a huge demand that is going to explode as we go into the future, with income levels going up because of the focus of the government on the agrarian economy. So we are extremely positive. Only thing is, yes, again, you got in at higher levels. You have the quantity of share is pretty low. In both, I would advise hold and add.
Hold and add is your advice coming in for both of the names. Ashish, on the technicals, would your advice be similar to what Gaurang is saying? Hold and add and average is the best bet, given that they don't hold that many shares of both these stocks.
Yes, I completely agree, because see, we are right now, if you look at the overall outperformance, that has come from the financial space. And if you look at a normal economic cycle and the sector rotation that happens, it usually moves from the financial towards the consumer discretionary segment, may it be luxury, may it be capital goods. So that should start outperforming. So I'm optimistic that Voltas from that space should start showing sign of green shoot from here on. And it is on the chart also, it is at a very important level, placed at a very important support at 1180. So as long as that support is intact, I'm optimistic the stock can again move back towards 1500 and above the cost price towards 1680 also. So the view for Voltas is positive. The support on the downside is going to be around 1180. And for L&T Tech Services, we can see the stock has slowly and steadily moved down from 5,500 towards the 4,200 levels. Below that, but it has been a systematic sell-off across the IT space. It's not only L&T Tech Services, but if you look at any other stock from the space, that has gone down. So I'm not worried about that sector as a whole should reverse up. And when that happens, this stock will outperform as well. So the suggestion would be to hold on to the stock here. The support on the downside is around 3848 levels. That should remain intact. On the upside, we should eventually see 5,000 levels in this stock.
Okay. Interesting to keep an eye out on those levels over there as well for L&T Tech as well as Voltas. Next query for today is coming from Raghav Rao, who's writing to us from Noida. He's holding 30 shares of Ircon International. This is at a price of 192 rupees per share. Currently, the stock is trading at 156. So they're making some bit of a loss on this one. Wants to know whether to continue to hold this or look to sell this one. Gaurang, your view coming in on Ircon International, just a couple of weeks back, it was running up in trade mainly because of some order wins coming. So every time we see that order win coming in, the stock runs up. But technically, overall, on a whole basis, when you look at it in the last 6 months, it's a bit on a downtrend, right? So what are we watching out for on the fundamental front as of now for Ircon?
Well, so we don't have a dedicated coverage on Ircon, but let me give you just our view as far as the entire Indian railway related theme is concerned. So you have stocks like Ircon, you have stocks like IRFC, RVNL, you have stocks like Railtel, IRFC, etc., and maybe Titagar Wagon and Jupiter Wagon, etc. You know, there has been a huge change in terms of the modernization that the Ministry of Railways and the Government of India is right now working on. We've seen upgradation in terms of railway tracks. We've seen modernization of coaches. We've seen Vande Bharats run across pan-India. We are likely to see a bullet train between Mumbai, Ahmedabad, Mumbai, and of course, so on and so forth, dedicated freight corridors, more modernized locomotives with higher capacities, etc., etc. These changes are not going to happen in 1 month, 3 months, 6 months, or maybe 1 year. changes will happen over a longer period of time. Effectively, what I'm trying to say, Vinay, is that these are strong plays with dedicated government policies in place. They will perform over a longish period of time. They will not perform in 3 months, 6 months. So if you eventually decide to invest in any of the railway related themes, please have at least 2.5 plus kind of time horizon to get effective returns out of your investment.
Sure. Okay. Long-term story is good. Don't expect immediate returns because it will play out over a period of time, is what Gaurang is saying. But on the technical front, Ashish, like I was saying as well, right? We had seen at one point of time, July, somewhere it reached the 300 all-time high level, 350. And then after that, we've seen the decline coming in for the stock, right? So right now, yes, the viewer has not bought it at a very high price, 192. Right now, it's at 156. What should they do? Hold or book out the, some bit of the loss that they're making, or maybe average? What's the strategy?
If you look at, you rightly pointed out, the stock has moved from 350 and now to 156, and the buy price is around 192, so that's achievable. On the downside, the stock has managed to form double bottom at 135. It managed to go there nearly 2 or 3 times, bounce back from there. On the upside, the neckline for this pattern is placed at 171, 172. So I think if the stock manages to break the neckline above 172 levels, there can be a good breakout, and the pattern target on the upside should be somewhere around 210 odd levels. So my view is hold on to the stock here. There is a possibility it can give a breakout along with the broader market rally. So overall outlook is bullish. As long as on the downside, the support or the stop loss can be maintained at 145, but the ideal stop is 135 if you can maintain that.
Okay, keep an eye out on those levels over there. Could see a run up, but maintain that stop loss that Ashish is saying as well. Let's move on to the next query. Shankar is writing to us from Bangalore. He's holding 25 shares of Adani Enterprises at a price of 2,000 rupees per share, making some profit on this. Wants to know whether to hold or sell this one. Adani Enterprises, Gaurang, any view on this one?
So again, this one is a difficult one really because you don't have a coverage, to be very honest. But my belief is that, there are certain companies in the Adani group that are worth looking at in terms of performance. Okay, this is not a recommendation. So Adani Enterprise, Adani Ports, Adani Green, these are some of the names in terms of, sound businesses, which with the outlook of positivities in terms of future earnings. Sorry, I won't be able to give a specific in buy, sell, and hold on Adani Enterprise.
Okay, surely. But on the technicals, your view coming in, Ashish?
See, Adani Enterprise had a very important support of 2750, which was breached with a big gap down. And since then, it has been just going in a broad range of 2,600 odd levels on the upside, and on the downside, 2,032. So unless the stock manages to break that range back about 2,550, 2,600, we are expecting it to consolidate. So I would suggest continue to hold on as of now. Wait for that breakout to happen, because if that breakout happens, we can expect the gap filling activity, and we can expect to see the price up back to around 2,800 and possibly higher. On the downside, the support for the stock is going to be around 2,207. So maintain 2,200, 2,207 as a stop loss and hold on to the stock for now.
Okay, hold on to the stock for now. That's the view coming in from Ashish. You had seen those flashes coming in for KPIT Tech also in terms of the EBITDA margin guidance, as well as what they met in terms of the increased guidance. So that is why we're seeing KPIT Tech. They reported their numbers today, earlier on in the day. So keep an eye on that. The stock is buzzing in trade. As of now, almost near the day's highest point. But on that note, we're going to slip into a very short break. And as we slip into the break, here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen. Welcome back to Business Lunch on CNBC-TV18. Now we still have our experts with us, Ashish Kyal as well as Gaurang Shah, who are solving all your stock-related queries. Let's keep it going, gentlemen. Then the next query for today coming in from the defense side. We have Ketan Shah, who's writing to us from Ahmedabad. He's holding 15 shares of Hindustan Aeronautics at a price of 3,800 rupees per share. Wants to know whether it's advisable to buy more shares. He's not looking to sell at all. Just wants to whether he should look to add more. Your view coming in on the defense side and HAL specifically, Gaurang.
So we've been recommending this defense sector for a pretty long time now. Hindustan Aeronautics used to be under our coverage. Currently, we don't have a coverage, but we like the sector. Currently, the coverage that we have is on Cochin Shipyard, BHEL, BEML, to name a few. But all these names are a very strong play with respect to Make in India, Made in India, and the FDI and defense, which was opened up way back in 2016-17, if I'm not mistaken. Hindustan Aeronautics undoubtedly is one of the best suited company in terms of not only completing the requirement as what is needed by India, but also there is a huge opportunity in terms of export market. And the order book is very, very strong, Vinny. The only problem is, companies like Hindustan Aeronautics Limited, who make light combat aircraft, light combat helicopters. These are products which require dedication in terms of experience, time, technology, and precision. These products don't happen overnight or within 3-4 months. There is a long gestation period. Once you make a prototype, get an approval, then the mass scale production starts. And that too, it takes a lot of time to complete the order book. But it is one of the best plays in terms of defense.
In terms of defense, on the technicals, Ashish, what's your view coming in? Should the viewer add more also? And given that, since we'd seen a bit of a decline coming in somewhere in Feb, right, for the stock, then again it started coming up. So is it advisable to buy now? Maybe wait for some bit of a time before buying?
No, I would advise he can buy now, add more at the current levels, because the stock has formed an inverted head and shoulder pattern, giving a breakout as we speak. It's already up by more than 5% as of now, and the volumes have picked up pretty well. So the overall technical chart is suggesting a strong breakout in HAL at this point of time. And on the upside, we can expect the pattern target to be around 5,200, 5,300 levels, with the support at around 4,140. So the risk reward looks also very appealing for going long at the current levels.
Okay, surely keeping an eye out on HAL over there and follow the advice for HAL. But, I just want to mark KPIT Tech. My ticker team, Sudarshan, he just, mentioned as well that KPIT has actually not given a guidance for FY26. So pull out the charts. It's seen a bit of a fall. When we were talking about before, the numbers were fine, but then look at the fall that's coming because they've not given a guidance for FY26 in terms of revenue and margins. So that is something important to watch out for in today's trading session. Look at the fall. Right now it's just managing to hold on to gains of 1%. So surely keep an eye out on KPIT Tech. Now it's 0.5% of gain. So it's seeing that decline coming in fast. Let's move on. And actually, the next query we have is coming in for the IT side, from the IT side itself. We have Pranali, who's writing to us from Mumbai. She's holding 32 shares of Wipro. This is at a price of 200 rupees per share. Wants to know whether she should stay invested in Wipro. Your view, Gaurang?
Well, I'm sorry to disappoint Pranali, but we have a sell/reduce recommendation on Wipro because of our targets are in place. And even if you look at the numbers, Vinny, and compare it with the large cap names, one side Wipro, other side you keep names like TCS, Infosys, HCL, Tech Mahindra. Historically speaking, we've seen underperformance. I would recommend a switch from here since we have a reduced recommendation on Wipro. And if you do decide to switch out from here, large cap names, if you want to again allocate your capital towards IT, then TCS, HCL Tech would be the preferred destinations.
Okay. Keep an eye out on TCS or HCL Tech. That's the view coming in from Gaurang. Your view, Ashish, what are you from Wipro in terms of should she have any hopes from Wipro or look at other IT names?
If you look at Wipro, the stock has been possibly forming a triangle pattern in a range of around 249 on the upside. And on the downside, the support for the stock is at 229. It's been nearly, I think, 10-12 trading sessions since it's moving in that broad range. And I think it's better to hold on as long as the range is intact. On the downside, the support for the stock is around 231. And if it manages to break 249, I'm expecting it to go towards the level of around 260, 265 odd levels on the upside. So suggestion would be hold as of now.
Suggestion would be hold for Wipro. Okay, let's move on and talk about the next stock that is in focus, and that is Hindalco. We have Kirti Sinha, who's writing to us from Patna. It's holding 10 shares of Hindalco. Price is 500 rupees per share, long-term investor. So wants to know whether they should continue to stay invested in Hindalco. What's the long-term story looking like, Gaurang?
The best part is the level at which the investment happened, Vinny. The bad part is the number of shares. Again, you cannot say enough is enough in stock market, but yeah, when you get into names, again, this is a pure metal play. Metal is subject to US news flows in terms of tariff, and of course, news flows comes out from China. But domestically, there has been a good environment in terms of consumption going up, both for steel, aluminium, copper, etc., etc. We have a positive coverage. 740 approximately is the target from a long-term point of view on Hindalco.
Okay. And on the technicals, Hindalco, how is that looking like for the long-term story? What are the levels that they should keep an eye out on, Ashish?
See, if you look at Hindalco, it's following a good cyclical move of around 55, 56 days, where the stock manages to reverse over short term from those time frames. And even recently, the low was formed around that cycle zone. So I'm optimistic for on Hindalco over the near term. From a bigger term perspective, I think the stock has the potential to move towards the previous high, which was around 740, 750 levels. As long as on the downside, the very important support comes to around 575. So as long as 575 is intact, we can expect it to go towards 740 on the upside.
Okay, surely keeping an eye out on those levels. Let's move on to the next query for today. Pratik Sharma is writing to us from Mulund, holding 25 shares of BPCL at a price of 200 rupees per share. Wants to know whether he should hold or look to sell this one. BPCL right now, they're making some bit of a profit. Outlook on this, Gaurang?
Well, it has been, all the three oil marketing companies, honestly, Vinny, there have been a drag. Government has spoken at multiple occasions in terms of divestment, especially for BPCL. Post that, we saw a rally, and then, of course, nothing happened at ground level in terms of divestment. Crude oil prices were very high, have settled down to $65, $66 Brent, $63 to $62 NYMEX. Expectation is that crude oil prices are likely to settle lower. After adjustment of inventories, there is possibility that there should be more positive impact both on the refining margins and net profitability. Being a government company, a 20% dividend track record every year sounds good, but that's not the only reason. But yeah, provided you are in for a long term, you can continue to hold BPCL.
Okay, and a quick view, BPCL, your levels to keep an eye out on, Ashish?
See, right now on the upside, 325 is going to be the immediate hurdle from the levels perspective in near term. And on the downside, the support for the stock is around 288. So hold is the recommendation, 325, 326 is the target.
Okay, 325, 326 is the target, hold is the recommendation. But that was the last query for today, gentlemen. Thank you so much for joining in with us, Ashish, Gaurang, both of you all. And thank you so much, viewers, for sending us your queries. And always remember to send us and email us your queries, and we'll address them with our experts. But with that, thank you so much for tuning in. And up next, you have Closing Bell.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Modest start to the Asian indices as well, but they've opened higher compared to what we are seeing on the US futures currently. It's a mixed picture that is emerging as of now.
The Nifty's also, by the way, crept back into the positive territory on a year-to-date basis. We're up about 1.7% or so.
I think the Nifty Bank again holds the key because it's seen some bit of cool off from that 56,000 odd mark. And if the bulls need to fight back, this one will have to find its form.
Reliance Industries has clocked in a very strong, steady and a good performance. The key positive was acceleration for Reliance Retail.
24,088 on the Nifty, about 0.12, 0.1%, so nothing on it at all. The Nifty Bank is, again, got nothing on it, 54,624 or so.
At Kotak, we're penciling in about 12% earnings growth in FY26, followed by another 14% in FY27.
We expect our OPEX to further moderate next year. Our OPEX growth last year was only 16%.
We're playing in a very significant way in multiple segments.
Benchmark indices holding with a gain of nearly 1% at 11 o'clock. The Nifty is closer to 24,250. Reliance Industries 4% up move.
People at the entry-level segment have numerous demands on their income.
Navy carried out successful multiple anti-ship missile firings in the Arabian Sea as well.
Surge on the Nifty, 1,000-point surge on the Sensex. The bulls are making a comeback, and how?
That was the day so far. Hello and welcome to Closing Bell, last hour of what's been a super strong Monday's trading action. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Nigel D'Souza, and the Nifty is holding firmly above the 24,300 mark. And it picked up pace in the second half of the trading session. As we speak, benchmark indices up over 1%. Mid-caps, small caps higher. Mid-cap index is up 1.2%. That said, for a 1.2% kind of a rally, the advanced decline ratio is not that strong. It's pretty much even-keeled. But, you know, Reliance Industries is clearly the star stock of the day. Reliance Industries is up more than 5%, and it's crossed the 200-day moving average. So that's a positive. And with the up move, we've pretty much recovered all that we lost in Friday's trading session. On Friday, we were down 200. Today, we're up close to about 300 odd points. The only thing is we've not managed to surpass Friday's intraday high, which is 24,365. So that would be a level to watch just in the near term.
And that's something that the Nifty Bank has managed. The Nifty Bank's high today is higher than what we saw on Friday. And the Nifty Bank is the one, you know, where the RSI had perked up and that had gotten to an overbought zone. So at the start of today, we had mentioned that the RSI has cooled back down to around that 67 odd mark. And that's the one that's leading the way. So if you pull up a contribution chart, you'll see Reliance Industries and the banking names, they're accounting for almost all of the gains that we're seeing in today's trading action. And though you have the breadth of the market, that's pretty much even Stevens, you have many outsized result reactions that we're seeing in today's trade. So you pull up a couple of names. You have RBL Bank, that's up close to 10%. On the flip side, you look at L&T Finance Holdings, that stock's down close to around 5%. And I think the stock of the last half an hour or so is KPIT Technologies. The street was waiting by for guidance. The guidance has not come about, though you need to keep in mind that the commentary is fairly positive. But what happened in the last, in the last 30 minutes or so is we saw a sharp spike up on the stock because of the commentary that did come in. But I think the street was looking forward to some kind of concrete guidance, which hasn't come, which explains why the stock has slipped from the highs.
Yeah, we'll talk more about, KPIT Tech. That said, Q4 was strong, but no guidance, which basically means that the situation is very fluid, very uncertain, which is why the company can't go out there and, give it in terms of numerical guidance. But, growth rates for KPIT have also fallen. The time when it used to command a very high PE was when growth rates were 30-35%. Last year, growth rate came down to about 18.5%, roughly. So last year also a lot of de-rating happened because a year back, the stock was priced for growth rates of 30% plus. It came down to about 18.5%. And now we'll have to see what the company does this year. There's a conference call at 5:30 p.m. So we'll get clarity on that. But for for now, the key headline is that the company hasn't given you a revenue or a margin guidance. But, we'll get in our experts to weigh in on this. For now, let's go across to Mitesh Thakkar to find out a few last hour trades. Mitesh.
Good afternoon. So I think the market, as we were hoping and anticipating that it could bounce back, possibly move towards the upper end of the range, which is 24, 550, and we're not very far away from there. Roughly about 200 points to go. So the overall tone remains positive, except for the fact that in the extreme short term, there still could be some kind of consolidation, which could see the markets taper off a little bit, just be in range for some time. But the bias is on the positive. I eventually expect the Nifty to break on the upside, which is beyond 24,500, 550 and head towards 24,750, 800. Having said that, on the stock side, I have a buy on Tata Motors with a stop at 652 for targets of around 700. And the other one which I like, that's Torrent Pharma, which I would recommend buying with a stop at 3280 for targets of 3450.
Okay, Torrent Pharma. It's the pharma sector which has done very well today. The Nifty Pharma Index is up nearly about 2%. But top owners go to Reliance Industries because that giant has woken up and is ready to fire. Reliance Industries is up 5%. It's crossed its 200-day moving average. But also bear in mind, in the last 3 years, Reliance Industries did practically nothing. The stock price hasn't moved in 3 years.
Yes.
Just comparing it. So there is a little bit of a catch-up. And now the numbers are very strong. So in the current quarter, profits are up 5%, revenues went up 10%. The key positive was Reliance Retail, because Reliance Retail's growth was struggling. But in this quarter, they've come back with a 16% top-line growth, EBITDA growth of 14-15%. And to put it in context, for instance, in Q3, Reliance Retail top-line growth was only 7%. In Q2, it was negative growth. And that's when the street started getting worried about retail. But there is acceleration seen in that. And you know what Axis said? That the fact that they're managing to do it while, they're managing to grow in the current quarter, while optimizing their network, while making those investments in FMCG and so many other verticals, it just shows that the platform is now very mature and it's pretty much at an inflection point, according to some analysts. O2C was subdued, better than expectations. Jio clocked in a steady quarter, and new energy plans for Reliance Industries are also unfolding, and that has got the street excited. There you have, they've commissioned a gigawatt-scale solar module plant. Brokerages are bullish. Nomura says top pick in the energy sector. JP Morgan, Morgan Stanley, overweight. And it's also the first Indian company to have hit a net worth of more than 10 lakh crore rupees. So that is a milestone worth reporting when it comes to Reliance Industries. We'll get the disclaimer up for you on your screen for Reliance. But in the meanwhile, let's also get in Dipan Mehta. He's joining us on the show now. Dipan, Reliance Industries, time to buy?
Hey, Nima, good afternoon, and thank you for having me on your show. Yeah, I think numbers were exceptionally good. I went through it in quite a lot of detail and very impressed with Jio numbers as well and with Reliance Retail. But the issue is that you are still buying 3 businesses in a single share. And if you're positive on one particular business, you can't buy into that specific business as an Indian shareholder. And that's where the problem is that, unless we don't have clarity on how the business is going to be listed separately, I'm not sure you want to buy the entire holding company per se. For example, I think Jio's numbers were exceptionally good, and it does show that telecom sector is doing very well. So if you want to increase exposure to telecom, you don't want to do it through Reliance, maybe you can better do it through Bharti. So that's the dilemma which investors are in. The same is with retail, and we saw numbers came from DMart as well, and I'm sure other retail companies also will come with good set of numbers. So that's what is happening, that if an investor wants to play a particular investment theme, or he is bullish on one particular sector, then that's not being offered by Reliance in its present form. At some point of time, we have been talking for several quarters that there's be some clarity on the structure, on the listing. And if Reliance were to become a holding company, then the holding company discounts also will come into play. So while I think it's great from a Nifty perspective that, the largest company has reported such great numbers, but when you look at individually, when you want to buy Reliance in a portfolio, sure, you will buy it because you want to track the Nifty. But whether you'll be overweight, I'm not so sure.
Okay, all right. Well, hi, Dipan. Good afternoon and good to see you, Ben. We had a news flash at the bottom of your screen that the long-awaited India and France, they have signed a mega 63,000 deal to buy 26 Rafale marine aircrafts, for the Indian Navy. So that's the big news point that was just flashed at the bottom of your screen. And you had the defense names itself that are moving higher in today's trading session. Any particular stock that's on your radar, Dipan? You have Bharat Dynamics that's up. HAL is buzzing in trade as well. One of the possible beneficiaries of this particular deal, between India and France could be Reliance Infra as well, but they will be doing the maintenance contractor work. That's in the years to come. Anything that stands out for you?
See, not specifically related to the Rafale deal, but definitely I think Hindustan Aeronautics is certainly a stock. Again, disclosure, we and our clients are invested. And the reason for that is that the GE engines, as and when they start coming in, you will see a lot of improvement in the billing and the execution at HAL. And it's a large company. And I think order visibility also is quite phenomenal and critical to India's strategy to be self-dependent on defense. So very positive on that company per se. It has underperformed for some time now. But I think because of whatever's taken place in recent time, again, the defense stocks have come into focus and, understanding that these companies are critical to our security. I think they may see even more importance being given by the government, maybe more order flow, maybe more operational freedom. I don't know, but on the whole, I think it does put a spotlight on defense companies, but our top pick would be Hindustan Aeronautics. But investors need to hold these stocks for a long period of time because the billing cycles, the order cycles are very long.
Got it. Okay, all right, Dipan. Let's focus on the banking names then. RBL Bank, that's passing in trade. It's up close to 10%. Citi is bullish on the stock with a buy rating, whereas JP Morgan is bearish on the stock. They have an underweight rating. Abhishek joins us to get us all of these details. Well, Abhishek, I don't remember the last time around RBL Bank was up 10%. Tell us more.
Well, it looks like, in the con call, they have guided that the worst is behind, which is a common phrase used across various banks at many quarters. So Citi has actually a buy view and they have increased the target price to 230 from 215 that they had earlier. They said that the stress in the MFI portfolio, that is the joint liability group model, and the credit card portfolio has actually subsided in Q4. So slippages at 4.7%, that is the annualized slippage ratio, has actually surprised them positively. They expect the slippages and the credit cost to improve meaningfully going ahead. So they see visible stabilization and anticipation of normalization with respect to slippages and credit cost in H2 FY26. So growth to be led by retail and secured portfolio as well as commercial banking. So valuation at 0.6 times price to book value on a one-year forward basis appears to be inexpensive. Now we also have JP Morgan. They have an underweight rating, target price of 140 per share on RBL Bank. They say that the headline profit after tax was well below their estimate by 9% miss on their pre-provision operating profit. So that is operating profit before provisions. Credit cost could reduce in FY26. Valuations appear fair, but they think that there will be sharp improvement in return ratios, which may take some time. So they are still not, confident with respect to return ratios of the bank to improve in the coming quarters. CET1 ratio is at 12.8 to 13%. This can be interpreted that they can expect capital raising by RBL Bank, going ahead. So they expect the stock to remain range bound at lower levels. Back to you.
Thank you. Sorry.
All right. Thanks a lot for that, Abhishek. Well, Dipan, what do you think? As Abhishek says, the management believes the worst is over. But as Abhishek also reiterated, it's been a common phase. What do you think? You're going with Citi?
Nigel, no doubt it is a cheap stock. But look, it's lost market share and growth certainly has been subpar compared to its peer group. It has had its share of problems with NPAs, uncertainty around management, and now seems to be like a great turnaround candidate. So yes, I think investors looking for increasing their exposure to banks and NBFCs can consider RBL Bank, because from this point on, I think a lot of the bad news is in the price. And something which is very positive is that earnings also may start to grow. And because of uncertainties being done with, you may expect the P multiple or the price to book also start to look up. But there's one key factor that I should look out for in RBL Bank before you go a bit more aggressive, and that is how is their loan growth shaping up? Have they got the confidence and the systems and the risk management policies in place to grow the loan book, which had been lagging for so long? And second, of course, is typically the CASA ratio, which will help us understand what the confidence of the depositors is there in the company. So you can certainly look at the stock in positive light, but the real conviction will come when you see the growth rates going back to higher than industry averages.
Got that. That is RBL Bank for you. Dipan, KPIT Tech, would you be worried? I mean, it's no surprise that companies are refraining from giving a guidance and then having to change it. No one knows how this situation will play out. It's so fluid. But if you're an investor in KPIT Tech, how would you view this no guidance?
No, I think it is disappointing, no doubt about it. And all these companies like KPITF and Tata Elxsi to an extent are feeling the indirect pressure of competition from Chinese EVs. And when this can change, we can't really say. And then, sorry, the companies that they are, the customers, they're going to get impacted maximum by US tariff policies as well. So with this kind of uncertainty, and anyway, the view on software is a bit negative, I would still say that these are good levels to kind of lighten up on KPIT Tech. No doubt a great company, fabulous track record, but it's in for some bumps going forward. And as investors, I typically say, and people lot of kind of, don't like it, but investors are in a way fair weather friends. And the minute you see that there is some disturbance happening, you want to reallocate your portfolio. That's the sad truth. And, I think something similar can play out in KPIT also. And I'd like to be a bit underweight in the stock.
What about Tejas Networks, Dipan? The stock had a one-way run and it's come down as well by the elevator. Sharp fall is what we are seeing. The problem in last quarter's numbers was there were a couple of one-offs in the operational performance, but the bigger problem is the order book. That's come down dramatically. However, there is a hope that maybe, in fact, there could be a big order in the offing, but that's been the case for the last couple of weeks. How would you view the stock at around 750?
Sorry, I didn't get the
Tejas Networks.
Oh, Tejas Networks. Oh, yes. It's another company which is there on our watch list. Highly, highly volatile earnings, I would say, not just in execution, but also in when and the quantum of PLI benefits as they are booking. So I think that you keep it on your radar, look for some positive news, look for stability, execution picking up, and then maybe look at the stock more positively. But look, I think investments in all these kind of telecom networks is certainly going to improve. They haven't scratched the surface when it comes to exports as well. But the absolute dependency on government projects and related high level of debtors and all is a concern. So it's like a, kind of a mixed picture at this point of time. So it's on a watch list. I don't think I'm looking at buying it or would advise investors buying into the stock.
That is, Tejas Networks for you. The company reported a loss this time. I think some of that BSNL deal that they were executing is also running off.
Yeah.
So till they get another BharatNet kind of, tender which comes to them, you are seeing that, order book also slowly start tapering off when it comes to Tejas Network. But the stock today has taken a big, big knock. Dipan, before we let you go, the big deal of the day, M&M and SML Isuzu. M&M seems to have got a very good deal. Stock is up. But SML Isuzu, after the kind of run-up, is now backtracking a bit.
No, I read the news and I was quite delighted because as a disclosure, we have investments in M&M for our clients as well. I think it's a great fit. And this is one business which in a way have been lagging. When you think of M&M, you think about the auto, the UV business, the EV business, and the tractors. You never think about the basic commercial vehicle business. But this is a great fit. And it fills a nice void which is there in the product offering. So very positive on this development. It may not make a material difference in terms of profitability considering the size of M&M. But look, it's earnings accretive. And over a period of time, they will grow the market share. Look at M&M's track record when it has come to acquiring the tractor companies. They have acquired 2-3 tractor companies for the last several years or so. And they all have worked out very well for M&M. So I think they have a great track record in acquisition, at least domestic acquisition. The foreign ones haven't done well. Domestic acquisitions have worked out very well and eventually add a lot of shareholder value. So very positive on M&M and very happy with the deal that's taking place.
Okay, all right, Dipan, we'll let you go at that. Thanks a lot for joining in and, in fact, filling us in with your take on all of those stocks that we discussed. By the way, just keep an eye out on Bajaj Finserv. The stock in the last few minutes has suddenly slipped to the low of the day. So I think it makes sense to get up Bajaj Finserv, the stock, that's the way from the top. It's seen a little bit of a downtake. And I think the other index that slipped is the IT index. Just pull up the intraday chart out there because I'm looking at charts of, TCS, Infosys. Both of them have come down. And I think you could see a bit of a downtick that we're seeing on the IT index from the high point of the day. The Nifty Bank is still holding with 650-point gain, but the IT index has slipped into the red. Slip into that short break, come back. We'll get chatting with Nikhil Ranka of Nuvama Asset Management. Stay with us. Welcome back. Well, let's focus on, before we get to the chat actually with Mr. Ranka, let's just focus on a couple of names actually. Quest Corp is now down close to around 4%. So that stock, in fact, has slipped. And KPIT, actually, the street is still split with regard to what they've seen from the company. Because the stock did go down to around 1,200 rupees. Now, quickly, it's bounced back. So it's a fairly volatile screen that we're seeing out there. But as promised, let's get in Nikhil Ranka, CIO Equity Alternatives at Nuvama Asset Management, who joins us. Hi, Nikhil. Good afternoon. Good to see you in. It's been a while since we spoke. What's your take on the index? At around 21,700. There was good reason for you to go ahead and buy because risk reward seems favorable. Now we're around that midway market, around the 24,000 odd mark. What do you think? Will it be a slow grind up from here on, or do you think there's a possibility we go ahead and test the recent low?
So good afternoon, Nigel, and thanks for having me on the show. So the last time we had spoken, Nigel, we were very positive on the markets because the risk reward seemed extremely attractive from those points, and we were expecting a 17-18% upside on Nifty. However, after the 10% move that we have seen from the lows, two things have happened. One, if you look at it, the initial part of the earnings season have actually seen some sort of earnings come cut through. So especially in the case of IT stocks, if you look at it, there have been 3 to 4% earnings cut on the large cap IT names. And to that extent, therefore, the consensus estimate for FY27 earnings, which was closer to 1330, 1340, is now down to 1310. And therefore, our view is from here on, we probably have a single digit upside on the markets. But then you have to also keep in mind that India could be a big beneficiary of flows in the near term. So when Mr. Trump got elected and came as the president, there was a trend of dollar hardening and a lot of money shifted to US. Now we are seeing the reverse playing out. Dollar index has moved from 109 odd levels to 100 now. And because of this, there can be a trend where money starts to move out of US and get back into emerging markets. And therefore, there is some sort of push and pull between earnings and flows, if you ask me. My base case is that we will consolidate in this band of 23,800 to 24,800 for some time. And then as things pan out, we probably break out on the upside.
So Nikhil, how would you construct your portfolio now? What are the structural overweights? What are the tactical overweights? What are the sectors that you think will go through a little bit of pain, at least while we consolidate?
So good afternoon, Rima. My sense is, Rima, pharma is something that we should look up from these levels. The sector had got derated because there was this tariff issue that was there for the sector. But given the fact that India exports almost 50% of the generic requirements of US, my sense is we should not have significant tariffs that will come on pharma. And valuations still look pretty palatable for for that sector. So that's one sector that we are positive on. In the case of IT, I would say, in the near term, stocks may consolidate a bit. But if you look at and go and analyze the period of COVID, because the uncertainty at that point also was extremely high, we found a very interesting fact that even in that year, the dollar revenues of companies did not degrow or degrew for a very small amount. So, Q1, Q2 for FY21 had declines in revenues. But then as you moved into Q3 and Q4, even though they are seasonally weak furlough quarters, we saw very strong growth in those quarters. My sense is history could repeat this time around. We will have some sort of softness when companies report earnings for Q2 as well. And then Q3, Q4 could start looking a bit strong for IT companies. The point is valuations have come down meaningfully for a large number of IT companies. And on an absolute basis, because there is no balance sheet damage per se in these stocks and sectors, they may not go down much. They may time consolidate for some time. And then we will see sort of up move coming back in these stocks. Tactically, one of the sectors where we feel this quarter could be the bottom of earnings is probably the MFI sectors. The initial commentary from a lot of names also, if you hear, RBL Bank also, if you see, even though numbers were not great, the stock did have a decent move today. Because this quarter looks like the bottom for most of the MFI names, and things should improve substantially as we move in the second half of the year. So that's a tactical overweight for us.
Okay, all right, got that. Nikhil, just hold on to that thought. We have some very, very important flashes that are coming up for you on the screen. And I think you should keep an eye out there. The DFS Secretary has assured that life insurance industry on no action against bank assurance channel. Now, this is a very, very important news flow that's coming in there. And I think the most important stock should be up for you on the screen. SBI Life and HDFC Life, because they had a fair bit of exposure to the bank insurance channel. So both those two should come in there. Yash will join in to give us further details. But as of now, there's, the DFS Secretary has assured life insurance industry on no action against them. I think we'll have to wait for Yash to join in. But I think both these two stocks should be on your radar. I think, do we have Yash with us? All right, we'll try to get in. But this should be some kind of relief that's coming in. We'll try to get further details on that front. Nikhil, how are you placed on the insurance companies? Some of these companies have not given any returns. They didn't really participate in the up move, but how are you all placed on them, the insurers?
So we were a bit neutral, Nigel, on that sector, especially given the fact that when, the tax exemptions were taken away for investments amount beyond 5 lakh rupees, there was this concern that the APE growth will slow down for a lot of these companies. And we did see that trend panning out in the last 3-4 quarters where the growth for the sector had slowed down in that sense. But incrementally, I think, if all these concerns start to go away, growth can come back for the sector. And even if we have double-digit APE growth, given the fact that most of these names are trading at less than 2 times price to embedded value, there could be some upside in these names if these overhangs start to go away.
You liked oil marketing companies when we had spoken to you last time. Now, go ahead. And now what is the call on it?
So, Rima, if you actually look at the sector fundamentals from the last time we had spoken, it's actually improved. The last time we had spoken, Brent was closer to $72, $73. As we speak now, it's closer to $65, $66, and we haven't seen any price cut happening on the petrol and diesel part. So in a sense, gross marketing margins, which were closer to 9-10 rupees the last time we spoke, those have actually now moved closer to 14-15 rupees. There has been 2 rupees of export duty that has come, but notwithstanding that fact, that will go to compensate the LPG losses that these guys are doing. And even if you look at GRMs, they are midway now. They aren't as high as $8-9, which they used to be, but they are still closer to $5. So a combination of these two things, one, GRMs are at decent levels, and second, marketing margins are way above what they used to be, should mean that as we move into the next quarter, because this quarter they will have some inventory losses and therefore reported numbers may not look good. But the next quarter should be very blockbuster for a lot of these companies. And stocks are still trading at closer to 5 times EV/EBITDA on an FY27 basis. So I still feel that there could be 15 to 20% upside more in these names as we go ahead.
Okay, all right. On the back of those, that news flash that's up for you on the screen, which sources are telling our colleague Yash, the stocks that are moving to the high point of the day are, SBI Life, and that's because SBI Life has got close to around 60% of its business from the bancassurance route. So that's the reason why that one has spiked up. HDFC Life, that as well has got around 65% from the bancassurance route. So that's the reason that one has spiked up. We have ICICI Pru, which has close to around 29% of its business from bancassurance. And Max Life, that's the other one in there with more than 50% coming in from the bancassurance route. So that explains why all these stocks are now moving to the high point of the day as we speak. I think Max as well should come up for you. Max, that one has spiked up. Yeah, at the bottom of your screen, you can see all the stocks that are reacting. Well, final question, Nikhil, before we let you go, we're going to be getting Ultratech's numbers in just a while. What I understand was that the con call was earlier scheduled, it's been pushed back by close to an hour or so. But what's your view on cement amidst all these trade tariffs that we're talking about? And if you're looking at a domestic play that's guarded from it, you're going to play the capex revival theme, then cement comes into play. And also the price action for April has been fairly encouraging. Your view on cement?
So structurally, if you look at the sector, Nigel, the good thing that is happening is it's getting consolidated into 2-3 players. So we now have Ultratech with close to 200 million ton capacity. We have the Adani Group with another 150 million ton capacity. And then we have the likes of Shree, JK Cement. So my sense is, next 3-6 months, stocks can still consolidate. But if you ask me 12-15 down the lines, we are more seeing a telecom-like scenario in this sector where the pricing power will be extremely strong in the hands of the top 2-3 guys. And then, my sense is 1,000 rupees of EBITDA per ton becomes the floor for a lot of these companies. And we are potentially then looking at companies starting to do 1,300 to 1,400 rupees of EBITDA per ton on a sustained basis. And once that sort of volatility goes out in terms of the profitability and we have more steadier EBITDA per ton getting reported from these companies, the EV/EBITDA multiples for these companies should start to re-rate. So with a 12 to 24-month outlook, I think the sector holds a lot of promise and any weakness in the sector should be looked to be bought into.
Got it. Okay, all right, Nikhil, we appreciate you joining in. And, we take note of the fact that last time around you were sounding reasonably optimistic on the markets, and it worked in that favor as well. Look forward to chatting up with you rather soon. For the time being, let's slip into a short break. As we do that, well, here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18, the all-new app. Get instant access to breaking news, in-depth articles, as well as financial world updates. All of this at your fingertips. Just download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can simply scan the QR code that's up for you on the screen. Welcome back. Well, we have Ultratech's numbers that are flashing for you on the screen. On the top line, that appears it's a little bit lower than what we were working with, couple of percent points lower out there. But I think we had the EBITDA number as well. That should come up for you on the screen. The EBITDA number more or less in line, So I think it's around 1.5% to around 2% miss on the top line. That's further flown down to the EBITDA number. The street was a little bit cautious because they have a couple of assets now that have got consolidated within the entity. But for the time being, it appears it's not dragged profitability by a great deal. We'll have to wait by to see further commentary in terms of what the management has to say on the path ahead, as well as how is their debt book looking. I think we have the commentary that's to the bottom of the screen. The volume number should come up for you. Just a minute, just trying to pull out that number. Consolidated sales volume during the quarter was around 41 million tons, which is a growth of close to around 17%. And excluding the acquired assets, the EBITDA per ton actually has come in at around 1,270 rupees per ton, because some of those assets that they've acquired, well, they'll still take time to come up to speed with regard to what Ultratech is doing. So a 17% growth actually is a good number. That's something that the street was working with. Volumes, no worries on that front. On the profitability, they're saying that the energy costs have come down by close to around 14% on a year-on-year basis because of the decrease in fuel cost, which was at around 881 rupees per ton in Q4. That compares with more than 1,000 rupees in the same quarter last year. Utilization levels were around 89%. So volumes have been fairly good. Utilization levels as well have been fairly good on that front. They're saying that the expansion schedule is moving as of plan. And as of the ongoing capacity expansion, they have commissioned close to 17.4 million tons or thereabouts. So I think we have most of those flashes. I'm just trying to look forward to the management commentary. All right, that's the commentary that's coming in now. Given the government's focus on infrastructure as well as housing projects, along with the increased rural as well as urban demand, they're looking at a sustainable volume growth of around 7 to around 8%. While the sector may see some short-term challenges, they continue to say that the long term looks pretty much in step. So just to sum these numbers up for you, close to 2% miss on the top line. That's flown down to the EBITDA, in absolute terms. But the management says that X of all these acquired assets, it's still holding at around 1,270 rupees per ton. And they've got the benefit of lower power and fuel cost in the past quarter. So these numbers go in as more or less in line with what the street was working with. And the management commentary as well is fairly optimistic on the way ahead. To help us out with a quick analysis, we have Jyoti Gupta of Nirmal Bang who joins us on the phone line. Hi Jyoti, good afternoon, good to see you in. Tell us, what is your first take? These numbers appear pretty much in line with what we were working with.
Thank you, Nigel, for having me on the show. Yes, they are. Actually, I'd anticipated like a 7% YOY growth, and my Q&Q was slightly higher. And EBITDA was something like a 4,500, which I'd anticipated with 1,222 as EBITDA per ton. I think more or less some minor variation, but I think it was anticipated primarily because the plants in the north, which got a bit of an advantage from realization of almost like 160 to 180. I think more or less the numbers. And in fact, Q1 should be even better for the industry as well as Ultratech as well.
Okay, so you're satisfied with these numbers. What else will you be looking forward to in the con call that I believe has been postponed by an hour now? So you got a later evening, Jyoti. But what are the key aspects you're going to be looking forward to?
I would actually be looking more at the expansion plans and moreover and on the realization per tons, the price increases, because that's the only thing. I mean, you don't have much benefits coming from cost going forward. And of course, the petcoke prices which have increased in the fourth quarter, that reversal should happen in FY26. So which means the benefit of petcoke which we got of 4 paisa in fourth quarter, that should reverse in the FY26. So obviously should be some increase in cost as well from their side. So I look more in towards the pricing, how the price is going to look out, the market share, and overall how the volumes are going to pan out. Because FY25 we had more or less like 291 days. This year we should have roughly like 321 days, unless we have more severe rains. So overall the growth, volume growth should be 7% plus for this year, and therefore a good year for the overall industry.
Okay, all right, Jyoti, we'll let you go at that. Thanks a lot for joining in and giving us all those details. One more detail that should come up for you on the screen. They've recommended a dividend of around 75 rupees and 50 paise, which is a fairly decent number. Not a big mover for the stock, but some additional dividend is what they've given out. And the debt as of now has spiked up because of the acquisitions that they've done. and the capex that they're incurring as well. But remember, the company is throwing up a lot of cash. So we have seen in the past that the debt number is normally kept under control once these assets keep throwing up cash. So at the last reported number that I can see that they have filed, the consolidated number is around 17,667 crore rupees, which is sharply higher on a year-on-year basis. But, the street was bracing for a higher debt number as well. We'll have to watch out for the capex plan and the debt reduction plan for the remainder of this year as well. So that's about Ultratech for the time being. The stock is down close to around, I think, 1.5% or thereabouts. But the numbers more or less in line with a small miss actually on the top line. Well, let's go across to Nimesh, who's here to tell us about D Street Chatter. Nimesh, tell us what you're picking up.
Hi, Nigel. A good recovery in today's market, largely led by large cap names, including Reliance Industries. What we saw on Friday was more of a selling from HNIs, super HNIs, and a bit of unwinding of longs as well. But the institutional flow seems to be quite positive. Even in today's trade, the buys is towards positive. And sectors which are well bid includes banks, PSUs, and the defense stocks. So these are the three sectors where there is institutional flow on the buy side. Having said that, earnings and the geopolitical risk, which is still not out of the way, that's going to be a key dominant factor, at least in the near term. So that's something to watch out for. And I guess for a bit of geopolitical risk, some larger HNIs are actually raising cash levels and are trimming positions. So while institutional flow is positive, there is a bit of selling happening from the larger influential investors. While everything is good on the downside, watch out for 23,800 as a very strong support now on the downside. So that's the level to watch. But from a institutional activity point of view, the buying continues, and especially in the large cap names.
Okay, watch for 23,800 on the way down. Buying continues in large caps. What about individual stocks? What chatter have you picked up, Nimesh?
Hi, Rima. So the first stock on my list today is SpiceJet. That's been buzzing the last couple of days. The volumes have picked up. I understand there are very strong buy flows from larger HNIs in the last many days. And now there is a very strong buzz or an indication that the company is likely to raise funds via preferential issue, and some big names may come in the preferential. So that's the buzz as far as SpiceJet is concerned. The second stock, a couple of names where there is delivery-based buying, Bandhan Bank as well as in GMR Airports. GMR Airports lost 4% on Friday and has recovered most of the losses today. Bandhan Bank is still down, but there is buying, is what I understand, from large institutions into private banks, and Bandhan stands out today as far as flows are concerned. The third name is Hyundai Motors. Like what we were seeing in Maruti, there is selling pressure in Hyundai as well for the last many days. And I understand a large long-only fund has been an active seller in the last couple of days. So that's Hyundai Motors. And the last one is KPIT Tech. The earnings are today, so that's something to watch out for. But I understand there are block offers in KPIT Tech from larger institutions today. But do remember, most of the ER&D companies, after the disappointing numbers, have actually bounced on the higher. So need to see what KPIT delivers, but there are block offers from large institutions in today's market.
Got that. Nimesh, KPIT numbers were just out a while back.
Oh, I missed that.
Yeah, so Q4 was actually very strong, but just to inform you, they haven't given an FY26 guidance.
Okay.
So they've abstained from talking about putting a number to what FY26 will look like. But Q4 was strong, 3% top line growth, order book picked up by, I think, about 18-19% on a quarter-on-quarter basis. Stock is holding up with a gain of about 1%, but it's a stock which has lost 35% from its 52-week high, which was a level above 1900. But conference call is at 5:30 p.m. today, so that's going to be very, very crucial to track. Mitesh is now back with us for a few last trades for BTST. Mitesh?
I have BTST on AU Bank and UPL. AU Bank, I would recommend a BTST with a stop at 683 for targets of 700, while UPL, again, a BTST here. We'll keep a tight stop around 672 and a target of 688.
Got that. Let's move on and talk about the flashes which you could see on your screen, because it could be a major relief for life insurers. Sources tell CNBC-TV18 that the government may not take action against life insurers over the use of bank assurance channel. Yash joins in with the details he's picked up. Yash.
Well, Rima, this has been one issue which has been, scaring the industry, if I could say that, because bank assurance to a large list of listed companies contributes majorly in terms of the entire sales which they get. Now, what we've been given to understand is that just last week, life insurance CEOs had a meeting with Department of Financial Services Secretary M. Nagaraju. Of course, various things were discussed in the meeting. The company made presentations on how the persistency for the sector has been very strong, how the mis-selling numbers have been close to negligible, how the industry has emerged as a major contributor when it comes to government securities. But one big takeaway, according to our sources, that emerged out of this meeting is that the Department of Financial Services Secretary M. Nagaraju has indicated that there won't be any action when it comes to restrictions on the bank assurance channel. What we've been given to understand from our sources is that the Secretary acknowledged how bank assurance going forward will be a very, very big and an important channel when it comes to taking insurance to every household, life insurance to every household, and hence the growth in the bank assurance channel is also very important. As I said, the industry had also presented how the cases of mis-selling are near negligible, and this was the remark which was also made by the Secretary, saying that as long as these numbers do not swell up with the increase or the expansion of the bank assurance channel, then the government would not have any problem with an important channel like the bank assurance. As I said, the regulator had indicated in the past that they wanted to restrict bank assurance channel, restrict concentration of business through one channel. They would ideally want 50% of the total distribution to come from bank assurance, but with the assurance coming from the government and the acknowledgement how big this channel can be, provided that the cases of mis-selling remain restricted, it is going to be a big, big relief for the life insurance industry.
Well, Yash, and if I remember correctly, the ones that got hit the hardest were the likes of SBI Life, Max, as well as HDFC Life, right? So I think that's why we're seeing a bigger fill-up on those. If you could help us out, if you have some numbers off the cuff, I think 50 to 60% is from the bank assurance route. Is that correct?
Well, that's correct. For HDFC Life, SBI Life and Max Life, starting with highest being SBI Life, after that, Axis Max Life, and then HDFC Life get significant contribution from their bank assurance channel. And of course, these guys also have their parent banks as the major, bank assurance partner. For SBI Life, it's State Bank of India, HDFC Life, HDFC Bank, and Axis Max Life, Axis Bank as the major bank assurance partner. So of course, in that order, this is a big relief for all these companies.
Okay, all right, Yash, thanks a lot for that. Let's get in Sudeep Bandyopadhyay, Group Chairman of IndiTrade Capital, who joins us. Hi, Sudeep. Good afternoon. Good to see you, Ben. Any view on these insurance companies? As Yash says, there's a relief that's come in there. Earlier, there was a fear that they're going to be restricted on the bank assurance front. But that seems to have some kind of leeway has been given. Your view on the stocks?
Good afternoon, Nigel. I think it's definitely fantastic news for these three companies, particularly which you highlighted. SBI Life gets a significant part of their business from bank assurance channel through SBI. Same is the case for HDFC Life and Max, which gets it through Axis Bank. So this kind of news is a big relief for these companies, because building agency channel requires quite a lot of time and effort, and would have been extremely difficult for these companies to keep up the momentum, assuming there were some restrictions on bank assurance channel. So yes, big relief, and obviously market is giving a thumbs up as far as these stocks are concerned post this announcement. Of course, overall we are positive on insurance, and we do like these companies as well as LIC.
Okay, all right. Sudeep, just stay with us for a bit. Let's get to another story. Sources are telling CNBC-TV18 that the government may allow the Chinese companies to apply for the electronic components PLI scheme. Ashmit joins us to tell us what's the proposal and what's the news piece out there. Ashmit?
Well, an important development, this, especially given as how a large part of the global value chain, especially for components, rests in China. So we understand that the government has taken a decision to allow Chinese companies to partake as a part of the electronics component PLI. However, there are a number of caveats that need to be borne in mind. Chinese companies cannot come by themselves. The caveat has been spelled out very clearly by the government that the only manner in which Chinese companies can partake in this electronics component life cycle is to basically come via a JV route. They have to form a joint venture with an Indian entity. That's point number one. The second aspect is the management and control of the joint venture will have to necessarily rest with the Indian entity. So there has to be a stake of more than 51% or more as far as the Indian entity enjoys as a part of this joint venture. As far as what the Chinese shareholding could be, well, that's again an important caveat to be borne in mind. For certain specific critical components, the shareholding for Chinese entities may be allowed to go up to as high as 49%. But for the other components, the shareholding of Chinese entities could be capped at no more than 26% or 10%. These are various slabs that the Chinese companies, depending on the component, will have to work with. The other aspect which is critical is that there necessarily has to be a transfer of technology aspect. This is something that the government is very clear on, that any joint venture participation, subject to all the shareholding norms, subject to all the management and control norms, there will also need to be a transfer of technology. And fourth and finally, any investments that is being proposed by such a joint venture formed with a Chinese entity, the approval for that, the investment approval for that will not come via the automatic route. It will not be automatic. There will be approval. There will, on a case-to-case basis, the government will exercise discretion, and that approval for that FDI will have to come in via the press note 3, which was released by the DPIIT. So there will be scrutiny leveled on these entities, the way they're coming in, what the structure of the holding is, what is the nature of the transfer of technology, and only after that will the government allow for these JVs to proceed. But nonetheless, an important in-principle call being taken by the government that to encourage the local electronics component ecosystem, there is some participation that is felt is required from the Chinese counterparts. Back to you.
Okay, Ashmir, thank you very much for that. That's a big story, but lots of riders in place, so China will get a leg in. And we'll have to now wait by. I'm sure there'll be a lot of joint venture, JVs, partnership, alliances, announcements that we'll get. But this is an important story with lots of implications for India's growing electronic manufacturing space. Get into a break. On the other side, we'll chat more on the markets. Welcome back. Counting down to the close of what's been a very strong Monday, Monday's trading action. Reliance Industries has led the way, up nearly 5%. But TVS Motors is the other one you need to watch. Stock is spiking as the company has beaten street expectations. EBITDA margins at 14% is ahead of street expectations of about 11.5%. The stock is spiking, now up more than 3%. The CNBC-TV18 poll was 13.3% versus that. TVS Motors margins have come in at 14%. Bottom line has seen a surge of 75%. So margin beat and bottom line has surged for the company, and the top line growth also looks very strong, 17% up in terms of revenues and 9,550 crores. So TVS Motors clearly has been a big mover, and it's outperformed many of its peers, in terms of performance and even in terms of a stock price. The stock in the last 1 year is up close to about 40%. Bajaj Auto in the last 1 year is down nearly 10%. And Hero MotoCorp in the last 1 year is down 12%. So TVS Motors has stolen a march over some of its peers. So TVS Motors and Q4 numbers have been pretty strong. We'll await finer details on it, but prima facie looks good. But the other one, and this is the big deal actually in the automotive space, because M&M is all set to acquire a near 59% stake in SML Isuzu for 555 crore rupees, which will strengthen its position in trucks and buses. Sudarshan is here with the finer details. Sudarshan.
M&M is high in today's trade, and SML Isuzu, if you see, it's down more than 10%, or currently down 10% trade. And the reason, M&M has announced acquisition and also is going to make the open offer, and open offer price is at a 12% discount to Friday's closing price. So M&M is going to acquire nearly 44% stake from promoter, that is Sumitomo Corporation, and 15% stake from public shareholder, that is Isuzu Motors. And this total stake would worth rupees 555 crore, or say 59% stake. And apart from this, M&M is also going to come out with an open offer to acquire additional 26% stake, and for this price is fixed at rupees 1,555 per share. This is an all cash deal, and deal is expected to be completed by December 2025. So what was the objective of M&M going ahead and acquiring SML Isuzu? To expand its truck and commercial vehicle business. So in the segment of more than 3.5 ton commercial vehicle, currently M&M's market share is 3%. Post the acquisition of SML Isuzu, its market share will increase to 6%, and by FY31, it's targeting the market share to increase to in the range of 10 to 12%, and by FY36, market share should increase to more than 20%. So this was the objective. And in the last 3 years also, SML Isuzu's turnover has increased from more than rupees 900 crore to currently around rupees 2200 crore. So overall, it's very positive for M&M, and that's the reason stock is higher. But considering the open offer price, a discount of 12% to Friday's closing price, you are seeing a sharp downtick in SML Isuzu. Also, till Friday, SML Isuzu was almost 26% higher in 2025.
Thank you very much for that, Sudeep. M&M seems to be ticking all the boxes with this acquisition. Your thoughts on M&M? And if you just want to quickly add a word on TVS, I know numbers are just out.
As far as M&M is concerned, it's been our favorite four-wheeler stock. In fact, we have been preferring it over all other stocks. Tractor business is doing very well. SUV, of course, we know the story. They're doing very well, and this acquisition fits perfectly well with the way they are moving ahead. The price they're paying also is decent. I won't say they're overpaying. I think this should strengthen their automobile business even further. So I think it's all good as far as M&M is concerned. From a long-term investor's point of view, continue holding. If you want to buy for long-term, please buy even now. Absolutely no problem. As far as TVS Motor is concerned, I think fantastic set of numbers. The margin is definitely a beat, and it augurs well as far as margin is concerned. But I would be a bit cautious because the valuation is a little rich. If you compare with Bajaj, Hero, and other two-wheeler manufacturers, I think the multiple at which TVS is quoting is significantly higher. So I don't recommend a buy at this level, but definitely good set of numbers.
Okay, all right. I think for TVS Motors, what the street likes is the positive margins. But I just need to note that there could be an element of PLI as well. And that explains why actually the margins have come in relatively better. So we'll try to put that up for you on the screen. But that beat may not be as much as expected because there could be a positive impact of around 100 basis points owing to that PLI benefit. So stripped of that, actually, the margins could appear pretty much in line. So the stock initially did run away, but now it's come off from the top. So just keep an eye out on TVS Motors from being up close to around 2.5%. It's come off a little bit because there could be an element of PLI that's accounted for in this past quarter, which is bumping up the margin. So wait by on that front as well. But Sudeep, we request you to stay with us. We'll just wrap down the markets and then we'll look forward to having a chat with you on markets forward as well. The other stock I want to pull up is UltraTech Cement. Just pull up the intraday chart actually. If we could see, the stock initially did see a bit of a knee-jerk reaction, but then in fact it did recover some of those losses. So UltraTech Cement is still down close to around 0.8%, but it was down close to around 2% or thereabouts. It was a day that belonged to the big boy Reliance Industries. That one led the way. A contribution chart will tell you Reliance Industries and the banking names. That's what accounted for almost all of the gains in today's trade. And the important point is the Nifty Bank today made a higher high after the last few trading sessions. A couple of global facing themes as well. You had Sun Pharma, JSW Steel, as well as Tata Steel. They went home with gains. And Mahindra & Mahindra as well as SML Isuzu, both of them did they did that big deal over the weekend. The street likes it for Mahindra & Mahindra because they'll gain market share. But for SML Isuzu, it seems shareholders wanted a higher price. So that got slammed 10% out.
Indeed, the open offer price is disappointed, especially given the way the stock ran up in anticipation of this deal. Let's talk about the mid-cap action. Very strong mid-cap index going home and closing with a gain of 1.6%. Good advanced decline ratio. Not a roaring advanced decline ratio, but about 1,400 stocks advancing to 1,200 declining. Okay, quick word on the gainers. RBL Bank, DCB, both up close to about 9 to 10%. Defense shipbuilding stocks had a field day. Garden Reach Shipbuilders up nearly 8%. We spoke about BEL in the frontline pack. So defense is a pack. If you have to look at the sectoral gainers, it was largely defense. Other than that, you had, IGL deserves mention. So that was up nearly 4%. Sonata Software won a deal. I think a little more than $70 million. Its second largest deal win ever, and that stock was higher in trade. On the way down, L&T Finance weak, M&M Financial weak, and Tejas Networks, 13% gone on Tejas Networks, and even Ramkrishna Forging, where there are some discrepancies, so the street doesn't like it. That brings us to a close on Monday's trade. The Nifty closes above 24,300, a gain of 1.2%. Don't go anywhere. We're going to just get into a short break. We'll wrap closing bell, but we'll come back with Markets Forward. A positive start to the week for Dalal Street as it ends firmly in the green. The Nifty and the Sensex gain over a percentage each, with mid-caps taking the lead. Oil and gas stocks climb over 3%. IT index was under pressure.
Reliance Industries puts up a resilient show despite the headwinds in the O2C business. Streamlined retail operations, strong geo performance, and FMCG expansion are the key positives. Analysts lift their target prices for the stock on the strong show. Stocks of Reliance up close to around 5% in today's session.
M&M is set to buy 59% in CV maker SML Isuzu from Sumitomo and Isuzu. This is to be followed by an open offer to the public. Mahindra Group CEO Anish Shah says the blended deal valuation is fair and hopes to scale the business to 20% market share in a decade. Mahindra & Mahindra stock gains in trade. SML Isuzu hits a lower circuit post the announcement.
Hello and welcome to a fresh new edition of Markets Forward, your go-to show where we aim to get you up to speed with regard to today's trading action and set you up for tomorrow as well. I'm Nigel and with me is Rima. Hey Rima.
Hi, what a good trading session, right, today. So it's a fabulous start to the week. So, what are your thoughts?
Well, that's right, Rima. We started the week on a positive note and we erased any kind of pain that we saw on Friday. Intraday on Friday, we did see a bit of a recovery. And today's trading session, we recovered all the losses on Friday, which is good news. What led the way? The big names. Reliance Industries, that found its form in today's trade and that stock really led the way. And giving it company on the upside was the Nifty Bank. Nifty Bank went through a phase of consolidation in the past week, but today it was back and all cylinders blazing in trade. And what it did today was it made a higher high. That's something was missing in the last few trading sessions. The advanced decline ratio, well, that was pretty much even Stevens by the time we wound up. So you pull up the crisscross lines, you'll see that you had way more number of stocks advancing than declining. But towards the end of trade, they were pretty much, in step with each other. But from the broader markets, there were plenty of movers. What's the way ahead, though? That's going to be most important from here on. You'll have to say the Nifty still appears to be in a bit of a range. 23,800 mark on the downside, 24,500 on the upside. So that appears that the 600-700 point range that we are in. All eyes are going to be on two factors. One is any kind of resolution or any kind of negotiation that actually results in a deal on Trump's tariffs. An eye on the border because, things are still very, very tensed out there. The Nifty resistance, that's Nifty Bank resistance at around 56,000 odd mark. That's the level from where we pulled back last week. So the Nifty Bank needs to get past the 56,000 to give the bulls further hope that we can drive higher. Rima.
Okay, and Reliance Industries was the big star in today's trade, providing bulls that much needed anchor to drive home gains. Here's what we've lined up for you on our show today. We start with the top movers and shakers. Hormus joins in. The stock of the day is Ultratech. It reported their Q4 numbers. Reliance Industries after the 5% up move post Q4. And M&M after its acquisition of more than 50% stake in SML Isuzu. And then, as always, we'll prep you up for tomorrow with the key market events. But first up, a complete roundup of today's big movers. Hormus Patakia is now at the big wall. Hormus.
Earnings. Plenty of reactions and numbers coming in thick and fast, predominantly in the second half of the day. But the star of the show today was undoubtedly Reliance Industries. 5.5% higher, the biggest single day gain in 10 months for the stock and a key contributor to the Nifty upside. KPIT Tech is not a big reaction, but it gave up gains of as much as 4% after its results because it did not offer guidance for the year, eventually ending higher in today by the close of the session. And RBL Bank was the surprise package, 10% higher in today's session, but the one that did not have a very good day was Tejas Networks. Continued to make lows as the session went by, eventually ending lower by 13%, and Shriram Finance too ending in the red. A pocket that shone through the day was the defense space, and for obvious reasons as well. Paras Defense ending 10% higher, and actually almost all of these names anywhere between 5 to 10% in today's trading session. Now there are plenty of other newsmakers as well. Sonata Software, after the deal win that it announced earlier in the morning, ending 7% higher. Ramkrishna Forgings recovered from the lows but still ended 5% lower. Whirlpool continues to build on those gains, and Credit Access Grameen, of course, with the latest surrounding the MFI space, ending 2% lower. And the pharma sector was another one that did well today. Large cap pharma, mid cap pharma, every one saw healthy gains in today's session, anywhere between 2 to 3%, and Sun Pharma too among the top gainers on the Nifty. And lastly, some stocks that did not do very well in today's session included the likes of Sterling and Wilson. Chola Finance continues to drop, as does 5-Star Business, and Jubilant Ingravia too, seeing losses of around 3.5%. Back to you guys.
Okay, all right. Thanks a lot for that, Hormuz. Well, let's go across to our guests. We have Jay Thakkar of ICICI Securities and Sudeep Bandyopadhyay of IndiTrade Capital, who join us on the show. Hi, gentlemen. Thanks a lot for joining in. Jay, you go first. How do you read today's trading action? You know, there were calls that maybe, in fact, we could pull back a little bit. It seems the bears got fooled going by the first day action of the new series. We pulled back a little bit in Friday, but today we made all of that up. Where do you see the Nifty headed?
Good afternoon to you, Nigel. Well, see, as far as the Nifty is concerned, we definitely have seen a very strong run-up coming, right from 21,750 approximately levels. We did see some, profit booking coming in, or some, dip on last Friday, that is the last trading session. But then today again, we saw that up move continuing. So we are seeing good trend from the FII side as well. Continues on the cash segment. Almost like 8 days of consecutive buying we have seen there. And 23,800, I think that is a very critical level going forward in the near term, Nigel. I mean, till those levels are held, I think overall trend remains positive. The bank Nifty is already positive. We are seeing a good momentum in the entire BFSI. Last couple of days, definitely, we have seen some profit booking coming in the NBFC space, maybe Chola, Shriram Finance or other stocks. But then overall banking back is doing quite well and is likely to continue. I mean, it's likely to inch towards 56,000, 56,500, led by the private sector banks, which are the heavyweights. This will help Nifty to move higher, as well as Reliance, the kind of breakout which we have seen today. I think in the near term, it's unlikely to move below 1,300 now, and it's inching towards 1,450. That would also help Nifty to inch higher. So our short-term target on Nifty would be 24,500, and beyond that it would be 24,800. That would be our ultimate target, at least for the May series. And the trend will be positive, Nigel, until 23,800 levels are held. Of course, we may see volatility, going forward in this series, but then the trend would be continuing to be bullish. The broader markets have been positive so far, have underperformed the Nifty, but then are also likely to participate going forward.
Okay, all right. Thanks for that, Jay. Well, let's focus on a couple of numbers that we got today, and some industry-facing numbers that we had. Ultratech, that's the leader in the pack, and that reported its said today. And the numbers, in fact, appear pretty much in line. On the revenues, there was a bit of a miss that we saw in comparison to what our poll threw up, and also that flowed down into the EBITDA number. But it appears more or less the numbers were in line. What was positive was that the overall volumes are up by close to around 17%, and that's something the street was working with, the range of around 15 to around 19%. Remember, they have inorganic growth that's factored in there as well. Kesoram Industries, as well as your India Cements that are factored into those numbers. The grey cement realizations on a sequential basis were up by close to around 1.5%. That's heartening because a couple of names, cement majors, they had reported a bit of a flattish number, which was disappointing. But now you have realizations that have improved on a sequential basis. And from this quarter, that's quarter one FY26 onwards, it'll look up as well. A small sweetener that came in was they've recommended a dividend of around 77 rupees and 50 paise. Management commentary continues to be positive in the longer term, though they note that in the near term, there could be some kind of headwinds that they will face. Sudeep, quick comment on Ultratech and the cement pack?
I'm very positive on cement pack for quite some time. The trade-related challenges in the global market doesn't affect cement. It's a very localized business. And we have seen cost optimization happening by most of the cement companies. Petcoke prices may go up and costs may go up a bit going forward. But by and large, the costs have been optimized. So future, we have to keep focusing on pricing and volume. These are the two things which will determine how the industry moves forward. Considering the amount of capex which the government of India is committed to make, and the kind of building a boom, infrastructure boom which we are seeing around us, I think cement has a fantastic future in the next 12 to 24 months. As far as Ultratech is concerned, definitely the industry leader with the largest capacity and continuing, their effort of greenfield, brownfield, as well as acquisitions. So I think it's going to be good for Ultratech going forward. So from a long-term investor's point of view, definitely Ultratech should be in their portfolio.
Let's talk about Reliance Industries then, right? That's, in fact, it led the entire oil and gas sector higher by nearly 3%, with Reliance Industries gaining 5%. Two key positives. One, actually three of them. One, Reliance Retail's acceleration, 16% top-line growth, 14% EBITDA growth. Oil to chemicals was subdued, but ahead of street expectations. And the third one was new energy. The new energy is finally, getting kick-started and commissioned. The company has a gigawatt solar capacity solar module capacity that, they announced. So the street likes the action over there. The other businesses were steady, particularly Reliance Jio. Subscriber ads were there. The ARPUs have now inched up to 206. But the kicker was Reliance Retail and anticipation of new energy and what those plans will unfold. Brokerages are bullish. Nomura says it's the top pick in the energy sector. Morgan Stanley and JP Morgan are overweight on Reliance Industries. And also remember, now Reliance Industries has a net worth of more than 10 lakh crore rupees. So it continues to scale. New milestone as India's largest, company. Jay, have you seen a bit of a breakout in Reliance? Because today it crossed the 200-day moving average on the way up.
Rima, in fact, the stock has technically provided a breakout from an expanding triangular pattern, which is also called as a broadening pattern. So I believe that now until the 1300 levels aren't broken on the downside, the trend remains continuously positive now from here on. In fact, we have seen good short covering coming in this stock as well, because this was one stock, Rima, wherein there was good amount of short build up to an extent wherein the open interest had gone to its lifetime high. And now the OI has started coming down, despite, we saw a couple of times Reliance breaking its previous low, but then, we didn't see additions of the shorts. In fact, rather there was more of covering. And now since, it has given a breakout, today there was a clear unwinding in the call options as well, and technically it has provided a breakout. So I see that 1450 should be the level to watch out for from here on in Reliance or in May series itself. Although we have a 1400 strike wherein there is good amount of call base, but nevertheless, I think overall trend has turned positive for Reliance definitely. So if at all there is any dip towards say 1340, 1330, if at all, then it definitely should be utilized as a buying opportunity. My target remains intact of 1450.
Okay, let's focus on the big deal that was announced over the weekend. Auto giant Mahindra & Mahindra is set to acquire 59% stake in SML Isuzu for around 555 crores to strengthen its position in trucks and the buses segment. Shares of Mahindra & Mahindra, well, they gained on the back of this development, but SML Isuzu hit lower circuit and there was no exit from the start of trade. Sudarshan joins us to fill us in with the contours of that deal.
So as you have said, M&M in today's trade was up more than 2%, while SML Isuzu has slipped more than 10%. And it's on the back of deal announcement. M&M has announced that it's going to acquire 59% stake, or say nearly 59% stake, for rupees 555 crore. Of total 59% stake, 43.96% stake will be acquired from promoter, that is Sumitomo Corporation, and another 15% stake will be acquired from the public shareholder, that is Isuzu Motors. And this acquisition will be done at a price of rupees 650 per share. But now come to the open offer. M&M also going to make an open offer to acquire additional 26% stake, and for this open offer price is at rupees 1555 per share, which was at a 12% discount to Friday's closing price. Now, why M&M is going ahead and doing this deal, basically acquiring SML Isuzu? The objective is to expand its truck and CV segment, especially in the segment of more than 3.5-ton commercial vehicle, in which currently M&M holds market share of almost 3%, and it believes that post the acquisition of SML Isuzu, its market share will double to 6%, and now it's targeting market share in the range of 10 to 12% by FY31, and in the range of 20 to 22%, or say more than 20% by FY36. Even SML Isuzu's turnover, if you look at over the last 3 years, in FY22, its turnover was around 954 crore. Now it's almost reached 2,200 crore. So it has been seeing an increase on a continuous basis. Let's listen in what Anisha had to say on this deal.
I would just say that it's a fair valuation for all concerned. And for us, we've always followed a very structured process in terms of focusing on certain businesses, investing where it makes sense. And it made sense for us to invest at this value because we feel that from here we can grow the business and deliver returns for our shareholders, which is a very important aspect in how we look at this. And therefore, a blended value is what we really saw. That's what we're finally investing. And on that basis, we feel that it's a fair and appealing deal, which has a very good strategic fit as well. We feel that it is important for this to stay as a listed entity and be able to compete in its segment effectively. We're in a strong leadership position in almost all the segments we play in today. SUVs, we've gone from a 12% to a 23% market share. And we don't really play in all the SUV segments as yet. Despite that, we're at 23% market share. In tractors, we've gone from a 38, 39% to 43, 44% now. In electric three-wheelers, which is a space where we really had a small business in ICE three-wheelers at a 7-8% share, we are now at a 43% share. We will leverage what we have in the business today because we are in a growth mode. This is not an acquisition about a cost rationalization. This is an acquisition to help us broaden the footprint to go bigger on growth. And that's where the dealership footprint that exists in SML Isuzu will be a very meaningful one for us.
Okay, that's Mahindra Group's Anish Shah talking about the acquisition. Sudeep, you did tell us earlier that M&M is a stock that you like very much, and this deal seems to be ticking all the boxes. Any other picks in the auto pack, or is M&M the stock to own?
Well, M&M definitely is a stock to own, but if somebody is looking at picking up something else in the entire auto pack, I will still probably go to Maruti. I know the numbers were not great, and the commentary wasn't also. But I think considering what's happening, considering the tax break which the middle class really got, I definitely expect demand for small cars to come back. And what Mr. Bhargav was complaining about, probably will see a turnaround in that and the demand coming back. So Maruti, considering the kind of network they have, the kind of presence they have, kind of models they have, definitely will benefit when demand comes back in the small car segment. So I will go for Maruti as the second pick in the automobile segment.
Okay, all right. Jay, what about you? How are they looking on the charts? Mahindra and Mahindra, it went to that 3,200 odd mark, I recall. Then it pulled back to 2,500. The fears that maybe Tesla is coming in and the likes. But now it's bouncing back. Where's the resistance level?
Well, I would say, Nigel, that yes, I also agree that, M&M relatively in the entire auto pack is looking definitely positive. I mean, see, FIs have reduced their position in the auto, mainly in two-wheelers, that is Bajaj Auto and Hero MotoCorp, to the tune of 2 to 2.7%, Nigel. And M&M, they have not reduced that much. In fact, Ashok Leyland and M&M, these are the two stocks which I like as far as the overall four-wheeler pack is concerned, whether it is passenger vehicle or CVs. But I think that these are the two stocks which are likely to perform well. Maruti is likely to trade within a range. I think, we didn't see much that great results as well. But then M&M is likely to inch towards the levels of 3,200 or maybe beyond. Going forward, maybe even for that matter, 3,500. The overall product mix or the product portfolio is also quite good, and I think it's quite competitive. And the overall F&O derivatives data also, if you see, Nigel, then there has been a long build-up out here relative to other four-wheelers or CV segment stocks. So I think this is clear-cut winner going forward. Definitely 3,200 to 3,500 levels could be seen. The only thing is that on the lower side, 2,500 is a very critical support, Nigel. And until those levels are held, the trend should be positive.
Sudeep and Jay, thank you very much for joining us. With that, it's time for a short break. We'll get you the key market events to watch on the other side. Welcome back. Automaker Maruti, which holds a significant share in India's passenger vehicle segment, has raised concerns about growth. Speaking to CNBC-TV18, Chairman R.C. Bhargav said sales have declined, particularly in the entry-level segment, as consumers in the lower income brackets are delaying purchases due to rising car prices. Further, he believes the tax cuts announced in the budget, it's unlikely to stimulate sales, at least at the entry level. Listen in.
The demand has been falling for the last many years. If you look at the small car market, or let me go beyond that. If you look at the household income distribution in India, 200 million out of 300 million households are below 5 lakhs in income. The people in this lower income households, and they comprise the bulk of the Indians, were suddenly faced with sharply rising costs of small cars, largely because of regulatory requirements and the cost of meeting those requirements, partly because of commodity prices and other things. But overall, the prices have gone up very sharply. And so they have dropped out of the market. The projections made by SIAM on the auto industry for 25-26 do not show a better picture than 24-25. Last year, we grew at about 3%. The forecast made by SIAM is 1 to 2%. So the domestic demand is not growing beyond what it has been in the past, maybe falling a little bit. Where we see a silver lining is that our exports are going to grow. We grew exports at 17% last year. We expect that exports this year may grow at about 20% this year. So that is going to make up a lot of what may or may not happen.
Well, and before we wrap up on the show, let's bring you all the key market expectations you need to watch for tomorrow's trade. Ria joins us to fill us in with the key events. Ria?
Well, yes, let's take a look at the key events to watch out for tomorrow. In the US, we have the consumer confidence and the JOLTS data coming out, as well as the advanced economic indicators report. For China, we have the manufacturing PMI data coming out, and the Japanese markets will remain closed tomorrow on account of a national holiday. Back home in India, we have a lot of Q4 numbers to watch out for. We have Ambuja Cements, Bajaj Finserv, Bajaj Finance, BPCL, Trent and Schaeffler India coming out with their Q4 numbers tomorrow. We also have two board meetings. Bajaj Finance will consider a stock split and a bonus issue, and NTPC Green will consider a fundraise of up to rupees 5,000 crores.
Thank you, Ria, for that. And that brings us to a close in this edition of Markets Forward. Thank you very much for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we are tracking this evening. India accuses Pakistan of violating the ceasefire at the line of control for the fourth straight day. Indian Army says it responded swiftly and effectively. Defence Minister Rajnath Singh to brief Prime Minister Narendra Modi. Sensex and Nifty reclaim Friday's losses to hit a 4-month high. Nifty moves back above 24,300. Reliance Industries contributes nearly 40% to Nifty's gains. M&M expands its commercial vehicle portfolio, will acquire 59% stake in SML Isuzu for 555 crore rupees. M&M will make an open offer to acquire another 26% at over 1,550 rupees a share. Maruti Suzuki chairman R.C. Bhargava says 88% of Indian households cannot afford to buy even a small car, blames regulatory measures and rising commodity cost for the sharp rise in car prices in the last 5 years. A dire warning from Bajaj as China plans to curb the export of rare earth magnets. Bajaj says the entire electric vehicle industry in India will come to a grinding halt if China halts the exports. That's a money control exclusive. Government likely to allow Chinese companies to apply for the production-linked incentive scheme for electronic components provided they partner with Indian companies. Sources say shareholding of Chinese companies in joint ventures will be restricted to 10 or 26% or 49% depending on the sensitivity of the sector.
It's happening at a great pace. So let's say that by 2028, we'll be able to travel in the bullet train.
Maharashtra Chief Minister Devendra Fadnavis promises a bullet train by 2028, staying firm on the stated target. Also targets a port and airport on the outskirts of Mumbai in 3 to 4 years, says $100 billion in infra financing has been tied up. That's an exclusive. Yemen's Houthis accuse the United States of bombing a migrant detention facility, killing 68 people. US military is yet to respond. Israeli attacks on Gaza leave 23 people dead in the last 24 hours. Donald Trump's approval ratings dip as he nears 100 days in office. As per 3 polls, Trump's rating hovers between 39% and 45%. This is the lowest 100-day rating for any US president in nearly 8 decades. Canada heads to parliamentary elections in what looks set to be a race to the finish for the incumbent Liberal Party headed by Mark Carney and the Conservative Party headed by Pierre Poilievre. Trump's tariff war and his barbs about marking Canada USA's 51st state have emerged as key election issues. Pre-poll ratings give Carney the edge. Supreme Court agrees to hear pleas seeking regulation of so-called obscene content on OTT platforms and social media. Government says content on some of the OTT platforms are not just obscene but perverse. The apex court issues notices to the centre along with Netflix, Amazon, Google, Meta, Apple, among others. The top story this evening, tensions between India and Pakistan continue to rise following the Pahalgam terror attack that killed 26 civilians. The Indian Army has accused Pakistan of violating the ceasefire at the line of control in Jammu and Kashmir for the 4th straight day. The Indian Army said that it responded swiftly and effectively after Pakistan Army posts initiated unprovoked small arms fire overnight near Kupwara and Poonch districts. Defence Minister Rajnath Singh visited Prime Minister Modi's residence to brief him about security preparedness post the attack on April 22nd. Singh had met the Chief of Defence Staff, General Anil Chauhan, yesterday. Meanwhile, search operations are still underway to track down the terrorists who perpetrated the attack on tourists in Pahalgam last Tuesday. The Jammu and Kashmir Assembly moved a resolution condemning the terror attack and expressing solidarity with the victims. During the special session, Chief Minister Omar Abdullah said he will not cite the attack to push for the restoration of statehood.
जम्मू कश्मीर की सिक्योरिटी जम्मू कश्मीर के इलेक्टेड हुकूमत की फिलहाल जिम्मेदारी नहीं है, लेकिन मैं ये मौका इस्तेमाल करके स्टेटहुड की मांग नहीं करूंगा। अब मैं किस मुंह से इस पहलगाम के वाकये को इस्तेमाल करके मरकज से कहूँ कि अब मुझे स्टेटहुड दो। मेरी क्या इतनी सस्ती सियासत है? मुझे क्या इन 26 लोगों के मरने की इतनी कम कदर है?
All right, on to the day's trading action. The Wall Street regained all of its Friday's losses, with the Nifty reclaiming the 24,300 mark. Reliance contributed nearly 40% to Nifty's up move. The broader markets outperformed the blue chips. Nifty Bank and Nifty Mid-Cap indices gained over 1.5%. Nigel D'Souza is here with the day's market action. Nigel.
Well, it was a good start to the week for the Nifty. The Nifty managed to pull back most of the losses that we saw on Friday and, in fact, ended towards the high end of the day. What led the Nifty higher today? You had banks as well as Reliance Industries. They were the ones that led the way. The advance decline ratio, well, pretty much even Steven. For most of the trading session, you had high number of stocks that were advancing, but towards the end of the day, you had them coming closer to each other. The big deal that was announced over the weekend was Mahindra. They have gone ahead and they bought stake in SML Isuzu. So the stock reactions were such that for Mahindra and Mahindra, they're increasing their market share and they have a vision to go ahead and further increase their market share in that particular segment. While for SML Isuzu, it appeared that most of those shareholders were expecting a better price, and that's why that stock didn't react very, very favorably. Look into a couple of stocks then that will give you a sense about how the economy is shaping up. One is Maruti and the other one is Ultratech. Maruti, their commentary was a little bit cautious with regard to some slowdown, but the stock price actually ignored that because it ended higher in today's trading session. Even Ultratech, the numbers were more or less in line, and they're saying there could be some kind of bouts of short-term volatility, but in the longer term, they're expecting steady growth. The other big movers today were from the BFSI space. Shriram Finance, asset quality was a bit of an issue. The growth as well, not as much as expected. So that stock pulled back more than 10% in the last two sessions. RBL Bank, some part of the street believes the worst is over. The numbers were encouraging. And Citi is quite positive on the stock. While L&T Finance Holdings, well, out there, the dispersals were weak. You had the gross NPAs that were the highest that we saw in the last 7 quarters or so. So that one came in for a hard knock. Other big winners from the broader markets, you had Sonata Software. They secured a $70 million deal. Street like that. Tejas Networks, the results were weak, and also the order book did see a bit of a downtick out there. So that's why that stock was under pressure. And Ramkrishna Forgings, well, there were discrepancies in certain inventory levels out there. So that's why that stock ended lower. What's the way ahead? All eyes are on Trump's tariffs. Can there be some negotiations that take place? That's going to be important. An eye on the border as well with regard to geopolitical issues. So we'll have to keep an eye out on that. And keep in mind, the Nifty appears it's still in a bit of a range. 23,800 to around 24,500. That appears to be the range. The Nifty Bank holds the key. That led the way today. 56,000 is the crucial resistance mark.
Right, thank you, Nigel, for that. In the commodity market, oil prices edged higher, but uncertainty over US-China trade talks kept gains in check. Concerns over global growth and fuel demand weighed on the market. The possibility of OPEC Plus boosting supply added more pressure. Meanwhile, gold prices declined by over 1% as global equity markets claw back post the sell-off last week. China's foreign ministry has reiterated that the country's president Xi Jinping and US President Donald Trump did not have a call recently. A ministry spokesperson maintained that the two countries have not had any negotiations on tariffs. President Trump's assertion was not backed by US Treasury Secretary Scott Bessent either. He said that he did not know if the US president spoke to Chinese president. The comments come in response to Trump's claim in an interview with Time magazine that the Chinese leader had called him. However, Trump refused to comment if he had spoken to Xi Jinping after the tariffs were implemented.
You said you spoke with President Xi. Have you spoken to him since the tariffs? When did you last speak with him?
I don't want to comment on that, but I've spoken to him many times.
Chinese fast fashion giant Shein has hiked its US prices for US customers ahead of the 2nd of May, when its decades-old rule that allowed imports under $800 to skip duties comes to an end. As per Bloomberg, the price increases, which are as high as 377%, began on the 25th of April. The average price for top 100 products in beauty and health category have risen by 51%. The average jump in the product prices was more than 30%, with many doubling in price. Back home, M&M has expanded its commercial vehicle portfolio. The automaker will acquire 59% stake in SML Isuzu for 555 crore rupees. M&M shares gained 2% following the announcement, while shares of SML Isuzu slumped nearly 10%. Sudarshan Kumar is here with more on the details.
M&M is high in today's trade, and SML Isuzu, if you see, it's down more than 10%, or currently down 10% trade. And the reason, M&M has announced acquisition and also is going to make the open offer, and open offer price is at a 12% discount to Friday's closing price. So M&M is going to acquire nearly 44% stake from promoter, that is Sumitomo Corporation, and 15% stake from public shareholder, that is Isuzu Motors. And this total stake would worth rupees 555 crore, or say 59% stake. And apart from this, M&M is also going to come out with an open offer to acquire additional 26% stake, and for this price is fixed at rupees 1,555 per share. This is an all cash deal, and deal is expected to be completed by December 2025. So what was the objective of M&M going ahead and acquiring SML Isuzu? To expand its truck and commercial vehicle business. So in the segment of more than 3.5 ton commercial vehicle, currently M&M's market share is 3%. Post the acquisition of SML Isuzu, its market share will increase to 6%, and by FY31, it's targeting the market share to increase to in the range of 10 to 12%, and by FY36, market share should increase to more than 20%. So this was the objective. And in the last 3 years also, SML Isuzu's turnover has increased from more than rupees 900 crore to currently around rupees 2200 crore. So overall, it's very positive for M&M, and that's the reason stock is higher. But considering the open offer price, a discount of 12% to Friday's closing price, you are seeing a sharp downtick in SML Isuzu. Also, till Friday, SML Isuzu was almost 26% higher in 2025.
Right, thank you, Sudarshan, for that. Staying with the stake acquisition, Mahindra Group CEO and MD Anish Shah said that SML Isuzu will continue as a listed entity even after the deal is completed. Speaking with CNBC-TV18's Shireen Bhan, he added that the acquisition is based on fair valuation for all entities.
I would just say that it's a fair valuation for all concerned. And for us, we've always followed a very structured process in terms of focusing on certain businesses, investing where it makes sense. And it made sense for us to invest at this value because we feel that from here we can grow the business and deliver returns for our shareholders, which is a very important aspect in how we look at this. And therefore, a blended value is what we really saw. That's what we're finally investing. And on that basis, we feel that it's a fair and appealing deal, which has a very good strategic fit as well. We feel that it is important for this to stay as a listed entity and be able to compete in its segment effectively.
Maruti Suzuki chairman R.C. Bhargava said in the company's earnings call that 88% of Indian households cannot afford to buy even a small car. Speaking to CNBC-TV18, Bhargava blamed regulatory measures and rising commodity costs for the sharp increase in car prices in the last 5 years.
The demand has been falling for the last many years. If you look at the small car market, or let me go beyond that. If you look at the household income distribution in India, 200 million out of 300 million households are below 5 lakhs in income. The people in this lower income households, and they comprise the bulk of the Indians, were suddenly faced with sharply rising costs of small cars, largely because of regulatory requirements and the cost of meeting those requirements, partly because of commodity prices and other things. But overall, the prices have gone up very sharply. And so they have dropped out of the market.
The newly imposed US tariffs on automobiles and auto parts could impact the revenue of Indian auto component exporters by 2,700 to 4,500 crore rupees, according to a report by ratings agency ICRA. Exports to the US are expected to decline by mid to high single digits in FY26. The study also estimates that new tariffs could add around 9,000 crore rupees in incremental costs across the supply chain. The tariff war between the US and China could pose a significant challenge for electric vehicle makers across the world, including India. Now, China is planning to ban the export of rare earth magnets, which are crucial to EVs. Speaking with Lata Venkatesh, Bajaj Auto's chairman Rajiv Bajaj warned the industry will come to a grinding halt if China bans the export of these magnets.
As of yesterday, I still have to verify this, but I was given to believe that suddenly China has decided not to permit the export of heavy rare earth magnets, which are used in motors of electric vehicles. And as you know, that for some of these EV components, the whole supply chain of the world resides in China.
Exactly.
So if this is true, we are still trying to come to terms with the facts, all the facts. But if this is true, it would mean that, and if it doesn't change, then in a matter of weeks, the entire Indian EV industry will grind to a halt.
All right, in earnings corner, shares of TVS Motor ended over 2% higher after its fourth quarter earnings beat estimates on all parameters. Net profit jumped by 75% on a yearly basis to 852 crore rupees, while revenue also saw double-digit growth. TVS Motor posted EBITDA of 1,330 crore rupees and a margin of 14%. Both were much higher than what the street anticipated. Ultratech Cement delivered a largely in-line performance in the fourth quarter. Net profit was marginally below estimates despite growing 10% compared to last year. Revenue also fell short of expectations, growing 13% year-on-year. Margins, which stood at 20%, were in line with estimates. The company recommended a dividend of 77.5 rupees a share. Well, India is likely to allow Chinese firms to invest under the electronics component PLI. However, according to sources, this can be done only through joint ventures with Indian firms. That's not all. In all cases, the management and control of the JV will have to remain with the Indian entity. Ashmit Kumar is here with the details. Ashmit, what are you picking up?
Well, an important decision this as far as the electronics component PLI is concerned. Bear in mind that a large part of the global value chain rests in China. Therefore, a long-term decision being taken by the government that, yes, Chinese entities will be allowed to partake as a part of this electronics component PLI scheme, but it is subject to a number of riders. Number one, the first rider is that these Chinese entities cannot come by themselves. They necessarily have to come in. The only route possible is through a joint venture or a JV route, and that JV has to be done with an Indian entity. Number one. Number two, the management and control of this joint venture will necessarily have to rest with the Indian entity. So the Indian entity will need to have a 51% shareholding or higher. What the government is thinking about is that for certain critical components, it will be willing to allow a Chinese shareholding of 49%, but for other components, the shareholding of the Chinese entity will be capped at about 26% or 10%. These are various slabs depending on the criticality and the sensitivity of the component at hand. Number three, with respect to as far as transfer of technology is concerned, the government is very clear that any such JV that will be sailing through for the PLI scheme will happen only and only if there's a transfer of technology clause. The government wants the technology to flow from the Chinese companies to the Indian counterparts. And fourthly and finally, only because there is compliance with these three aspects does not translate into an automatic approval. The government is quite clear that any FDI that's coming in via these Chinese entities will be subject to heavy scrutiny. The approval, if any, the discretion will lie completely with the government. The approval, if any, if it comes, will be happening under the press note 3 that was issued by the DPIIT. So clearly the government taking a longer term view, willing to allow the Chinese entities to come on board the PLI scheme, but subject to heavy scrutiny by the centre.
Right, thank you, Ashmit, for that. India has signed a 63,000 crore rupee deal to buy 26 Rafale M fighter jets from France. The agreement includes 22 single-seater Rafale M jets and 4 twin-seater trainers. Deliveries will begin in a few years and are expected to be completed by 2031. The Rafale M jets will operate from INS Vikrant and INS Vikramaditya, replacing the MiG-29K fleet. All right, it's time for a short break. Coming up next, Maharashtra's Chief Minister Devendra Fadnavis promises a bullet train by 2028, staying firm on the target. More details when we return. The Mumbai-Ahmedabad bullet train project will be completed by 2028. That's the word coming in from Maharashtra Chief Minister Devendra Fadnavis. In a chat with Shireen Bhan at the India Middle East Europe Economic Corridor Summit, Fadnavis revealed that the Vadhvam port in Palghar district will be functional in 3 to 4 years. He also said that Maharashtra will be at the forefront to welcome Elon Musk and Tesla.
Bullet train will bring you to BKC in 20-25 minutes, and this road will bring you to Mumbai in 40-45 minutes.
The question is, when will it bring us to BKC in 45 minutes?
See, that is also not very far, because, you see, unfortunately, sometimes politics is very cruel, and between 2020 and 2022, when there was some other government in Maharashtra, they actually literally scrapped the bullet train. But once we took over again, we started it afresh, and today I can tell you that every bit of work of bullet train is being taken up, and it's happening at a great pace. So let's say that by 2028, we'll be able to travel in the bullet train. Vadhvan is a game-changer port. And you see, today, the biggest port of India is the JNPT port. It accounts for 60 to 65% of the container traffic. And this Vadhvan port is 3 times bigger than JNPT. That will make, this port-led development expand to 17 districts of Maharashtra. Next 3 to 4 years, we'll start the operations of Vadhvan.
Is Maharashtra going to be part of Elon Musk's plan for India?
That only Elon Musk can tell, but I hope we should be, and we'll always try, we'll always compete, we'll always be, at forefront to welcome them.
Your colleagues in the state of Andhra Pradesh are virtually giving away land for free. 99 paise, is what the deal has been done with TCS. Are you worried about things like that? Do you see those things as an opportunity?
No, I'm not worried, because Andhra Pradesh can have anything, but they cannot have Mumbai and Pune. You see, ultimately you need to have Mumbai. Mumbai is Mumbai. You cannot compete with Mumbai.
The Supreme Court has agreed to hear pleas seeking regulation of so-called obscene content on OTT platforms and social media. The government has said that content on some of the OTT platforms is not just obscene, but perverse. The Apex Court has issued notices to the centre along with Netflix, Amazon, Google, Meta, Apple, among others. India's industrial output grew by 3% in March compared to the same month last year. The rate of expansion is faster than February and was led by higher electricity generation and higher production of consumer durables and infra-related products. The government has set up an inter-ministerial committee to frame broad contours of national manufacturing mission. Sources tell CNBC-TV18 that the committee headed by Niti Aayog CEO BVR Subramaniam will look at the mission's framework. Abhimanyu Sharma is here with more. Abhimanyu.
till the National Manufacturing Mission, it was announced in this year's union budget by the finance minister, and the government is looking to increase the share of manufacturing as the share of the GDP from around 16 to 17% in the coming years. And as part of this itself, the stakeholder consultation is already underway with several domestic industry participants and several states. And what we understand now, that what government sources have indicated, that an interministerial committee has been set up to frame the broad contours of the National Manufacturing Mission. And also, the mission aims to promote the Make in India initiative and is going to cover small, medium and large industries. It's also going to cover 5 focus areas particularly, which will include ease and cost of doing business, a future-ready workforce for in-demand jobs, a vibrant MSME sector, availability of technology and quality products. It remains to be seen how early the stakeholder consultation would be completed and how early the contours would be finalized, based on which a broader policy would come out in the public domain, which would involve responsibilities of respective line ministries in the central government and also responsibilities for states. Also, several PLI schemes which already exist for domestic industry participants, they also may be factored in as part of the entire National Manufacturing Mission, speaking of the broad framework which is currently being looked at by the committee.
Right, thank you, Abhimanyu, for that. In international headlines, Yemen's Houthi rebels have alleged that a U.S. airstrike killed 68 people in a prison holding African detainees. As per Yemen's Interior Ministry, the detention center was housing 115 African migrants. The attack came hours after the U.S. military revealed that its forces had hit more than 800 targets in Yemen since an air campaign began 6 weeks ago. Israel's attacks in Gaza have killed at least 50 people in the last 24 hours. Intense bombardment was reported across the territory. This comes as Israeli Prime Minister Benjamin Netanyahu dismissed the idea of establishing a Palestinian state. The Israeli leader said that it was folly to think the proposal would bring peace. Meanwhile, Israel also carried out an airstrike in Lebanon's Beirut. The country's military said that it targeted a Hezbollah missile storage facility. The group has dismissed Tel Aviv's claim. Donald Trump has recorded the lowest 100-day approval rating of any U.S. president in the past 80 years. A Washington Post ABC News Ipsos poll found that only 39% of American adults approve of Trump's handling of the presidency, while surveys by CNN and NBC found that 41% and 45% American adults support Trump's policy. One of the polls also found that 3/4 of Americans believe Trump's economic policies are likely to trigger a recession in the near future. A 31-year-old man has been charged with second-degree murder after driving into a crowd at a street festival in Canada's Vancouver. The attack killed at least 11 people, including a 5-year-old girl. Police confirmed that terrorism has been ruled out because of the suspect's history of mental health issues. Officials have said that more charges are expected soon. Canadians will cast their ballots today to elect the country's next Prime Minister. Incumbent Mark Carney called the election in March shortly after taking over from Justin Trudeau. His main opponent in the race is Conservative leader Pierre Poilievre. The Conservatives appeared certain to win any contest by a landslide at the start of the year. However, final polls suggest the Liberals are slightly ahead. US President Trump's tariff war and his barbs about making Canada USA's 51st state have emerged as key election issues. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC-TV18.
Mahindra & Mahindra has announced a major strategic move to bolster its position in India's commercial vehicle market by acquiring a majority stake in SML Isuzu. The acquisition reflects M&M's ambition to scale up its presence in the intermediate and heavy CV categories, complementing its strong footing in the sub 3.5-ton segment. Under the deal contours, M&M will acquire nearly 59% stake in SML Isuzu for Rs 555 crore at a price of Rs 650 per share. This stake purchase includes 43.96% from Sumitomo Corporation and 15% from Isuzu Motors, which currently holds shares in the public market. Following this stake acquisition, M&M will also make an open offer to acquire an additional 26% of the company at a significantly higher price of almost Rs 1,555 per share. The transaction will be an all-cash deal, and the company expects the acquisition process to be completed by December of 2025. The objective behind the acquisition is clear. M&M wants to solidify its presence in the bus and truck segment, where currently it holds a modest 3% market share in vehicles over 3.5 tons. With SML Isuzu's integration, M&M expects to double this market share to 6% immediately, and more ambitiously, the company aims to grow its share to 10 to 12% by FY31 and surpass 20% by FY36. Notably, SML Isuzu commands a 16% market share in the intermediate light commercial vehicle segment, a crucial category that bridges LCVs and MCVs, providing an important growth lever for M&M. SML Isuzu, a prominent name in the LCV and MCV spaces, operates a well-established manufacturing facility in Shahid Bhagat Nagar in Punjab. The company has shown a consistent growth trajectory over recent years, with a turnover of almost Rs 2,200 crore in FY24, up from 1,822 crore rupees in FY23 and 924 crore rupees in FY22. This acquisition aligns well with M&M's broader strategy to diversify and deepen its CV offerings, positioning itself more competitively against players like Tata Motors and Ashok Leyland. It also gives M&M access to a strong brand, an experienced dealer network, and a product range that complement its existing portfolio. Here is the in-depth conversation on that Shrin Bhan had with Mahindra Group MD and CEO Anish Shah on the deal and industry outlook.
M&M has announced a major acquisition. The company will acquire a 59% stake in commercial vehicle manufacturer SML Isuzu for 555 crore rupees and will also launch an open offer for 585 crores for an additional 26% stake, as it looks to strengthen its position in the trucks and buses segment. With the acquisition, M&M is likely to immediately double its scale of production and is eyeing tripling that by FY31. Joining us now to talk about the road ahead is Anish Shah, the Group CEO and Managing Director of the Mahindra Group. Anish, many thanks for joining us here at the CNBC-TV18 studio. It's great to have you, and congratulations on getting this deal done. But let's start with valuations. A big difference between what you offer the sellers and what the minority shareholders get. It's 650 versus 1554. Take me through how you arrived at the 650 valuation.
I would just say that it's a fair valuation for all concerned. And for us, we've always followed a very structured process in terms of focusing on certain businesses, investing where it makes sense. And it made sense for us to invest at this value because we feel that from here we can grow the business and deliver returns for our shareholders, which is a very important aspect in how we look at this. And therefore, a blended value is what we really saw. That's what we're finally investing. And on that basis, we feel that it's a fair and appealing deal, which has a very good strategic fit as well.
I'll talk about the strategic fit in just a second, but let's just get through the nuts and bolts of this. By when do you anticipate all the approvals to come in? And of course, you do also now need to make an open offer. By when do you hope to close the deal?
So typically, 60 to 90 days is the process. And we hope to be able to stay within that time frame and close it then.
I know you've said that you intend to keep this a listed entity, but is that the plan as far as the foreseeable future is concerned, or is that the medium to long-term plan as well? Do you envisage a future of this being a separate listed entity?
That is a plan right now. I'm not sure whether that will change or why it will change, but we feel that it is important for this to stay as a listed entity and be able to compete in its segment effectively.
Okay, let's now talk about the synergies, and let's address this at the back end to start with, and then I'll get to the front end. At the back end, what do you believe the synergies can be, you know, both in terms of the capacities that you have and how you intend to make use of those? What's the plan on the back end?
So, Shirin, scale matters. And there are synergies across the entire spectrum. To start with the back end, it's looking at first the product complementarities and the investment made in developing new products. It is about procurement, the manufacturing strengths that come in. And this is where M&M's manufacturing strengths will play a huge role as we look at building a stronger stake in this segment. But before that, let me even take a step back and talk about why this makes sense overall. If you think about different segments we play in, we're in a strong leadership position in almost all the segments we play in today. SUVs, we've gone from a 12% to a 23% market share. And we don't really play in all the SUV segments as yet. Despite that, we're at 23% market share. In tractors, we've gone from a 38, 39% to 43, 44% now. In electric three-wheelers, which is a space where we really had a small business in ICE three-wheelers at a 7-8% share, we are now at a 43% share in an ultra-competitive market and with the #1 player in that segment as well. In LCVs, we are at 51.9%, up from the low to mid-40s a few years ago. So we're playing in a very significant way in multiple segments. This is one segment where we have a 3% market share. And there are actually different parts of this segment, because when we look at greater than 3.5-ton commercial vehicles, you've got a light and intermediate commercial vehicle segment, and then the MHCV after that. In light and intermediate, we've got a lot of strengths that play to what we do elsewhere. And that's where SML Isuzu also has a number of strengths, and that combination is a powerful one. So as we think about that scale, and therefore coming back to your question, at the back end, from a manufacturing, product, sourcing standpoint, and the talent, of course, there are significant things that are positive for us.
I'll come to talent in just a second, but you know, the growth aspiration, especially leveraging on the back-end synergies that you spoke to us about, 10 to 12% market share from the current 3.5% market share. You feel confident of being able to get to that by FY30?
We feel confident we can get there, and we have a target of 20% plus for the next 5 years. And therefore, we want to put this business on a very significant path for growth.
And what does this now mean as far as the front end is concerned? You know, in terms of dealerships, in terms of franchisees, what happens on that front post this deal going through?
So there again, we see a number of synergies, but we will leverage what we have in the business today, because we are in a growth mode. This is not an acquisition about a cost rationalization. This is an acquisition to help us broaden the footprint to go bigger on growth. And that's where the dealership footprint that exists in SML Isuzu will be a very meaningful one for us. In addition to that, how we sell to the customers, the service we can provide, the ability we will have to be able to meet their needs across a much wider footprint, all of that is a positive for both the businesses, and which is where scale comes in a bigger way.
So when you talk about growth, you know, you gave us some indication of the kind of levers that you intend to deploy as, in order to drive growth. What could be potentially some of the others? Because you made it very clear that this is not about cost rationalization. This is really about your aspiration to grow in this space. What will be the growth drivers, the growth engines for you here?
So it starts with products, and that's the advantage we have in Mahindra Trucks and Buses as well, is a very good set of products, and that's similarly what we see in SML Isuzu. The second aspect is the ability to deliver those products at a compelling price for our customers, and that's where our manufacturing sourcing strengths come into play. The third is the ability for customers to be able to look at what they get from this, save cost, be able to address any challenges very quickly, have a wide footprint to be able to get service and parts and everything else that they require. And as we look at all of these three aspects, if they're done well, that allows us to play in a much bigger way in this segment.
You know, speaking of playing in a bigger way in this segment, I mean, this is a fairly competitive space as well. But since you're talking about forecasting for the future now, is an ICE future the only future that you're looking at, or is an EV future also part of the plan as far as this segment is concerned?
ICE and EV. And SML Isuzu also has a very strong pipeline for electric vehicles. They have showcased some of that at Bharat Mobility. And that combined with our strengths in EV will allow us to put forth a compelling set of products.
How soon can we expect the EV side of this portfolio to be out of the market?
I don't have a timeline on that, but from my understanding, it's going to be in the near future, not too far off.
Near future would mean, a year, 2 years, a longer period?
My sense is probably in less than a year.
In less than a year?
But as I said, we have to do more work to really fully understand it. And once we fully understand it, then we can commit to timeframes.
So in terms of next steps now, are there likely to be any changes on the people front as well? Are we likely to see any restructuring on the people side as well?
So we have a lot of respect for the management team at SML Isuzu, for the business, for their employees, dealers. I think it's a very well-run business. That's a big plus. And therefore, as we think about growth, we're going to leverage the talents and skill sets. So we will work together to see what makes sense overall for every leader and for every employee. But we are going in with a mindset where we have a high degree of respect for them. We feel that they can do a lot, and they can help us actually build this business and take it to where we want to take it.
Just stepping out of this particular acquisition to what's happening as far as the marketplace is concerned, I'm sure you've seen the comments that Mr. Bhargav has made at Maruti Suzuki on what's happening really as far as the low-end market is concerned, where the pain continues to exist. What is the sense that you get, about spending capacity at this point in time and how that's likely to drive consumption or not aid consumption as much as it ought to?
A lot is defined by the products that we have as well. And we've seen and continue to see a good demand for our products. More on that, Shireen, I will hold off till our earnings call, which will be exactly a week from today. But on balance, we've seen a good market. We have stayed with the commitments we've made year to date at least. And as you've seen our numbers for volume for both SUV and tractors month over month, they have been fairly healthy, the volumes that we have declared publicly.
On the EV launches that you did, and that of course was a big pivotal moment as far as the journey is concerned, what's the update? What's the status check? What can you share with us on how that's panned out so far?
Our customers love the car. I love the car. I
Is
love
that what
driving
you're driving?
it. Yes, absolutely. And it's just so much fun to drive. The power, the technology in the vehicle is just truly amazing. And I can't drive another car after this right now. And that's the feedback we're getting from customers. Right? We've had customers who see the car and literally, even friends of mine who've just seen it and said, okay, so when will I get the car? I'm buying it now.
What is the growth curve, Anish, really, as far as electric mobility and electric cars in specific are concerned? And I'll also ask you this in the context of what we're seeing happen globally, where we have seen a sort of tempering, a significant tempering as far as electric mobility is concerned. What's the sense that you get here? And, in a future where perhaps in a not-so-distant future where we're going to see more competition in the form of Tesla and Elon Musk entering the Indian market?
A lot depends on product. Because if the product is a wow and delivered at a reasonable price range, the customer is going to want the product. Right? The next question will be on charging. And our vehicles today offer a 500 to 550 kilometer real-life range. Certified is 682 and 656 for the two vehicles we launched. So we've taken that anxiety away. I charge once a week. And most people in cities will need to charge once a week only, unless you're going out of town. Charging on highways is not there as yet, but that will come up very quickly. And that's something I know the government is very focused on and is driving as well. So once all of that happens, an EV offers a much better value proposition in many ways than an ICE. There will be specific ICE products that customers will want, and that will continue. So we don't see ICE going away completely. But we see EV taking a significant stake of the overall share.
So what is the current market share and what's the aspirational market share as far as the EV segment in the car space is concerned?
For India, currently it's 1.5%, which is very, very low. With the products we have, we feel that we will get to 30% EV penetration in the next 3 to 5 years.
You know, a large part of your tenure so far has been about consolidation. It's been about making sure that you fix what needs to be fixed and then focusing on the growth gems that you want to take forward. Do you now feel ready and comfortable to take on more M&A likely, just the way that you've done this particular deal?
We will continue to be very structured in our approach. Our first year was focused on capital allocation. Then we pivoted to growth after that, and we really pushed all our businesses to think big, to be able to deliver a lot more, and that's what we've done across our businesses, including our growth gems. Starting last year, we said we will again pivot to delivering scale, and that is a faster growth trajectory, which is again something we have been able to demonstrate across businesses. And that's the phase we're in right now. But we will look at each business, make sure it can actually deliver what it promises. And if it does, we will put more power behind it, more capital behind it, and enable it to grow.
So, you know, you talked about some of the tailwinds that you're focusing on, but if I could ask you about the headwinds currently, it is a very, very volatile global environment. It's an uncertain global environment with the way the tariffs are playing out. But specifically from your point of view, what are you concerned about today? What is worrying you in terms of potential headwinds?
The world is a very, very uncertain place, a lot more than we had ever imagined it would be. I remember we talked about black swan events that happened sort of once in a lifetime. Now they probably happen every month. So our approach is to be agile and to be able to respond to things as they happen. Having gone through COVID, it's made us much stronger. The semiconductor crisis was a very significant one for the auto business. Therefore, what worries me is actually what I don't know in terms of what's going to happen tomorrow. What we know, we've got plans in place for, and therefore, we want to stay very agile to be able to respond to things as they happen and pivot where we need to.
You know, exports was a big part of your plan of growing the business as well, and that's been a fairly small percentage driving your revenue so far. Does that change, or are you approaching the export business differently in light of the current state of flux?
So it's been a little slower than we would have liked, largely because of the success we saw domestically, because the kind of demand we got for the products we launched, we just couldn't deliver in time. And sometimes that's a good problem to have. Now we are focusing on exports more, but specific markets, we want to try to get to a 15% market share in certain markets before we go to the next set. So it's a fairly ambitious set of plans, but again, one that's done in a structured and disciplined manner, where we're picking certain markets, trying to get to a certain market share there and then move elsewhere.
So where are you closer to being able to get to that 15% market share in the markets that you've already forayed into?
In South Africa, Australia and Chile.
Okay.
Right? These are three markets also that have very little domestic manufacturing. And that's one where we've played in over time. We've had distributors set up a brand that exists as well. And the products that we're launching there now are seeing a lot of very good demand. So we should be able to get, we are in 10% in one of the markets already in a segment we play in, at 5% in another market. And therefore, we're on our path.
You know, digressing away from auto for just a second, because one of the other potential growth areas, especially again in light of all the developments that are taking place globally as well as locally, Mahindra Defence, you know, what's the playbook looking like at this point in time, given the many factors that you have to contend with?
So we play only in the transportation and security areas of defense. So armored vehicles is one that we have been supplying to the Army for many years and continue to be at the cutting edge of technology there. In fact, that's where our trucks and buses business helps as well, because there are synergies across both. We're doing a lot in terms of security systems, in terms of counter UAWs, in terms of surveillance mechanisms and surveillance underwater systems and so on. So it is a big area, and we feel that in transportation and security alone, there is a lot that can be done. We do not want to play in the ammunition-related areas of defense, and we are therefore staying away from that.
Back to the deal, and you said this is going to be a win-win as far as shareholders are concerned. So, outside of the expansion, what is it going to mean in terms of the margin profile changing as well, given the many synergies you already spoke of?
So our focus is on growth right now, and therefore...
will that also entail significant investments? Or
we feel that the investments that we plan for in our trucks and buses business should be sufficient. We may come back and take a look at it. There may be some changes, but I don't expect a whole lot. And SML Isuzu is generating a fair amount of cash as well, so that will help in their investment plans. Margins will improve over time, but our primary focus right now in the short to medium term will be on growth. And as we drive that growth, we will see a continued improvement in margins.
Well, Anish, it's always a pleasure. Many thanks for joining us here on CNBC-TV18, and thanks very much for taking us through what this deal means, but also a whole host of other issues that you're focusing on. And of course, look forward to hearing more from you once the results are out and the silent period is over. But thanks very much for joining us here. That's Anish there, taking us through what the deal with in the LCV space means for the Mahindra Group and how this is going to be a strategic opportunity that they intend to build on. We'll take a short break here on the record and return with the markets right after this. Stay tuned.
Hello, welcome to News Center. I'm Parikshit Luthra. China has imposed restrictions on 7 medium and heavy rare earth mineral exports in the midst of Trump's tariff war, which has led to a protracted standoff between the world's two superpowers, US and China. As per a New York Times report, shipments of rare earth magnets, a critical component used in manufacturing electric cars, missiles, even drones and robots, have been halted at many Chinese ports. NYT has reported that the Chinese government is drafting a new regulatory system which, when in place, could permanently prevent supplies from reaching certain companies, including American military contractors. China accounts for over 70% of production of rare earth minerals across the world. 75% of rare earth minerals imported into the United States between 2019 and 2022 came from China. India's EV sector is definitely in a spot of bother. Sources say that the industry is facing production challenges, adding that Beijing is now demanding end-user certificates signed by both the Indian Foreign Ministry and the Chinese Embassy before authorizing any such order. In fact, Rajiv Bajaj has warned that the industry could be headed towards a grinding halt if the curbs are not removed.
As of yesterday, I still have to verify this, but I was given to believe that suddenly China has decided not to permit the export of heavy rare earth magnets, which are used in motors of electric vehicles. And as you know, that for some of these EV components, the whole supply chain of the world resides in China.
Exactly.
So if this is true, we are still trying to come to terms with the facts, all the facts. But if this is true, it would mean that, and if it doesn't change, then in a matter of weeks, the entire Indian EV industry will grind to a halt.
And joining me now is Ashok Chandak, President of the Indian Electronics and Semiconductor Association, Rakesh Sharma, Executive Director of Bajaj Auto. We also have with us Jonathan Cheng, China Bureau Chief at the Wall Street Journal. Gentlemen, thank you very much for joining us. Mr. Sharma, if I can begin with you, give us a sense of what is the immediate impact these restrictions that were imposed by China on the export of rare earth materials. I believe this started on the 4th of April, but are you already seeing impact on the production line?
Hi, Parikshit. Yes, the Chinese government announced a slew of strict controls pertaining to the export of rare earth magnets, which find application in motors in the EV side. And we are completely dependent on those. The controls came into immediate effect on 4th April, so much so that product which was in the ports for shipment was also held back. So obviously there is a disruption in the supply chain, and the process for end-use certification still needs proper buttoning down and definition as to who all will have to validate it, from where it will go, and what will be acceptable. And it finally ends up back in China, where a certain committee will give a decision on this. So the process itself is a little bit ambiguous, and that is what we are trying to come to terms with. And in the meantime, I would say that during this quarter, different product lines will get impacted by the supply chain, because as the stocks run out in the system and fresh stock and it's not replenished, we will see during the quarter severe impacts on almost all product lines.
Right. So you're expecting severe impact on all EV production lines, Mr. Sharma. That's an important point. I would like to ask you, so what the ask here from the Chinese government is, you have a performer that you have to fill in a required format. That needs to be endorsed not just by the Ministry of External Affairs in India, but also the Chinese Embassy. You also have to give a declaration that this will not be given to any third party or will not be used for making weapons. Do you feel that this is a very complicated process and almost amounts to saying that you will not get this at all?
No, I wouldn't say that this is not possible at all, because at least from our point of view, it's the end use is confirmed and it is common knowledge, and we should be able to certify end use. It is the steps in the process. See, there is a very broad-based circular of guidance issued by the by PRC. But that has to be then broken down into steps. Which is the certifying agency, and which is the endorsing, validating agency, and what will happen at the end of the whole process? How much time is it going to take? Are we supposed to do it transaction-wise, or is it supposed to be quantum-based, period-based? All these things have to be still sorted out.
Right. Very important points there. Sir, stay with us. Let me also get in Jonathan Cheng of the Wall Street Journal. Jonathan, this is not just for the auto sector. This is for all electronic manufacturers. This impacts the space sector, the semiconductor sector, and it applies to all nations for that matter. This is clearly linked to the US-China trade war. At what point do you think the Chinese government will start thinking of a reprieve or for pulling away this non-tariff barrier?
I think it's very hard to predict when that might happen. I think China recognizes here that it does have some leverage because all of those industries that you just mentioned are many of them are reliant on these rare earths. Of course, rare earths aren't actually all that rare. They're plentiful around the world, but there aren't many countries that can process it, and that's where China really has a chokehold on the global industry. And because all of these industries are linked to national security, there is a national security grounds that they can claim on this. And of course, we've seen that trade more generally has become a national security issue. Certainly, that's the way the US has been looking at it for the last few years in terms of restricting semiconductors and restricting other things that they see as critical to China's advancement. And China obviously sees it that way as well. So even if they're being used for things that don't have anything to do with the military, it is going to gum up the whole system and introduce a lot more uncertainty.
Right. Let me get in Ashok Chandak of the Electronics and Semiconductor Association. Mr. Chandak, how worried is the Indian electronics manufacturing industry, the semiconductor manufacturing industry, as a result of these curbs that have been announced by China? Are your members writing to you to seek help from the government? Have you already approached the government for help?
I would call from electronics semiconductor perspective, the impact is still a bit far off, I would call. Because particularly for example, as Mr. Sharma highlighted, the magnets and other things required for electric vehicles, these are many times hand to mouth and in supply chain. But while for semiconductor industry, there is a very limited quantity of these materials required, but these are very important surely. There is always some supply chain running in terms of the warehousing, stocks, and other stuff. So immediate in a couple of months, we don't see any major issue that is going to come up actually. However, this issue will need to be sorted out, need to be addressed. And my view is, obviously China is taking steps, we don't know how to dwell why they do this. But I would say that a single country cannot stop the whole world actually. So there would be ways by which some, like the end use certificate is an example which has been put up over here, that would be there in force for some time, which will create running of the existing production requirement of electronic semiconductor industry, not only India, which is at an answer stage for semiconductor right now, but also globally. But there are new alternatives, those are going to emerge actually. In fact, last couple of quarters or years, I have seen already in a semiconductor industry, many companies are trying to diversify their supply chains and supply bases. And we also know that for this rare earth element, it is not the question of where the rare earth elements are available. There are several countries, those have got the mining possibility, be it Australia, even Africa, Sweden, even in India, for example. The issue is of the refining and processing. And there also refining processing, there are two factors we should look at. One is the economical factor, and second is the technology factor in terms of the refining processing. And I would say that the amount of the total amount of the market size for these materials has limited the number of companies doing the refining and processing of these materials. And China definitely has got the leadership in terms of the market share, surely over there, with whatever means and other stuff. But this should happen going forward. As we see, already several companies worldwide started talking about diversifying supply chain, looking at even the recycling as one of the method, because some of the materials required for magnets and other semiconductor lithography machines and equipments, they would need they could also use the recycling topic actually. So I would say in short term, yes, definitely there is a cause of concern. I want to bring one example here, if you allow me 30 seconds more. When Russia-Ukraine war started, everybody was worried that the entire industry will come to the grinding halt because most of the precious gases like neon and other stuff were supplied from Ukraine. And you would see that, except few noise here and there, nothing much stopped in terms of the industry per se, actually. So I would say that we should stay tuned. The industry is working and people are working towards finding out the alternative ways and means. Even India has an opportunity, I would call, under Department of Science and Technology, there is a material processing department, and we could also look at expediting those refining and processing capabilities over there, actually.
Right. Let me get in Mr. Sharma once again. Mr. Sharma, any domestic supplier that you can source these earth magnets from, rare earth magnets from? What about going to other nations, such as Australia for that matter, to get these rare earth magnets? Is there a market, a supplier base anywhere else where you can get them?
Well, certainly not domestically. And these rare earths, as one of the panelists pointed out, China is currently a 90% market share, primarily because of the solvent extraction and the chemical processing capabilities, which take time to put in place, whilst rare earth minerals are available in many places. So in the short term, or even in the medium term, let's say over a year or 18 months, it is difficult to substitute China as a source for rare earth magnets for application, at least in our industry, which is the EV sector.
Do you feel this is going to result in a price rise for electric vehicles specifically in the coming months?
No, I don't think it is price related. I think it is disruption related. So at least the responsible OEMs will not leverage this to increase prices. There may be some secondary market which develops, but we should not lose sight of the fact that India is a very large market for EVs, at least for two-wheelers outside of China. Currently, and let's say in the next 2 to 3 years, it's going to be a huge market. So it's a huge business opportunity for anybody, obviously including China, to supply the Indian EV system. So I think in the short term, it's very, very important to understand what the objectives of the Chinese government are, to take them at face value and not consider this as a non-tariff barrier, and quickly align to the process requirements. If that can be clarified on both sides, on the India side and the China side, then I think we will be able to deal with this short-term disruption.
Right. Jonathan, this was one leverage. Hopefully, it will not become like the semiconductor moment that we saw during COVID-19, where there was a crisis with regard to semiconductors all around the world. But do you feel that there are other critical materials where China could probably turn off the tap in order to have more leverage in the trade negotiations with the US?
Well, I do think that this is one of the more powerful ones, just because it's not something that is so clearly understood by other people. I think it's something that plugs into all of the things that are the most sensitive, and therefore something that it can inflict great pain. But also it's not so easy to understand for the average person. So there may be less blame that goes towards China in that regard. But I do think that, China has had a lot of time to think about this, because during Trump's first term, most of his focus was on China, and China did have to look for different ways to exert leverage. I think exactly what the other panelists have said here. I think you're going to start to see other countries look for alternatives. In the past, you never really had to think about this, because you knew that you could get what you needed from China at a very good price. But if China is going to start to withhold it, then you need to look for alternatives. And I think when that starts to happen, then China loses some of that leverage. And I think you'll start to see that happen over the medium term. It won't change overnight. And that's what gives China its leverage now. And arguably, that's the reason why they should use their leverage now, if that's how they see it, because they may not have it going forward.
Right. Mr. Chanda, final question to you. Do you believe that, at a time when the world was trying to diversify away from China, this move may actually force companies to continue investing more? And if tomorrow they need these materials and they're not getting it at the price they want or so easily, do you feel that more companies may want to get into China and that diversification towards India may slow down?
No, my view is this is one of the classic examples during the all so-called trade wars, that the countries are going to leverage what they have, and that's what we see from a China perspective. But I can tell you that particularly from a semiconductor industry perspective, the companies have already started several quarters and years to look at the alternative mechanisms. So, for example, some of the examples which are known to me particularly, US already started processing of the gallium and germanium. In Japan, there is some activity going on. The company in Australia called Lenas, they already started to work on this neodymium and praseodymium oxides. And this is going on actually. So my view is, in the short term, definitely there is a major cause of concern, no doubt about it. It could also create the shortages and delays and some disruptions, including a price rise for these materials actually. But in a medium to long term, the multiple opportunities would emerge, and there would be more suppliers, those would emerge for multiple materials. And growing, it is increasingly seen now that for semiconductors as well as electronics, both, those are critical for every country. The several companies are coming forward now and try to invest and try to bring. And as I mentioned before, because the total market size in terms of the $1 million or $1 billion, if you want to count, was quite limited. And that is why many companies did not diversify. And China continued to do the economically viable way of processing and selling at affordable prices, actually. That went on. But finally, if it comes to this kind of a situation, it will become a problem. And I want to put again one more statement here, just 30 seconds more. I mean, I know everybody's talking about China taking steps and other thing, but I would say one country would be affording to choke the entire world for a longer time. They would negotiate, they will provide something. Finally, everybody has to survive in the world actually. So they are not going to stop.
That's right.
I don't think that everything will come to a stop everywhere, every country in the world. Somewhere the solution would
That is hope, sir. That is hope. That is the hope, sir, that the US-China trade war is unsustainable. These tariffs are unsustainable, and somewhere they will come to a truce very soon, and that will be good for everyone, of course. But thank you very much, Mr. Sharma, Jonathan Cheng, Ashok Chanda, for joining us on this very interesting discussion. We're taking a short break. On the other side, we take stock of China's continued commitment to its economic growth amid escalating tariff tensions with US and what it means for the global trade order. With former US Ambassador to the ADB, Curtis Chin. When we return, stay tuned. Welcome back. China is arming up to protect its economy from the ongoing trade tensions with the US. The country has announced a series of measures to stabilize employment and is fully confident of achieving its annual growth target of 5%. China's top economic planning body said that the country will implement a scheme to boost consumption and set up a venture capital guidance fund by June. China also plans to help companies pivot to the domestic market. China has already allocated 160 billion yuan to boost domestic consumption. Another 140 billion yuan investment is expected to follow. To discuss this, joining us on the show is Curtis Chin, former U.S. ambassador to the Asian Development Bank and senior fellow at the Milken Institute. Thank you very much, Ambassador Chin, for joining us. Let me begin by asking you, Chinese exporters are likely to be the worst hit as a result of the U.S.-China tariff war. Will these measures by the Chinese government be enough to protect them?
You know, time will tell, but my gut is we'll continue to see China roll out additional steps to protect their domestic economy. You know, whether it's the United States or China, clearly it's all about a domestic audience. And I was struck by your opening comments that talked about, you know, China's trying to do everything it can to get approximately the 5% growth that they have projected. But just a few days ago, the International Monetary Fund, the IMF, came out with its latest GDP projections for China and have lowered it to 4% for both this year and next year. So you believe the IMF, you believe China, but clearly everything is in flux. And I think both the United States and China, let alone every country that's dealing with these proposed tariffs, are trying to figure out what to do next.
Right. Ambassador Chin, do you also feel that, you know, we were just discussing in the earlier segment how China has stopped the supply of rare earth minerals to countries around the world and made this into a non-tariff barrier. Do you feel that some of the domestic economic measures will include, subsidizing the domestic manufacturing even more and creating more barriers for companies dependent on Chinese suppliers?
You know, it's still continuing to play out, but I think when you look at anything that China might do, you need to focus on the whole issue of stability. I mean, that is the critical challenge for China right now. If you think about the near-term impact of tariffs, of China's steps, you need to think through in terms of domestic employment, what happens to those Chinese workers, no fault of their own, that find themselves without income and a job. You know, and I think more than any major country in the world, you know, China puts the emphasis on stability. I think each side, China and the United States, are really trying to wait out each other. Who will bear the most pain in the near term? And what was really striking also about your last segment was, again, the difference between the short-term challenge and really the medium-term consequences of these actions, which we mix for all nations involved. For China, as one of your commentators noted, it makes them a less reliable partner. Just exactly what some people have said about the United States. And so what it means, I'm based in Southeast Asia, it means Southeast Asian nations, other nations will need to think through the importance of diversification away from China, maybe away from the US too, as key markets or key sources of these kind of intermediate elements that go into products that countries make and then seek to export.
Right. And this is a story that you've also been following very closely, Ambassador Chin, as to how Apple is considering making India the production hub for all phones for the US market especially. Now, considering this trade war has broken off and you've got these tariff wars and China also imposing a lot of restrictions, do you think India will have an advantage? Will India see more manufacturing coming as a result of US-China trade tensions?
Well, you know, as a big fan of India, I mean, I think that is all of our hope as we think about diversification of manufacturing away from, single markets. I've seen reports already, is China slowing the export, the ability to move some of that knowledge, that manufacturing knowledge from companies, manufacturing lines in China, kind of stalling or delaying that movement to India. No, again, these are all short-term actions. Ultimately, things will shift. We saw that even during the pandemic. The reality of supply chains did shift away from China also to nations like in Southeast Asia, like Vietnam. That continues even though the pandemic, of course, has faded. And so this trade war will end. I think we can all guess when it might end. For me, it's when there is a face-saving way out of this situation for all the major players. And when that happens, the reality is that steps being taken by companies to shift away from China, to shift into an India or elsewhere, those steps will continue to play out in terms of decisions made now. For the short term, they're really going to play out in the long term.
Right. Another point that companies and nations look at while considering any investment is how secure is that country? How safe are the investments there? What is the impact of terrorism and international trends? Now we've seen a very gruesome, ghastly attack in Jammu and Kashmir. You've been following that very closely. And India has drawn a clear linkage between Pakistani state actors, the government, and the terrorists who were involved. How do you think this attack on Indian civilians impacts the investment sentiment towards India?
I think for me, and let's hope that it's true, that this is a short-term situation. I certainly stand with the U.S. president and others around the world who expressed their support for India in this situation. The reality is, when I look at all these countries that I deal with in Asia, concerns about terrorism. Here in Thailand, we just had the impact of an earthquake in Myanmar. People are worried in the short term. But the key will be these weeks and months ahead. How will these things play out? For me, the bigger story, we talk about all these headlines right now, the bigger story is the reality that India will also need to think about markets, beyond China, beyond the United States. Actually happening right now, I think, as you know, you've been following also, in Mumbai is the first major summit of something called IMEC, which is like an India, Middle East, Europe economic corridor, trying to increase connectivity between India through the Gulf and then on to Europe. I'm based mainly in Southeast Asia. The Milken Institute is based in Singapore, but I'm right at this moment in Thailand, where I support a terrific company called Equator Pure Nature, which just has launched from Thailand into India. This is a company that produces a line of all natural consumer products, laundry detergent, body wash. But what is most critical is that Thailand has lessons learned from its dealing with issues like pollution, concerns about the environment. And I think, as you know well, these are also concerns that take place right now in India. Worries about the environment, worries about pollution. So I think India is very smart to partner and to look at opportunities for products and services that they might export to Southeast Asia, westward to the Middle East. Likewise, welcoming
Ambassador Chin. Right. Ambassador Chin, on the IMEC corridor, that's a very important point. Keeping in mind the current circumstances, the CPEC, or the Belt and Road Initiative, has been a major cause for concern in India for many years now. This makes the IMEC even more important. In the current geopolitical environment, do you think there is appetite to speed up the execution of this project? Are we going to see eye to eye with different countries? What kind of lead does India need to take?
Well, I think, IMEC was really launched on the sidelines of the G20. India had a terrific, successful G20, but the test is always what comes of it, what happens with these programs. Whether it's a direct rival to China's Belt and Road Initiative, the reality is that there is a need for greater infrastructure finance throughout Asia. There's a greater need for digital connectivity. So I say, bring it on. I think nations can benefit from all of these efforts, but clearly nations also have to look at the bottom line in these contracts. I'm in and out of South Asia. I remember when I was in Sri Lanka, there's talk, are the China programs debt aid or are they debt traps? Countries will know best kind of the fine print. And my hope is that transparency is what is key, whether it's an IMEC project or a Belt and Road project. Clearly there's a need in this region, and what we need is projects that are transparent, that are more accountable to increase that connectivity. I'm always struck that when I look at the regions of Asia more broadly, South Asia is probably one of the least connected. There was an op-ed I read out of India that talked about maybe India needs to think of itself as an island. And what did they mean? They meant, of course, trade with Pakistan is relatively limited. Trade north with China has its concerns. So they need to look at greater development of ports and air connectivity to the southeast and elsewhere in the region. But there is opportunity there. I think U.S.-India relations continue to be very well, and I hope they continue to be built on.
All right, Ambassador Chin, thank you so much. We've completely run out of time. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Hello and welcome to this very special episode of IPO KYC. Ather Energy is India's second pure-play EV maker, and it's getting all set to list on Dalal Street. Founded in 2013, Ather Energy was a college project of two IIT Madras graduates, Tarun Mehta and Swapnil Jain. And today, it's valued at nearly $1.5 billion. It's also been a while since we've done an IPO KYC, and this IPO will test the investor appetite. One, after the market turbulence on account of Trump tariffs, and two, even the EV ecosystem, given the mess at Blue Smart or the troubles at Ola Electric. So let me waste no time and welcome our very special guests on this episode of IPO KYC. I have Tarun Mehta, co-founder and CEO, and Swapnil Jain, CTO and co-founder. Thank you very, very much for joining in.
Our pleasure.
So let me start with the question everyone wants to know, right? Path to profitability. You've been loss-making for the last, I think, since inception now. When do you think you will turn profitable?
See, so any new business, especially R&D and a deep tech business like ours, where there's a lot of investment in product development.
That I believe that it's up to China to de-escalate, because they sell 5 times more to us than we sell to them. And so these 125, 145% tariffs are unsustainable.
We also hear about all the different countries that may be ready to deal on some level, whether it's tariffs or currency or whatever. Do you have any idea how close we are and who could be first? And is it possible, Scott, that there could be a template that could be, we wouldn't have to do each one individually? Because it seems like it's very complex and just would extend the process to months or even years to do 100 different countries. Is there any way to do something that looks almost standardized? And who would we do it with first?
Well, Joe, we do have a standardized template. We're not going to share it. But as I've said before, there are 15 to 18 important trading relationships. As you said earlier, we'll put China to the side. That's a more complex negotiation. And with the other 17, especially with the other Asian countries, we've had many countries come forward and present some very good proposals, and we're evaluating those. But I tell you, Joe, when I look at these proposals, and some of them, are really willing to lower their tariffs, lower their non-tariff barriers, but I look at what they're proposing and I just think, how did we get here? How did we get here?
Right.
And I agree with President Trump. I don't blame it on these countries. I blame it on the past administrations. And it's going to be a big victory when we make progress in the getting these
tariffs, non-tariff trade barriers, currency manipulation, state subsidies of labor and industry off.
Been quite a bit of consternation expressed about the U.S. brand and the country, U.S. losing its preeminence as a place for capital allocation and investment. I want to bring up, I just happened to see it this morning, one of our frequent guests, Kyle Bass, points out, okay, you're going to go somewhere else rather than the United States. Europe is anti-growth, anti-capitalist, pro-tax, super regulatory, loose collection of broken economies, and points out that the Euro Stoxx 50 index has had a 1.86% annualized return for the past 20 years. The S&P, 10% plus. Are you concerned that this could snowball into a point where would they go? If you don't go to Europe, where would you go? And where will Europe go? China? Is that what we're worried about?
Well, Joe, look, what this administration is committed to is keeping the U.S. the best place in the world for capital to arrive. And we are doing that. We're going to have tax certainty. We are going to not be taken advantage of in trade anymore. And we are going to deregulate the deregulated large economy in the world. If you look at the Draghi report, he says that Europe has basically tariffed themselves. I think it's 50% on goods, 100% on services, and we'll see if they can make any progress there. The other thing I would tell you is I imagine that the Europeans are now in a panic over the strength of the euro, and you're going to see the ECB start cutting rates to try to get the euro back down. Europeans don't want a strong euro. We have a strong dollar policy. We just saw this unfortunate incident where China claimed sovereignty over a Philippine island. Are you going to send your capital to a country that behaves like this?
Mr. Secretary, I have a question that relates back to China, but also back to a comment that you made last week that I think actually moved the market. So last Tuesday, you had a meeting that JP Morgan hosted. This was this private investor summit, and your comments either leaked out or got out. And those comments, if you really look at the market, moved the market materially higher on the back of them, where you said, quote, there will be a de-escalation in the very near future. That was the quote. And so my question to you is, what confidence or assurance do you have, having made that statement, when it now appears, maybe I'm misunderstanding it, that when you did meet with the Chinese last week during the IMF meeting, you did not talk about tariffs yourself, and it sounds like you're not engaged or involved in these China tariff discussions yourself. Maybe the president is. I know he said that he is, but you said that you don't know about those conversations.
Well, Andrew, first of all, to clarify the meeting with JP Morgan, there was nothing that I said in that meeting, nothing that I had not already said in the mainstream media 72 hours before. So I was surprised when the market rallied. And if you were to look at what happened after the meeting, after I sat down for a press conference, markets sold off. So if you bought during the meeting, you actually lost. To get to the meat of your question, that it's a complicated relationship with China, but it is my belief that which is unsustainable will not be sustained. And again, the Chinese business model is predicated on selling subsidized goods into the U.S., and it's just not a long-term business strategy for them. So I am sure that they will come and want to de-escalate.
Right. But that's just so we're 100% clear. And by the way, you may very well be right. I actually happen to agree with you on that front. But I'm agreeing with you in the context of just my presumption that that is correct, not because I've engaged in conversations with them directly. And it sounds like you haven't either, just so we're all on the same page.
Andrew, just to feed the news cycle, I'm not going to talk about where we are or not. What we're going to do is create the best deal for the American people, and that is obviously not done on television.
Mr. Secretary, last Friday, Time magazine published an interview with President Trump where he said that he could see a year from now 50% tariffs on goods coming from China. Is that a future you could envision?
Again, Becky, we're going to have to see where the de-escalation takes us. You know, President Trump is leading for the important trading partners. President Trump is leading the negotiations, and we'll see what he decides on.
Mr. Secretary, earlier this morning, Japan's economic minister said that there would be no change to our stance that we are demanding full removal of U.S. tariffs. Can you speak to where our conversations are with the Japanese? Because clearly, at least publicly, they seem to be pushing back.
Well, again, Andrew, if they want to litigate the negotiations in the press, they have an election coming up, an upper house election coming up in July, so I can't imagine that they would say anything else. I don't think they're going to come out and say, oh, whatever the U.S. wants, sure, we'll do it. But I will tell you that the negotiations with our Asian trading partners are going very well. Vice President Vance was in India last week, talked about substantial progress. I have mentioned that the negotiations with the Republic of Korea have gone very well. And I think we've had some very substantial negotiations with our Japanese allies.
Secretary, China quietly, it says here, exempting certain goods from tariffs that they need, which shows their dependence on a lot of, or interdependence with the United States on many, many different things. Similarly, the Trump administration has announced quite a few exemptions on some of the reciprocal tariffs for things that we absolutely need here. Isn't this sort of an opening for what negotiations would look like? And would you just take a complete decoupling with China off the table right now, since we know global trade has benefited the globe? We don't want zero global trade. But doesn't this indicate what's at stake here?
Well, Joe, I think this makes my point that the Chinese, they are exempting all these goods, tells me that they want a de-escalation. And what we haven't done is escalate by embargoing those goods or putting a trade ban on those goods, which we could, if we needed to gain more leverage. We haven't done it. They've actually given us a list of what comes from the U.S. that is valuable to them. And, I can tell you, I do have an escalation ladder in my back pocket, and we're very anxious not to have to use it.
Mr. Secretary, Gary Cohn was on Face the Nation yesterday, and he said that he thinks we're weeks away from starting to see the effects of this actually show up, whether it be in prices or, I guess to some extent, you could suggest in shortages of certain items. Where do you think we stand just in terms of how long it will be before Americans really start to feel this?
Becky, I can't tell you what various retailers have done in terms of stockpiling, in terms of substitution, in terms of elasticities. I didn't see Gary's interview.
Mr. Secretary, I have a separate question about Apple and maybe manufacturing in the U.S. or manufacturing as it relates to this trade war potentially with China. You saw last week that there was a news story. Apple may be moving or may try to move all of its manufacturing of iPhones that are exported to the United States or imported into the United States, moving that manufacturing from China to India. And I'm curious what you think of that. That might be an improvement from having it manufactured in China, but it's also not manufacturing it here in the U.S.
Well, Andrew, I think maybe it speaks to China being an unreliable trade partner, and again, these aggressive actions against the Philippines. And as I mentioned, I would guess that India would be one of the first trade deals we would sign. So watch this space.
Mr. Secretary, should we assume that regardless of what we hear or in being reported and sourced or however it's going on, that there are discussions going on between the United States and China at all times, and probably at most different levels, both high and low. Should we ignore a lot of the noise and just assume that in earnest both countries are trying to, as you say, de-escalate? Can we put that in the bank?
Well, Joe, these are the two largest economies in the world, so
Yes.
there are a lot of touch points. As you know, last week was IMF World Bank week in D.C. I had my Chinese counterparts here, and we talked about what you talk about at IMF World Bank meetings. We talked about financial stabilities. You looked ahead to trying to prevent financial crises. You talked about global financial regulation. So there are lots of touch points all the time.
Okay, we'll leave it at that then, and just assume that that both sides have an interest, a mutual interest, I think, in getting to a better place. We appreciate your time, as we always do. Mr. Secretary, thanks.
Good to see you.
Good to see you.
Thank you. Coming up, we're going to take a check on the markets, and then later, Harvard, America's oldest and wealthiest university, at a crossroads with the Trump administration over funding. Former Purdue University President, OMB Director Mitch Daniels is going to join us right after this.
In platforms, obviously is going to be investment heavy in the early years, and then the losses are recouped and profits come. We are no different. After 10, 11 years of investment, our recent trajectory has been very solid. Any profitability is a function of two things, which is your unit economics and then the volumes you put behind it. So how are you doing on both? Unit economics, you will notice in our recent quarters, there's been an enormous improvement. We have almost doubled our gross margins over the last 3 quarters, over 3 quarters of FY25, hitting almost 18-19% kind of gross margins, adjusted gross margins. So significant progress there. And if you see our volumes, again, YTD till Q3, there has been an almost 35-40, I think almost 40% plus kind of growth. So volumes have also grown quite healthily. So put these things, two things together, I feel pretty bullish about where we're headed as a business on profitability. Also, if you see our overall losses, they've started to trend in the right direction. If you see, again, 3 quarters performance, losses have been reducing, not just at percentage, but even at an absolute level. So I think the basics of a business, the more you sell, the more margin it brings home, it covers your fixed costs, and you become profitable. I think the engine starts to make sense in where we are. And I'm very optimistic about where it's headed.
So peak EBITDA losses behind the company, and from here on, losses should continue to moderate, as we've seen?
I think if volumes are continue to grow, as we hope for them to be, for the industry and certainly ourselves, and we continue to defend our margins. Remember also, Aether's positioned its products in a more premium position. That's allowed us to command generally a more premium pricing. I think that our ability to sell software separately as Aether Stack, these are things that give me a lot of confidence on continued margin growth. And volumes, nobody's challenging where EV industry is headed overall. It is a growing industry. So I think, yes, I definitely feel that we continue to move towards profitability.
So you spoke about unit economics, which is basically gross margins. And gross margins in the first 9 months of FY25 are 19% versus 9 months in the comparable period of last year.
Okay.
These margins are sustainable and should improve. Gross margins, right?
Yeah.
That's the trajectory.
These are not one-time spikes. They've come about as, honestly, and I'll give a lot of credit to our product development teams. They've come about because of fundamental and hence sustainable reductions to our cost structures of the core vehicle platforms across chassis, electronics, battery, across the board. There's been a lot of work on the supply chain front, which has fundamentally reduced cost structures. With introduction of multiple vendors, with a lot of work on value engineering, a lot of work on straight pass ratios. So this is not a one-time, and the proof of that is this is not a 1 quarter or 1 month performance. This is now been consistent over 9 months. So hopefully that gives us a lot of confidence.
So for you to turn
with the yield, the 10 years at 428, the 2 years at 376. For more in the markets right now, we want to get over to Mike Santoli. Mike, we're used to coming in and seeing pretty big moves in the morning lately, hundreds of points when it comes to the futures, and even more points, basis points when you're checking out treasuries too. This is relatively quiet.
It is, Becky. We're kind of digesting some big moves. Obviously, a large up move last week in the S&P 500. Bond market has sort of calmed down into a zone. I think that's welcome. You don't necessarily want to see the market really swinging wildly on a day-to-day basis, but it's also brought us to a pretty consequential spot here. The S&P 500 has regained almost exactly half of what was lost from the February peak down into the early April decline on a closing basis, a little bit more than that, and it's kind of taken us right into the gap that was left by the huge sell-off April 3rd after the details of the tariff plan were described. And so we closed that day April 2nd, 56.70. You fell 5%. So basically, you're kind of trying to figure out if we've had this reset and if it is justified. I think that's part of the argument that we're actually going to be having in this market implicitly for a while now. Take a look at some interesting asset moves too. I'm sure you guys were citing gold earlier. Bitcoin and the NASDAQ 100, getting to that whole kind of dual nature of Bitcoin. Is it digital gold or is it just a proxy for big tech? Well, here you have the election. They were all around the same spot in retrospect. And obviously, Bitcoin had the massive move on that sort of policy hope after the election, that huge pump in excitement and big decline. Gold then took the baton. That's right here. And that's essentially started to back off a little bit. Interesting reversal a week ago in gold. It really did get overheated, a lot of flows. It's probably just resting in an uptrend. But it shows you it's left the NASDAQ 100 behind. It's trying to perk up. You did have some strength relative to the rest of the stock market last week. So we'll see how this dynamic plays out, whether these are in fact going to have to converge. Finally, semiconductors relative to the equal-weighted S&P 500, the broad measure of large-cap stocks. Wanted to highlight this because this is a 5-year chart. Finally, semis have this violent bounce, but where does it take it? Barely above where they stood at the peak in early 2022 before that bear market. The equal weight also in a similar spot. So we've really reset. You want to see semis probably play some kind of role or participation at least, if not leadership, from here, guys.
What's next? I guess we have earnings that are going to continue to roll in.
Yeah.
We've got the FOMC meeting coming up in a couple of weeks. We've got the Berkshire Hathaway meeting coming this weekend.
Yeah.
But I just look for the points that the market's going to be watching. What data points?
Well, jobs on Friday, in the middle of all that, I do think is significant. The earnings setup has been kind of interesting because obviously, most companies are throwing up their hands saying we can't give very confident guidance about what's going on. But the stock reactions to earnings so far have been better than the historical pattern. So that suggests the market at least got to a point where the expectations were low enough. But I think it's going to be that earnings reactions, jobs, and then who knows, maybe Berkshire moves the market.
Okay. Mike, thank you.
Up next, the impact of tariffs on fans of Shein and Temu, plus a new price target for Apple from Morgan Stanley ahead of earnings. Details after the break. We're coming right back.
The EBITDA level, what should the gross margins be? Should they hit 25%? Do they need to hit 30%? Is there an aspiration that you want in terms of a business model?
See, I think difficult for me to comment on ourselves per se, but I can point to a few references in the industry. I think Indian two-wheeler businesses have been incredibly strong, and we have a lot of respect for them. And I think those become our guiding compasses on margins. Mass premium players have in the past been able to get to late 20s, even early 30s kind of gross margin structures. And I think those kind of gross margins in the two-wheeler business seem to generally ensure strong profitability. So I think for any business that's trying to build a mass premium kind of play, an ultra premium strategy like some of our peers, like in the bike side, they can obviously yield much higher gross margins. But a more mass premium play with scooters, I think seems like that kind of number seems to have worked out very well in the past for our peers.
Okay, and there's no reason why EV gross margins should not get to the ICE gross margins, right? There is
different structures of the industry and different structures of the product.
But you can aspire for late 20s gross margins, realistically.
I think there are certain advantages with EV sales. I think electric opens up this entire window of opportunity, entire opportunity around software, which was not very strong, I think, with ICE architecture. Selling software allows you substantially higher margins, as you will see even in our numbers, and something we are also trying to perfect more and more. And I think this is something very new and novel with electric. Not just in India, actually even globally. Tesla sells its FSD pack at a substantial markup to the vehicle price. We sell our software on top of the vehicle price with a healthy markup. So I think electric, if anything, opens up some new opportunities for additional margin and revenue, which probably was not very strong with ICE. And that's why I'm even more bullish with EV.
Fair enough. That's a point well made. So for you, what percentage of your revenue comes by selling software, and what are the gross margins on software?
So roughly about 6% of our revenue comes by sale of software. And it's a very high gross margin business. Given that software architecturally is generally a higher margin business. So that's just the nature of that part of the world.
Okay. Very high. We'll go with that. What about FY24? I mean, your revenues dropped by 1.5%. You bounced back very smartly in 9 months with a 28% top line growth. What's the sustainable revenue growth we're looking at?
I think there is a secular growth that's happening, which is the growth of scooters overall. Scooters continue to grow much faster than motorcycles. And given that we are scooters first right now as a business, that part of the growth affects us also. The other part is, however, the expansion that we are doing. So we are expanding our stores. And the recently introduced model Aetherista, our convenience scooter, that's landed very well in convenience first markets. So there are a lot of new stores that we're adding in those parts of the country. So distribution will continue to expand healthily for us, and that's something we're excited about. In addition to that, remember...
About 3%. Earnings came in at $4.33 a share. That was above $4.06 for the estimate. Revenue of $1.1 billion was just short of estimates, but U.S. comp store sales fell 0.5%, and the street was looking for a slight increase. Meanwhile, international comps grew 3.7%. Domino's. That was better than expected. They sell Domino's in Italy?
I doubt it. Do they?
I don't know.
I don't know.
They know how to make pizza already.
Meantime, Morgan Stanley raising Apple's price target to $235 from $200. The analysts forecasting revenues and earnings to come in slightly ahead of expectations on strong product pull forward. A weaker dollar and strong services growth. Now, Apple set to report results on Thursday. So another earnings report that we're all going to be watching this week.
And Shein has raised U.S. prices on its products ahead of tariffs that are set to go into effect this week. Bloomberg says that the average price for the top 100 products in beauty and health have increased by 51%, with several more than doubling in price. The average jump for home and kitchen projects is more than 30%. Shein and its rival Temu, which ship cheap products from China, are facing tariffs on many items as the Trump administration is ending a loophole that allowed goods worth less than $800 to be shipped duty-free. I don't know. I don't know if you bought any of the stuff from there.
I never have.
It's a little flimsy, suspect.
Coming up, a big week ahead for tech with 4 of the Magnificent 7 reporting quarterly results. We'll run through what investors should be watching coming up. But first, as we head to a break, a look at the winners and losers on the NASDAQ. This morning, you're looking right there, a whole bunch of winners. MicroStrategy, Meta, Tesla, Zscaler, and Cadence Designs. We're coming right back.
Very early stage in terms of products. A good two-wheeler maker would have 6, 7, 8, possibly even 10 products in their portfolio. Our industry is still at a stage where we have 1 to 2 products each. So we are overall at a very early stage. There's nothing wrong with us. It's just that we are at an early stage. As our portfolio expands, and I'm not just speaking for Ather, I'm speaking for our entire industry. As we go from a single product or a 2-product company like Ather to potentially 6, 8, 10 products, there's natural expansion of the addressable market that is bound to happen. And as that product portfolio expands, it'll make it more and more viable to expand distribution.
Ladies and gentlemen, it's wonderful to be here in Mumbai in conversation with the Honorable Chief Minister, Mr. Devendra Fadnavis. I've always had conversations with him that have elicited headlines, so I'm hoping that we will be able to do the same. I had the good fortune of being at the G20 summit in New Delhi, which is where the idea of the India-Middle East European corridor was first announced in the presence of the Honorable Prime Minister Shri Narendra Modi. A lot has changed since the G20 summit. We are currently in a state of flux and volatility globally, where there is a global reset that is currently underway. But the hope is, and the belief is, that what is being touted as a game-changing idea will be a reality, with all parties on board, with all stakeholders on board, ensuring that it does in fact fructify. But to talk about Maharashtra's aspirations of being the gateway to the India-Middle East European corridor, let me address that question with you, Mr. Fadnavis. You have grand plans of positioning Maharashtra as an infrastructure hub. It's been called the gateway to India, but as part of the IMEC, how do you position yourself? What are you factoring in as some of the things that you could potentially do to your current plans to envisage a future that includes the IMEC?
Yeah, thank you. First of all, let me welcome everybody to this beautiful city of Mumbai, which is financial, commercial, and entertainment capital of India. And I think Mumbai and Maharashtra has to play a pivotal role in the IMEC corridor, because I think we will be creating an ecosystem which will support this entire idea. And when we talk about our plans to become a $1 trillion economy, I think we are working in several ways. If you can look at our infra push, which we have given in last few years, I think you have seen change Mumbai, and also the entire Maharashtra feels connected now. And I think when we look at the opportunities through IMEC, I think we have a great opportunity to become the logistics capital. We can move a lot of logistics from Mumbai. We actually are looking at advanced manufacturing. We are looking at agri-tech. We are looking at fintech. Of course, Mumbai is a fintech capital. So I think the clean energy push, the green manufacturing, all these areas I think are very important for us, because they will not only play a major role in making us a $1 trillion economy, but they will be also the drivers of the IMEC corridor.
Well, speaking of the drivers for growth and urbanization, infrastructure development, connectivity, as you outlined, are some of the key areas that the government is focusing on. For the benefit of our audience here in the room, as well as for those who are watching on TV and online, Mr. Fadnavis, what is the aspiration in terms of infrastructure development? Is there a number that you're working with that over the next 5 years, this is potentially what you would like to invest as far as infrastructure is concerned, to ensure that you can realize the many dreams that you've spoken of?
Yeah, absolutely. You see, between 2014 and 2019, we invested somewhere around $30 billion in creating infrastructure. You can see the coastal road, you can see the Atal Setu, you can also see the Samruddhi Highway. There are many iconic projects, the new Mumbai airport, many iconic projects which we built during this tenure. Now we want to do more. So recently, we have tied up with Indian financial institutions to raise a sum of around $50 billion. And in next 3 to 4 months, we'll be tying up with foreign investors to invest into $50 billion more. So there will be a huge push on infrastructure side. We are building a lot of access control roads, airports, ports. Now, you know that the new Mumbai airport will be ready very soon. Now we are building a new airport in Pune. We are also building one more airport in Vadhavan, which will be the third airport of Mumbai. We are actually building a new airport terminal in Shirdi. We are building a brownfield airport in Nagpur. So across Maharashtra, we are building airports. We are building roads. We have already built Samruddhi Highway. Likewise, now we are building one more highway, which is Shaktipit Highway. This will connect Nagpur. It will be from Nagpur to Goa, and it will actually connect the entire, that area of Maharashtra, which is up till now a little backward, to all the major centers of business. And this will actually transform our economy. And we are also actually building a lot of river connecting connectivity projects. So actually, if you look at Marathwada area, which is water stressed, in that area now we are building a river linkage project by which we'll be bringing 50 TMC water, the water which flows from west flowing rivers, which directly flows into the sea. That entire water will be brought to Marathwada and will make Marathwada drought free. Again, one more project which we are doing is more about urban floods. So we usually every year we have a lot of floods in the area of Kolhapur and Sangli. This entire water we are bringing through diversion canals to Ujni and to Marathwada. So there are huge projects around water, there are huge projects around infrastructure, roads, ports, airports. Again, you know that we are building Vadvan, which is, Vadvan is a game changer port. And you see, today, the biggest port of India is the JNPT port. It accounts for 60 to 65% of the container traffic. And this Vadvan port is 3 times bigger than JNPT. And actually, on its day one, it will be amongst first 10 ports of world. So this port is going to change, the entire way we conduct the business. And we are also integrating entire Maharashtra with this port, because with the Samruddhi Highway, we have actually brought 15 our districts connected to the JNPT port. So the port-led development is now actually expanding beyond Mumbai, Pune or Nasik to 15 new destinations. And now from Samruddhi, we are creating an access control road, which is just 100 kilometers to this new Vadvan port. So from Nasik to Vadvan, a new road will be created, and that will actually connect at least 17 districts to Vadvan port. And that will make, this port-led development expand to 17 districts of Maharashtra. So see that we are actually getting us ready for this corridor, so that, once all the signatory countries, they work together and they create this corridor, Maharashtra will be the future-ready state. It will be ready to use this corridor.
Well, future-ready as and when the IMEC does come together. But, if I could just continue on what you talked about, the port-led development, which, of course, is going to be a big part of this reality as and when it does take shape, Mr. Fadnavis. One of the challenges when we talk about doing business in India is the ease of doing business. The other is, of course, the cost of doing business. What will this mean? Logistics cost is a big cost as far as the cost of doing business is concerned. In your view, with the measures that you've outlined, if you can leave us with timelines by when you believe the measures that you've just spoken about will in fact be a reality, what could it mean in terms of the cost of doing business?
Yep, you're absolutely right, because EODB and CODB are two things which actually keeps you ahead. And we have been working on it for a long time. I mean, if you look at, ease of doing business initiatives taken by the state of Maharashtra during my first tenure, I think even the World Bank has recognized it, and the government of Singapore, which published one of its publication around ease of doing business in India, and they have put Maharashtra at number 1 in 2019. So I think that has always been our focus of achieving seamless business in entire business arena. Now we have also created a legislation around that. Our Maitri portal, which is one-stop shop for all businesses, to do the business seamlessly. So we actually have created a single window system by which anybody can access it, and this real single window, because I always say that many times there is a single window. When you enter, there are several doors which you have to knock. This is not like that. This is a real single window whereby actually end to end all things are connected, and we give the services totally from scratch to everything we are giving under this Maitri portal. Having said that, I think you're absolutely right that cost of logistics is something which is bothering businesses a lot, and that is why we are creating infrastructure and seamless movement of goods. See, now if you look at the movement of goods, or if you look at the JNPT port, from, let's say, Nagpur, it used to take 7 to 8 days for goods to reach JNPT port. Now it takes 8 hours. So with this, our connectivity push, once the Vadhavan is ready, and as per timelines, I think in next 3 to 4 years, we'll start the operations of Vadhavan. And once Vadhavan is ready, I think that will have huge impact on logistics, because today JNPT port is so jammed because it's only big port which is handling on this side. And turnaround time, although it's a very efficient port, but still turnaround time is high. But once Vadhavan is there, then I think the turnaround time will be very less, and that will actually lessen the logistics cost. I think around that, if you look at the Pune airport, which we are actually creating, this is not just an airport, but it's also, we are creating a huge cargo handling facility at Pune, because Pune is our manufacturing hub.
Yes.
And the entire manufacturing is done in and around Pune. So we are actually doing a cargo hub there. Our cargo hub will also be, one cargo hub will be created in Nagpur. We are doing it. And our new business magnet is now Sambhajinagar, where, the entire EV revolution has translated into action in Sambhajinagar. So you name it and they are there in EV. And they are also actually the connectivity to the Vadhavan port and the connectivity to the JNPT port is just 7 to 8 hours because of Samruddhi and because of the new corridor which we are creating. So I think a lot of things which we are doing will be adding up to, lowering the logistics cost. And when we started creating this Vadhavan port, I actually appealed to Honorable Prime Minister, and I requested him that we are creating a port. We are actually doing, a lot of reclamation there. So around the world, most of the efficient airports are reclaimed airports. So why shouldn't we build a new airport at Vadhavan? And he immediately agreed. And we are now also building one airport. So you see, a port and an airport together, that will create a huge ecosystem for businesses, and especially those who are into import and export, all those manufacturing which required a lot of export or a lot of import of the components. They will have an entire ecosystem created there for the manufacturing.
I just want to recap some of the big takeaways that have come in from the Chief Minister already. Almost $100 billion in terms of financing is what the Maharashtra government is hoping to do to aid infrastructure development. You've given us a timeline of the new port, operational hopefully in the next 3 to 4 years, along with the airport that's going to be coming up there. Third, Mumbai, which of course is your plan as far as creating the new engine of growth as far as the state of Maharashtra is concerned. What's the status check on that? How soon can we expect that to be a reality?
Yeah, of course, I think that's soon going to be a reality. You see, due to, our infrastructure deficit between 2000 and 2014, we lost a lot of IT revolution to cities like Bangalore, cities like Hyderabad, because, Mumbai being an island city, there is huge land constraint and the rentals went shoot up. They went up so high that it was unaffordable for tech companies to locate themselves in Mumbai. But now with our infrastructure push, actually we have connected the new Mumbai to Mumbai with Atal Setu, 22 kilometers sea bridge, and the entire hinterland which we have connected. Now we are creating a third Mumbai between, this Atal Setu, JNPT port and the new airport. And this will be 3 times bigger than the existing Mumbai. And it will be a sort of thematic city where we are actually building an Edu city. In the Edu city, we will be having 10 foreign universities located themselves, out of which 5 are in active dialogue with us. Actually, 5 have already applied. Since we have a non-disclosure agreement, I cannot disclose the names, but they've already...
Are they US-based, Europe-based?
Yes, US-based, Europe-based, yes, absolutely. I would say that these 5 universities are actually amongst first 100 universities of world. So we are creating an Edu city, we are creating a health city, we are creating an innovation city. Now this innovation city is a concept where we want to bring entire innovation ecosystem at one place. It's a actually 300-acre city where entire innovation will be hosted. And Mr. N. Chandrasekharan of Tata Sons, he has actually volunteered to create a framework around this city. And now we are actually actively talking to many stakeholders. And the moment I announced it, who's who from global community has contacted me, and they have shown interest that they want to locate themselves in this city. So we are creating innovation city there. You see, new Mumbai and this third Mumbai is already the data center capital of India, because around 60% of our data center capacity is created in this new Mumbai. So I think that it will be a very exciting city where you'll see a lot of technology. And of course, the biggest benefit to this city is that, the rentals or the cost of, property is at least, 50% less than Mumbai. So it is affordable city. We lost all this IT revolution because of the rentals. Now, the entire real estate which is getting created there is affordable. And also we are creating a huge, ecosystem for GCCs at this third city. And having said that, we are not stopping at the third Mumbai. Now we will be building fourth Mumbai around Vadhavan, because, Vadhavan is one area where we are creating port, we are creating airport. The bullet train also stops at Vadhavan, and our coastal road, which now, Bandra Versova we are creating, Versova to Bhayandar we are creating, Bhayandar to Uttan we are creating, from Uttan to Virar. So this entire western coast will be joined by the coastal road. So see the ecosystem which we are creating, that at one point there is a port, there is an airport, there is a bullet train station, and there is a road which is connected. And all this, the bullet train and this road, will bring you to Mumbai. Bullet train will bring you to BKC in 20-25 minutes, and this road will bring you to Mumbai in 40-45 minutes.
The question is, when will it bring us to BKC in 45 minutes?
See, that is also not very far, because, you see, unfortunately, sometimes politics is very cruel, and between 2020 and 2022, when there was some other government in Maharashtra, they actually literally scrapped the bullet train. But once we took over again, we started it afresh. And today I can tell you that every bit of work of bullet train is being taken up, and it's happening at a great pace. So let's say that by 2028, we'll be able to travel in the bullet train.
By 2028?
Yes, yes.
Is that a commitment and a guarantee?
Yeah. You see, from the Gujarat side, they are ahead of us because there was a single government in Gujarat. There was, double engine government. So it never stopped. So Gujarat, they are quite ahead of us. We are lagging behind, but I think now we have actually taken the pace and will be able to do it by 2028.
By 2028, we should see the bullet train being operationalized. That's a commitment here coming in from the Maharashtra Chief Minister, and that's going to be a big headline as well, Mr. Fadnavis. But you talked about losing out on the IT revolution because the land was not affordable, rentals were not affordable. Let me ask you this in the context of what we're seeing happen as far as other states are concerned. Your colleagues in the state of Andhra Pradesh are virtually giving away land for free. 99 paise, is what the deal has been done with TCS. Are you worried about things like that? Do you see those things as an opportunity?
No, I'm not worried because Andhra Pradesh can have anything, but they cannot have Mumbai and Pune. You see, ultimately you need to have Mumbai. Mumbai is Mumbai. You cannot compete with Mumbai.
You can't compete with Mumbai. But, in order for all of this to be a reality, I think sustainability is also going to have to be key to the aspirations of growing the city, whether it's into 3 or 4 new cities as well. So from that perspective, Mr. Fadnavis, what will the state government be prioritizing to ensure that growth is sustainable?
Yeah, I think that's absolutely right because, when we grow, the biggest concern is energy because, one of the indicators of growth is how much energy do you consume. And today we are somewhere around, the installed capacity in Maharashtra is somewhere around 46 gigawatt. And by 2030, it will be around 82 gigawatt. So almost double. We have already started working on that. But I must tell you that in this capacity addition, the addition will be mostly the green energy. See, today our entire energy mix in Maharashtra is just 21% renewable, and rest all is from fossils. But by 2030, our 52% energy will come from renewables. So there's a huge push on renewable. By next year, by the end of 2026, by December 2026, our entire agriculture demand, which is around 16 gigawatt, will come from solar. We have already started, it is India's biggest distributed solar scheme, which we have started, Mukhyamantri Saur Krishi Vahini, where around 3,000 feeders are being solarized, and already we have finished around 4,000 megawatt, and by end of 2026, it will be 16,000 megawatt. So we are giving huge push to solar, to wind, to also PSP, because of the Western Ghat, we have a huge opportunity into pump storage. So we are doing pump storage. We are doing now. We are working around green hydrogen. So I think on sustainability, especially when you look at power, we are doing a good work. And along with that, the second biggest polluter is public transport. So now we are actually transforming entire our public transport into green. We are using CNG, we are using EV. The biggest order of EV to all the EV manufacturers has gone from the state of Maharashtra. Actually, right now we have a huge requirement, but the manufacturers are not able to provide our requirement. So we are actually totally transiting our entire public transport. And again, because of the EV revolution which is happening in our country, I think that by 2030, even the private cars and the two-wheelers will be mostly EV, because now a lot of push is being given to EV, and the costs are also coming down. So I think on sustainability, it is our focal area, and we are doing it.
Well, you're talking about the EV revolution, Mr. Fadnavis. So let me ask you, is Maharashtra going to be part of Elon Musk's plan for India?
That only Elon Musk can tell, but I hope we should be, and we'll always try, we'll always compete, we'll always be, at forefront to welcome them.
But, you talked about supply chain diversification. You talked about the manufacturing opportunities that also present themselves today. In light of that, electronic manufacturing, for instance, I mean, big potential area for India. We've already seen exports go up exponentially in the last 2 years. What role do you believe Maharashtra could potentially play in new areas like this, linking it back to the IMEC as well?
Yeah, you see, of course, if you look at the investments which have come into Maharashtra, whether it is Toyota, whether it is JSW, whether it is Ather, all the players, Mahindra, all those are into EV have actually come to Maharashtra. In fact, Maharashtra has become the EV capital, and basically with a EV ecosystem and with our port capacity which we are creating, and with the entire seamless logistics plan which we have created, I think IMEC will be a game changer for us, for our EV plans, for our to become. Today we aspire to become the EV champions of India, but tomorrow we can aspire to become EV champions of this entire region, and that's what we are aiming at.
So what would you prioritize as far as the next steps are concerned? Many of the game-changing opportunities that you just spoke of, but in order of priority, what would the top 3 be?
No, I think, as I've already told you, that the priority will be, of course, advanced manufacturing is priority, EV is our priority, agri-tech is our priority. So I think there's a huge business opportunity which I can see because of this connected world, because of this connectivity, and all of us know that India once was very prosperous because of this route. I mean, this is an old route. It's not something which is reinvented. It's an old route. So I think that I am looking at the same prosperity. It's not just for India, but for all the participating countries. But India can be at the forefront. So in that endeavor, we want to be part of it. We want to lead it in India.
Well, Mr. Fadnavis, it's been an absolute pleasure. Thank you very much for joining us here this morning.
Thank you so much.
Outlining for us the plans that you have for Maharashtra as being at the forefront of taking the IMEC future forward, and how you intend to be future ready for when IMEC is a reality. Ladies and gentlemen, the Chief Minister of Maharashtra, thank you very much for joining us here this morning.
We're in a strong leadership position in almost all the segments we play in today. SUVs, we've gone from a 12% to a 23% market share. And we don't really play in all the SUV segments as yet. Despite that, we're at a 23% market share. In tractors, we've gone from a 38, 39% to 43, 44% now. In electric three-wheelers, which is a space where we really had a small business in ICE three-wheelers at a 7-8% share, we are now at a 43% share. We will leverage what we have in the business today because we are in a growth mode. This is not an acquisition about a cost rationalization. This is an acquisition to help us broaden the footprint to go bigger on growth. And that's where the dealership footprint that exists in SML Isuzu will be a very meaningful one for us. ICE and EV, and SML Isuzu also has a very strong pipeline for electric vehicles. They have showcased some of that at Bharat Mobility, and that combined with our strengths in EV will allow us to put forth a compelling set of products. Don't have a timeline on that, but from my understanding, it's going to be in the near future, not too far off. I would just say that it's a fair valuation for all concerned. And for us, we've always followed a very structured process in terms of focusing on certain businesses, investing where it makes sense. And it made sense for us to invest at this value because we feel that from here we can grow the business and deliver returns for our shareholders, which is a very important aspect in how we look at this. And therefore, a blended value is what we really saw. That's what we're finally investing. And on that basis, we feel that it's a fair and appealing.
Hello and welcome to Startup Street. I'm Arundhati Ramnin, and with me as always are both Shruti Mishra and Ritu Singh. These are the top headlines from the startup world.
UDA, an augmented intelligence platform for corporate legal operations, secures $105 million in Series A funding round led by General Catalyst with participation from Floodgate and Sierra Ventures. The funds will be used to expand engineering centers in Bangalore, which will serve as a hub for AI innovation.
Malaki, a sustainable premium beverage brand, raises 5.7 crore rupees in seed funding round led by Venture Catalyst, along with strategic participation from Mark Ventures and Dada Chanji Family Office. This fresh infusion of capital will accelerate Malaki's expansion into new markets, strengthen its online presence, amplify its sustainability initiatives.
Verse Innovation, the parent firm of Daily Hunt and Josh, trims losses in FY24 at 815 crore rupees, a 57% decrease from the last financial year, according to TOFLA. The total revenue dropped by 17.5% to 1493 crore rupees in FY24 from 1809 crores in the previous year.
YouTube appoints former Zalora Group CEO Gunjan Soni as the new country managing director for the India market. His appointment follows the departure of former YouTube India managing director Ishan Chatterjee, who left the company last year to join JioStar.
Amazon's Prime Day may lose its sheen this year on the back of US tariffs that has caused many third-party merchants to either sit out this year or reduce the amount of discounted merchandise. This, as per Reuters, the planned pullback by the sellers is to protect profit margins.
IPO-bound Meesho receives board's approval to change its legal name in India from Fashioner Technologies Private Limited to Meesho Private Limited. As per regulatory filing, this move is to align with company's corporate and brand identity.
Well, those are the key headlines that we are tracking for you today. Now, B2B SaaS tech, or rather, what's brewing today, what we have is Beyond Or Technologies, which is the parent of skill-based training and higher education platform Mversity, which has announced the close of a $5 million pre-Series A round that was led by Z47 and Lightspeed, with participation from Altiria Capital and Innowin Capital. Now, since its seed round from last year, the company has scaled to about 36 campuses across 18 states and says it is on track to end the current financial year with 75 plus campuses. So joining me now is Vivek Sinha, who's the founder and CEO of Mversity, to take us through how the company is going to deploy these funds for growth and more. Vivek, thanks very much for your time here on CNBC-TV18. Start by briefly taking us through what market gap you saw that you're solving for with Mversity, given your background with Unacademy as well, and the size of the opportunity that you try to capture.
Thank you for having me on the show, Ritu. So there's a paradox that we see in India as a country. On one hand, there is an acute shortage of skilled workers in nation-building and critical sectors like healthcare, infrastructure, education, tourism. These sectors are growing at a very rapid pace, and they have not been able to add capacity because of lack of skilled workers. So every now and then you will hear a statement from the L&T chairman saying that they are not able to add more projects to their order book because they're not able to hire enough skilled workers. So that's one part of the paradox. And on the other hand, the unemployment among graduates in India is more than 30%. So one thing that we have in abundant in our country is raw material in terms of talent, right? So what Beyond Zord does is that we are trying to solve the skilled workforce shortage across 5 critical nation building sectors. We do it by running industry aligned, work integrated, skill based higher education programs. We started last year with 9 campuses. And last year we were catering to the first industry vertical, which was healthcare. It's a massive sector which has been growing at about 20% CAGR in the last 15 years, very, very labor intensive, and all organized and unorganized, all hospitals are facing severe labor crunch.
Got that, Vivek.
Yeah. When it comes to nurses, technicians.
Yeah, very briefly, got that, Vivek. We have limited time, so very briefly, if you could tell us the business model, help us explain that, and also the kind of revenue and profits you're currently generating. At what pace is the business growing?
So we monetize the supply side of the marketplace, which means candidates who wants to pursue our skill-based program pay us a fee for the training that we provide to them. These candidates see value in our program in terms of leading these program leads to immediate employability. So that's our revenue model. We don't charge anything to the employer for whom we create these talent pipeline. So in short, that's how we monetize. In terms of our scale, today we are at about 36 locations. Each location does about, at steady state, each location will do about 300 students, and each student pays somewhere about 5 to 6 lakhs for our programs. These are long-term 2 to 3 year programs. So that's our revenue model, and that's our scale as of now.
All right. This $5 million that you've raised, what is the plan for deployment exactly?
So it will be used in 3 different areas. First, we are going to expand our campus footprint from 36 to 75 campuses. We are already, if I'm not wrong, the largest skill-based training player in the country in terms of our presence, but we want to further cement our position as the market leader. Second, we are going to launch about 3 sectors apart from healthcare and hospitality in the coming 18 to 24 months. So some part of the fundraise will be committed for that endeavor. And third, we are also going to invest heavily in our virtual reality-based learning modules, because that's our USP, that's the secret sauce which leads to better outcomes. So these are the 3 areas where the fund usage will happen.
I see. Getting to the 75 plus campuses by the end of the fiscal, Vivek, that you were talking about, what will enable this kind of an expansion? And over the medium term, what kind of presence are you looking at in India and also abroad, if that's something that's on your radar?
Yeah, these are ambitious plan. Honestly, we have grown from 0 to 36 campuses in flat 12 months. It's not easy. It requires a lot of operational excellence, and because these are physical campuses, large scale distributed operations, and that's requires operating chops. So we have a very seasoned teams of professionals from both EdTech as well as other industries that is going to deliver it. Of course, it requires support from our financial sponsors, which we have just received in form of the second fundraise. Third, it requires a lot of focus on standardization and value delivery so that my proposition doesn't break at such a large scale. So we are focusing on all these 3 areas to make sure that we not only meet our expansion goals, but we also don't dilute the quality in that process.
All right. Very briefly, you said you have ambitions, but currently, do you have plans on the table looking to expand outside of Indian borders?
See, like India, every other, especially if you look at Europe or the developed nation, that society is breaking because of lack of skilled worker. The median age in European countries is 40, 45 years. They are facing a much bigger problem compared to India when it comes to lack of healthcare workers or caregivers. And they don't have the raw material like us. They don't have the demographic dividend like us. So of course we have plans, but we don't want to run ahead of ourselves. This market is supply constrained. So the dominant player in this market will be the player which owns supply. And that is what we are doing. We want to own the talent supply. I don't think this market can be won by demand aggregating or just by building a thin layer of technology platform. That's a very low mode. So yeah, there's a tremendous opportunity if we are able to stitch the international demand piece, but we first want to start by owning the supply from India and then eventually stitch the international demand part.
Vivek, finally, I know you spoke about VR earlier in our chat, but beyond traditional campuses, do you see Inversity really adopting a more hybrid, a more online, or any other alternative format to widen this access to your training programs?
That's an interesting question. I'll explain this with an actual anecdote or an example. Imagine when a nurse treats a patient in a rare hospital scenario, the first time she performs a life-saving procedure like CPR is on an actual human, because all she has done in a typical college format is theoretical lectures. At Inversity, the same healthcare worker would have done that life-saving procedures tens of times on a high-fidelity simulator. So simulators which gives you real-time feedback on whether you are performing the procedure correctly or not, or whether you saved the patient or you lost the patient. So the difference between the training, it's not just for the sake of embellishment. The technology part and the virtual reality based simulation part in our programs is very, very real. The impact is 30x, I would say, compared to traditional.
All right, Vivek, we wish you the best with that. And we're going to have to wrap up on that note because that's all the time we had. But thank you very much for your time here on CNBC-TV18.
Thank you so much, Ritu. Pleasure talking to you.
Moving on the hot seat today, drone manufacturing startup Garuda Aerospace has bagged 100 crore rupees in fresh funding from venture capitalists. With this fundraise, the firm is now valued at $250 million. With this big Series B boost, Garuda is set to turbocharge its manufacturing, fast-track cutting-edge defense drones and chase global expansion, strengthening its position as a key player in India's growing drone ecosystem. Joining us now to discuss this further is Agnishwar Jayaprakash, the founder and CEO of Garuda Aerospace. Agnishwar, thank you so much for taking time out and being here with us on Startup Street. Congratulations on raising these funds. But how will the 100 crore rupee Series B funding accelerate Garuda Aerospace's expansion and innovation plans? How are you planning on spending the money that you've, raised?
Thank you so much for having me on. I think it is a phenomenal validation for Garuda Aerospace having bagged the 100 crores in terms of our Series B fundraise. It has been a phenomenal story over the last 4 to 5 years. I think major credit goes to the government in terms of the progressive government initiatives that they have brought in that has really enabled the entire sector to grow, not just Garuda Aerospace. We have manufactured and sold over 3,000 drones thus far. We have one of the most significant track records in terms of having served over 400 clients, almost 1 million flight hours. This really stands testament to the high utilization ratio, especially in the segments that we are in, which is precision agricultural drones, which has seen tremendous amount of adoption into the space. So what we intend to do with this fundraise is to focus a lot more on product development, because most times the common misconception about drones is that it is only used either as a photography or a videography tool in marriages, events and sporting events, or the other end of the spectrum in terms of the defense segment. But we have figured out ways and means how to utilize drones in disruptive and multi-billion-dollar segments like precision agriculture, Industry 4.0, mining, mapping, several other structural damage inspection and Industry 4.0 applications that increase efficiency and reduce expenses for our clients. That is the reason like major clients have started using drones. And I think we're just going to push the boundaries in terms of enhancing our products, ensuring that our tech stack is far more superior and also global expansion opportunities.
Absolutely. And speaking of clients, you serve over 700 clients, right? You just told us the kind of impact you've created for them. But if you could talk to us a little bit about the sectors that you're focused on and how is Garuda strengthening relationships with major clients like Tata, HUL, Reliance and other, government agencies?
I mean, our focus has always been the precision agricultural drone segment because we were first movers in the space. Honorable Prime Minister had launched 100 of our drones in 100 locations in 2022, post which Mahendra Singh Dhoni became a brand ambassador as well as an investor. And what we're what we're identifying and what we're addressing is the fundamental need for every single farmer in our country to save and protect his crop. Before, it used to be done by a backpack sprayer. And it was very, I would say, ineffective and resulted in a lot of crop loss. And that is the reason why precision agricultural drones have played a significant role in terms of reducing crop loss by over 26%, also saving per acre cost by upwards of 100 to 125 rupees for the farmer, which is why they're shifting and switching to drone-based spraying of pesticides and fertilizers. But beyond that, I believe where after the COVID pandemic, there has been a forcible adoption of drones. The reason why we've amassed over 700 clients, including the Tatas, the Godrejes, the Adanis, Reliance, plenty of other industries, is because they realize that there are far more effective ways to utilize drones by adding them and with payloads like probes, sensors, magnetometers, high-powered lasers, different types of sprayers. So we have enabled these drones to be supercomputer on wings, not just merely data capturing tools. A lot of AI and ML-based analytics goes onto the drones, making it a lot more intelligent. And we have managed to make sure that these drones are creating a lot more impact on ground.
Absolutely. So creating a huge impact there on ground, you're seeing it improve, especially for agriculture and stuff like that. But you saw your, coming to the numbers, you saw your profits surging nearly 3 times last fiscal, despite a 2-fold increase in your expenses. If you could take us through how you plan to bring your expenses down and what's the target for this year and what's been driving the most demand for you?
I think Garuda Aerospace has had an amazing 4-year run. From 2020, 2021, we closed at about 2 odd crores. 21-22, we were at 15 crores. 22-23, we were at 47 crores. 23-24, we were at 109 crores. And this past year, we we're at 123 crores. This has been a story of relentlessness in terms of identifying different use cases in the drone sector, and also the sector actually being conducive to a lot of these deep tech introductions that we have done and innovations that has followed. It is not just us, the entire industry has grown. Over 400 startups have cropped up. Plenty of them have received funding. Several of them have even gone public. So the entire sector has seen tremendous amount of growth. With respect to Garuda, we have followed a very asset-light, recession-proof, and very focused on unit economics business model. And that is the reason why we have been profitable for the last 4 years. Despite the revenue growth, we have maintained our profitability. Our gross margins hover between 30 to 33%. Our EBITDA margins between 20 to 24%, and PAT margins are at 14 to 17%. The reason why we've been sustainable and profitable is because we don't hire and then fire. We don't go after